impact and how the market reacts to the monetary easing. But I will leave that aside. So yes, I mean, I know we don't have a rate cut anymore. We don't have a rate cut. We have things on hold. We had 100 basis points of rate cut back in September of last year, when people didn't have any rate cuts. We got the 100 basis points of rate cuts. We don't have any more left. But my guess is that if you look at the statements coming from the RBI, they have now sort of shifted away from the statement that they have in the policy meeting to saying, okay, we will be data dependent. My guess is that they'll be forced to be data dependent. And if growth slows, and if you don't get any spike in core inflation, I think the space gets opened up. Now, as I said, we don't have it in our baseline, but my hunch is that the risk is that we probably will be seeing rate cuts or more, more liquidity being pushed into the system. But I think you have to wait for it. And if you get a rate cut signal from the Fed, whenever it is, I think that would be a good opportunity or good point at which the RBI can hang its hat on that and say, okay, fine, we are going to start cutting rates a little bit more. But we don't have it in the baseline. But the risk, I think, is that you will probably see more rate cuts.
Jahangir, pleasure speaking with you. Thank you very much for joining us. Good getting that insight on a variety of subjects. Let me just quickly run you through the stuff that is lined up here over the next 2.5 hours or so. 8:35, you'll hear from the management of Dr. Lal PathLabs to discuss their first quarter numbers. 9 o'clock, you'll have the management of Niva, Bupa Health Insurance. Stocks done well. 9:20, Sandeep Bhatia of Macquarie will weigh in on the market. 9:30, Thermax will be with us to decode their first quarter earnings. JSW Energy will be speaking with us. It's all about numbers today, isn't it? 9:50, we'll have the management of Cholamandalam Finance to talk about their earnings. Lots to talk there. And of course, 10 o'clock, Jaspreet Singh of Amber Enterprises talks to us about their numbers and their acquisition as well. It's the economy with Lata at 10:15, and they discuss the state of global and Indian economy post-tariffs with Khaitan of Morgan Stanley. That's the lineup.
Time to slip in a short break. Got a lot of stock-specific action to track for you on the other side. For the time being, we'll run you through the list. Coal India, Swiggy, Mankind Pharma, JSW Energy, PP Fintech. They'll all be reacting to positive news flow. Add to the list Thermax. On the flip side, Eicher Motors, Niva, Bupa, Aarti Industries, PNB Housing Finance will be reacting to negative news flow. Take that break, come back, get into further detail on all of these names.
Well, the cues across Asia are fairly tepid, barring the Chinese markets, which is the Hang Seng and even the mainland Chinese markets. You don't have too much green. Even there, I mean, the Hang Seng, just 2 points higher. Fairly subdued, and some of the markets like South Korea are down well over 2%. Let's pull up the implied open. It's suggesting that, once again, the start is going to be on the downside. And then we'll see if we can pick it up from there. There you go, 130 points lower. Lots and lots of earnings to go over. Plenty of stocks on our radar. So let's straight away get to it with our list of top 10 stocks to watch. Our team is standing by. Guys, good morning to all. Let's start with, of course, all the big earnings. So Darshan, how is Eicher Motors?
So Eicher Motors has reported largely in line set of earnings for Q1 FY26, and company continues to maintain its commentary about preference of growth over margin. But that's a concern, because for a revenue growth of 17%, you are reporting EBITDA growth of 3%, margin falling below 24%. It remains to be seen for how long and what's the level that Eicher will want its margin to settle at. But as of now, on the margin front, it's a concern. Talking about the headline numbers, profit has increased 10%, revenue was up 15%, EBITDA has seen a just jump of 3%, and margin has fallen to 23.8% from 26.5%, almost 300 basis points fall. That's year on year. Now, on the volume front, along with TVS Motor, Eicher continues to outperform its peers on YY basis. Royal Enfield volumes were up 17%. Even on the commercial vehicle side, it saw a growth of 11% year on year. Commentary, it's looking largely positive and saying that Royal Enfield continues to gain market share in the middleweight segment. But we'll have to see how does market react to its commentary related to focus on growth over margin. But as of now, I'm going with red.
All right, you're going with red. I'm hoping they launch a new bike soon, maybe an 800cc, which is not on the cards, but nothing wrong in hoping. Sudarshan, thanks for telling us about that. I'm going with green for Coal India because those numbers look good. Top line was a little bit better. EBITDA number was better at around 12,500 crores, even adjusted for the stripping ratio. Well, it'll be around 11,200 crores or thereabouts. So it goes down as a beat. How did that come about? Well, the street was bracing for a bit of a weak quarter because the last month or so as well, the volume offtake hasn't been great. And we already had the cheat sheet because we already had the volume numbers with us. So there was no operating leverage that will play out, given that the volumes are down by close to around 4%. But yet, they managed to outbeat the numbers. How was that? The realizations are more or less steady. That's on the blended basis. The FSC realizations moved up marginally by around 1.5%, which is good. And the e-auction realizations didn't decline as much as estimated, which is good as well. So the e-auction premium to FSA sales is at around 50%. The street was working with a number of around 45%. The employee cost as well was lower because the number of employees are down by close to around 3%. And in addition to the good operational performance, they've given a dividend of 5 rupees, and the gross trade receivables on a sequential basis has come down a little bit. So green on Coal India. But hopping across to Ekta, she's here to tell us about Mankind Pharma. Ekta.
Well, morning. Mankind Pharma revenue looked good. It was up around 23.4% year on year, largely in line with estimates as well. Margins came in at around 23.7%. The street was anticipating around 25%, and there was a profit decline this quarter. Maybe the stock would be resilient on account of the internals, such as the domestic business, which was up around 19% year on year, the consumer healthcare business, which is a part of the domestic business, which was up 15%, and exports, which was up around 81% on a year on year basis. What could probably weigh a little bit on the stock is the operational as well as the profit estimates, the profit performance as compared to estimates.
All right, Ekta, thank you very much for that. So it's Mankind in focus. JSW Energy is the next one we want to talk about. Vivek is here with details. Vivek, morning.
Well, good morning. Well, a strong showing, especially when you're comparing it on a year-on-year basis. But remember, it's an optically very strong number, given the fact that there are 2 new acquisitions, 2 new platforms that have started contributing to the earnings from Q1 FY26. So when you're talking about the revenues have jumped up by 79% on a year-on-year basis. EBITDA almost doubling on a year-on-year basis. EBITDA margins at 54.3 versus 49.4%, and profitability higher by 42%. So what is it that aided the profitability compared to last year? So KSK Mahanadi, this particular asset that the company acquired, that got operational, 1.8 gigawatt got operational, and that contributed EBITDA of close to 867 crore. Along with that, Utkal Unit 2 is also started operation, and almost 370 million units of power was generated over here. The O2 power platform also started generating, and that contributed EBITDA of close to 219 crore. Now, the company has upward tweaked its guidance as far as 2030 capacity addition is concerned. They are now aiming to take capacity to 30 gigawatt. Remember, the company currently has a capacity of close to 12.7 gigawatt. What was a slight miss was the fact that merchant power volumes as well as prices were slightly lower. So the open or the non-long-term capacity was something that did see quite a bit of a dip this time around.
Okay, in fact, thanks very much for that, Vivek. We will be chatting with the management of JSW Energy. They'll be joining in around 9:40 to talk about their performance. Okay, let's move on. A couple of numbers coming in from the insurance space as well. Yash is joining in. Yash, how did it look for PB Fintech and Niva Bupa?
Well, to start with PB Fintech, the numbers for PB Fintech were pretty strong. The premium growth has, exceeded the industry. The premium generated about 40% growth as far as that is concerned. The operational performance also remains strong in the quarter. If I have to speak about the highlights, the core online insurance premium was up 35%. New protection, which is health plus term insurance, that also grew by about 46%. Operating revenue, that was up by about 33%. Core online insurance revenue growing by 37%. So strong operational performance. This was on expected lines coming from PB Fintech as that guided as far as the fourth quarter also is concerned. This time around, both the core online business and the new initiatives business both have performed very strong, contributing to the overall revenue growth. Niva Bupa, the numbers have been very bad this time around in the first quarter. The net earned premium, that has grown at about 20%, but the operational performance is very, very weak. Underwriting loss has increased 100%, almost 100%. That has doubled. Operating loss has come in at about 145 crore versus a profit of about 23 crore. Combined ratio has spiked very sharply to 117% as compared to 106%. So decent premium growth. This is slower than what the company has been doing in the past, but the operational performance deteriorating very, very sharply in the first quarter.
Okay, all right. Thanks a lot for that, Yash. Let's hop across to Vamakshi. She's here to tell us about Thermax. Vama?
Good morning, Nigel. Thermax, the revenue was a miss. It declined by almost 2% on a year-on-year basis, and this is coming after, several quarters of revenue growth. This is disappointing, definitely, but, the operational performance, on the other hand, was much better than what the street was working with. The EBITDA has managed to improve by almost 401 basis points on a year-on-year basis, and this is because there was an incentive from the government worth almost 56 crores. The net profit resultantly saw an uptick of almost 38% on a year-on-year basis. Now let's look at how each segment has performed and contributed to the margins this time around. Industrial products and chemicals, which are generally good contributors to the margins, this time they're seeing a degrowth. The industrial products margins are down 88 basis points, and the chemical business is seeing a much sharper cut of almost 850 basis points this time around. On the flip side, industrial infra margins have improved substantially to by 996 basis points, and this is mainly on account of the incentive that I mentioned earlier. And the green solutions business is picking up as well, up almost 183 basis points. Now the ordering activity, it was quite robust. It did order inflow was up almost 7% on a year-on-year basis, and the order book as well was up almost 7%, and this has come in higher as compared to what the analysts were expecting. So overall, the revenue has missed estimates, but the operational performance was much better on account of the incentives, and resultantly going with the green for this counter.
All right, and we'll have the management with us, a little later to talk about these numbers and the outlook as well. Swiggy is the next one we want to focus on. Mangalam has got this. Mangalam, morning.
Good morning. So Swiggy, if you look at the reported numbers and you look at the internals, there'll be two different stories. The internals are stronger, and I'm going with green because on a reported basis, the net loss has widened all the way from 445 crores to 1,000 crores because of the quick commerce spends. But food delivery, that continues to do well and also sees, operating leverage benefits come by out there. And in quick commerce, the good part is that the company, just like Eternal, has said that they've moved past peak losses in quick commerce, and their average order values are now fairly comparable to that of Blinkit. So all of that points towards green for Swiggy. Remember, the reported revenue grew by 54%. The EBITDA was a loss of 954 crores, and the net loss was largely led by ad and sales promotion expenditure, which was on account of the Max Saver and other schemes that they come out with on their quick commerce business. Food delivery growth at 18.6%. The EBIT grew over 200%, telling you about operating leverage out there. and quick commerce revenue growth of 115%. If you compare it with the way Zomato or Eternal reported their numbers, they've been gaining market share in food delivery. Zomato's food delivery business grew 16%, whereas Swiggy grew 18.8%. But Blinkit has grown a lot faster than Swiggy. And that is something that the analysts expect already, which is why Swiggy trades at a sharp discount to Zomato as well. They've maintained their contribution margin positivity band for quick commerce. The only thing I'm watching out for is that they have 12% stake in Rapido. And with Rapido now entering food delivery, they are looking to monetize that stake. So whenever that happens, that would be a further addition to their cash balance. Going with green on Swiggy.
Okay, all right, got it. Yeah, indeed, they put out that public statement as well that they'll have to reevaluate what they want to do with that 12% stake in Rapido, because Rapido itself is getting into a related business now, which is food delivery. Thank you for that, Mangalam. We'll watch out for Swiggy for sure. Let's move on and look at Aarti Industries as well. Sonal, how are the numbers?
Weak numbers this time around. Again, there is pricing pressure that the company talks about. The revenues were down 7%, EBITDA down 31%, profits were down 70% on a YY basis. The company says that revenue declined to reduction in key raw material prices, and also some of the shipments were delayed from June to July. Quarter-on-quarter volume decline also came in due to some demand concerns, and pricing pressure continues to persist across major segments that they are working in as well. Their guidance stays 1,800 to 2,000 crore rupees of EBITDA by FY28. Capex for FY26 is estimated to be around 1,000 crore rupees. But going with red, because the indication was maybe pricing has bottomed, but Aarti Industry says otherwise, and a big player in the industry. So there will be an impact on the stock today.
Okay, all right. Thanks a lot for that, Sonal. Well, let's go back to Vamakshi. She's tracking PNB Housing Finance. Vama?
Well, not great news for the company, Nigel. You know, Mr. Girish Kousgi, who's the MD and CEO of the NBFC, has tendered his resignation, and he has cited that he would like to pursue opportunities outside. His resignation will be in effect from October 28th, 2025. Now, keep in mind that he was appointed as the CEO and MD of the company just 3 years ago, and he will also cease to be director on the board of directors of PHFL Home Loans. The company, however, has not yet announced who will take over. Keep in mind that since his appointment as at the helm of the company, the stock had gone up by almost over three times, from November 2022 to its recent 52-week high of almost 1,200. This overall news flow is negative because this comes after a slew of exits that have taken place at the company. So therefore, going with a red for PNB Housing.
Okay, all right, got it. Vamakshi, thank you very much for that. So PNB Housing also on our radar today. We've got Manisha now joining in to tell us what the action in the commodity space is looking like. Manisha, morning. Big rise in the dollar, right? Once again, 100 on the dollar index. So what does that mean? What's been happening with commodities?
Oh, well, yes. As expected on textbook basis, we have seen a decline across commodities as well. And not just energy and the metals, but most of the agro commodities also have gone for a sharp decline because as the dollar index hits 100, it becomes difficult for the exporters to keep those margins there. So whether it has been about rubber or cotton or corn, all these things that U.S. tends to export, all of that has seen a very sharp decline into the markets right now. But I do want to talk about copper as well, because after that 18% decline day before, overnight has been yet another 6% of a decline. So on the week, we are down by 24% when it comes to copper. The profit taking has been seen across board as well. It's a sharp pull-off when we see that when we look at the steel prices, that one is off its 7-month highs. Iron ore prices fell 2% overnight. Aluminum and zinc have declined quite sharply. Silver is now trading at a 1-month lows. Gold prices have slipped below $3,300 an ounce. Also, when you look at the Chinese data, the PCE numbers have come in much weaker than what the street was anticipating. So the economic data is not supportive as well. The dollar index is on the higher side. The tariff concerns are keeping the markets very edgy. So as we head into the weekend, I do see a lot of profit taking continuing for many of these commodities.
All right. Manisha, thank you very much for that. So that's commodities in focus there. We're going to take a quick commercial break here. Up next, you'll hear from the management of Dr. Lal Path Labs, the first management on the program today, coming up in just a bit. We will also have Siddharth Khemka of Motilal Oswal Financial Services on Fundamental Stock Talk. What should you be doing with some of these names on the other side?
Welcome back. Well, let's get to our first corporate on our radar. Dr. Lal's the first quarter's numbers are more or less in line, but they are guided for 11 to 12% growth with margins holding about 27%. We have with us Shankar Banerjee, the CEO at Dr. Lal Path Labs, who joins us this morning. Hi, good morning, Mr. Banerjee, and good to have you on the show as always. Well, we've got that growth guidance of around 11 to around 12%. Could you tell us, how much of it will be volume driven, and do you have any price increases that you intend to push through?
Yeah, hi, good morning. Thank you for having me on the show. So the 11 to 12% guidance that we have given is primarily volume led, and even in this quarter we delivered 11.3% revenue, and the sample volume growth was 10.7%, which is primarily driven by volumes. Therefore, the realization improvement that we see is not price driven. It is more of a mix, in terms of geography and test mix that we are consistently working on, because our SwasthFit bundled portfolio contribution has also inched up, has come in at about 27% for the quarter. So primarily this 11 to 12% we want to achieve without a price increase.
All right. And West, which is suburban, the integration of suburban, that's around, I think, mid-teens as a percentage of your total sales mix. The growth there was relatively lower. You're expecting that to recover when? Quarter 2, quarter 3?
So, we had taken a sizable, or we had made a sizable change in the overall IT infrastructure that we were running the suburban business on, and that had caused a bit of a market a disturbance, and we hope to recover quickly, maybe in another quarter or two, so that by in second half we should definitely see significantly better growths in the West region as well. Growths are coming back there.
All right, and SwasthFit, that's been a driver as a percentage of your mix. What will it contribute?
So for quarter 1 of this year, SwasthFit contribution has gone up to 27% compared to 25% contribution that we had, in the same quarter last year. So we have seen a 2 percentage point increase in terms of overall contribution of SwasthFit to our business, and we feel that it continues to be strong for us.
All right, just one thing, sir, with regard to the cash in the books, that's around 1,300 crores, right? And you've indicated there could be an acquisition that you're looking at. How soon? And what could the ballpark size be? Will it be 100 crore or 500 crore? Give us, what's your appetite as of now?
So we have close to 1,400 crores of cash right now on our books. And we continue to look for opportunity, and we are looking at, a geographic expansion, specifically in the south, where our current contribution and our presence is pretty low. So that's the area that we are looking at. We don't have any size in mind in terms of, the acquisition, but we would definitely like it to be in a geography where, or in certain cities and towns, which we can then get in and then grow subsequently. So there's no specific size target that we are working on.
Guys, on a slightly lighter note, but related to the business of needles, we got a blood test for my daughter a couple of weeks back. And she said, well, is there no way to take out blood without needle?
Without a needle. Oh,
I said,
I'm with her on that.
I don't know, Mr. Banerjee, that's the disruption we need, sir, to grow the business.
Yeah,
needle without it, but...
Yeah.
Sorry, what is that?
No, you are right. There are obviously a lot of people who would hate.
Okay, I think there's something wrong with my...
He's talking about people with the needle phobia. You're looking at one of them right here. I know the feeling too well.
Just one question on numbers, sir. So margins, you're guiding for 100 basis point contraction, right, for 26?
So beginning of the year, we had guided about 27% EBITDA margin. But after our first quarter performance, we are doing a bit of a recalibration. I think we'll be able to do slightly better than that for the year.
So you will raise your margin because you'd said FY25 was 28.3. You're guiding for 100 basis point lower. And now you're saying it perhaps is going to be not 100 basis point contraction. But
yeah, that's what I'm saying. We'll have to recalibrate that. We recalibrate and see,
Okay.
but it's likely to be slightly better than that.
Okay. All right. So we'll leave it on that note for this morning. Thank you very much for joining in and giving us some perspective on the business. That is Dr. Lal PathLabs at the end of Q1. Let's move on and welcome in Siddharth Khemka into the conversation this morning. Siddharth, such a huge list of numbers post-market hours yesterday, right? Tell us if anything stood out. Actually, let's start with Swiggy, because you can argue it both ways that losses have increased. But they themselves are saying, I was going through their press release, 100 basis points improvement in contribution margin on the quick commerce side, quarter on quarter. So it depends on which number you want to go with. What's your sense?
Definitely. Good morning, Surbhi. Good morning, everyone. So glad to be on the show. I think, yes, if you look at after Eternal's number, Swiggy seems to be catching up both on the food delivery as well as on the quick commerce side. I think one of the key factors that we are looking at is the average order value, AOV, which has been one of the key lagging factor for Swiggy versus Eternal. We are seeing that now it is catching up fast with Blinkit, and it should meaningfully improve the EBITDA margins going forward much faster than what we were earlier expecting. In the food delivery business also, Swiggy continues to gain market share. I think the 10-minute delivery, food delivery that they are offering, that seems to be making a big differentiator. And on the overall capex front, they have said that no new dark stores to be added over the next 6 months. I think that will be also a big factor. Whatever dark stores that have been added in the last 6 months, they will start contributing positively to the EBITDA. So I think overall, the expectation going forward is that the company should achieve the EBITDA break-even by the end of this. So Q3 is what the company is guiding for, and that should be a key factor in driving the valuation. So we remain positive on Swiggy. We believe the improvement ahead of schedule could lead to further upsides. Currently, we have a target price of 450 on Swiggy.
Okay, sounding optimistic on Swiggy. Some of us will be using the services over the weekend as well. That said, Sid, what about Coal India? The volumes were soft, so the street anticipated the numbers will be soft. They're not as soft as anticipated. In fact, on the operational front, it's looking pretty okay. Realizations relatively better and costs down. Employee count itself is down by close to around 3%. Your view on the stock?
Definitely, Nigel. So I think in-line numbers to our expectation, the muted volume was offset by better realization. E-auction volumes accounted for about 11% of total volumes with the e-auction premium of 50%. That supported overall profitability. For the current year and the next financial year, FY27, we are largely expecting volumes to see some improvement, which should boost the performance. E-auction premium is likely to inch up towards 70% going ahead, which should again be positive. Overall, what we are forecasting is an 8% volume CAGR over the next 2 years, which should lead to a 10% revenue CAGR and 14% EBITDA CAGR. So overall, what we are seeing is Coal India is focusing on improving its market share in the domestic cooking, non-cooking coal segment. Management is also focusing on expansion, which should be funded through internal accruals. And as you said, yes, good cash flows, good expansion, and a decent volume growth. Valuations looks comfortable. We remain positive. We have a buy rating and a target price of 480.
Yeah, all right. Coming back to you, Sid, with more. We'll take a quick commercial break here. We'll come back and more stocks in focus. 10 minutes to the pre-open. Welcome back. There's 7 minutes to go for close, and we are counting down to the pre-open session. The GIFT Nifty still indicating 130 odd points lower start. Two names said. One is PNB Housing. I mean, both news related, and we'll address this at 9 o'clock. And the other one is IIFL Finance. A change in management in one, and credit cost guidance being revised higher for the second. Stocks have done well, especially IIFL from the lows. Any thoughts here?
I think if you look at IIFL Finance, there has been a strong growth in the gold loan business. The only concern is that the credit cost guidance has been raised. So that is a big concern. Having said that, the credit costs have been slightly lower than our estimate, but if it were to go up, I think it could have some impact on the earnings going forward. So overall, I think even the management commentary highlighted that they have recalibrated their exposure and gradually exiting the higher riskier segments within the MSMEs and the micro LAP segment to prioritize on the portfolio stability. Within the micro LAP, I think the company is witnessing higher stress, especially in the states of Andhra, smaller cities in Maharashtra. And the good part, again, on the other side, as you said, management change that is factoring in. RBI has given approval to open 10 new branches. So that is, again, a big, from a regulatory perspective, a little bit on the positive side. So I think it's a mixed kind of view coming in there. So certain overall numbers, I would say that is operationally weak quarter. Strong growth in the gold loans is the only positive that we see from the numbers. But I would say within the overall NBFC space, we'll get better stocks where companies which are having higher growth. So remain kind of neutral in IIFL Finance from the near-term perspective.
All right, Sid, do you ride a bike?
Yes.
Yeah, you do. I don't know whether it's a Royal Enfield, but that's the only motorbike that I have ever owned from the time I'm 18 till now. 350, 500, 550, and now the 650. Hopefully they come with a bigger bike. My preference aside, what's your view on the stock? Growth is good. Margins seem to be a little bit soft.
So I have been riding Royal Enfield Standard 350 for last 10-15 years. So it's an old bike.
The thump, yeah.
with a cast iron engine, so that gives the thump. So some of the new bikes, I think I liked some, did not like some, but definitely that has helped the company report a strong volume growth, almost 15% growth. Exports has been a key factor where we have seen 41% growth. Domestic market has been stable, 12% growth. So overall, what we see is that we are expecting a 10% volume CAGR for the Royal Enfield over the next 2 years. And management is now prioritizing growth over margins. So that could keep the margins under pressure from here on. Stock price has moved up. And we believe that with a slower earnings growth, especially coming in from the Royal Enfield space, the stock could remain a bit sideways from here on. Hence, the stock having done well and the growth coming down, we will likely remain neutral on Eicher Motors.
Okay, all right. We'll take a quick break here. We're going to come back in just a bit. Technical trades, Mitesh and Srikanth with us on the other side. Stay tuned.
Okay, those are Friday smiles that we are wearing, though otherwise the cues have been a little somber. We're getting the pre-open rates, and remember, a lot of the Asian markets have been reacting negatively to all the new reciprocal tariff rates. That's the Nifty, and actually it's not that bad. The implied open was a little weaker, but we're getting about a 150-point drop. Actually, no, on my screen it's just a 70-point drop. Maybe we'll refresh it and see how that plays out. Rates will settle in a bit, and then we'll get to more of it. But we have to quickly look at the trades with our technical experts as well. So let's take it back to them. Morning, Mitesh. What are the stocks you're working with today?
Yeah. Good morning. While on the index, we have maintained a range kind of outlook with 24,550 thereabouts as the key support here on the downside and 25,250 on the upside with mid-range pivot at about 24,950. On the stock side, I have a mix of buy and sell calls today. Cipla is a buy if you get it on mild decline, say around 1545, 1540 zones, buy with the stop below 1525 and look for a target of around 1590. Godrej Consumer had a good price and volume up move yesterday. So that's a buy with the stop at 1236. Look for targets of around 1305. Couple of sell calls. Ambuja Cement was a sell yesterday as well. Now can be sold afresh with a stop at 604. Look for targets of 570, and CDSL is a sell with the stop just above 1500 for targets of 1440.
Okay, all right, got that, Mitesh. Shrikant, let me come to you as well. Morning. What are the stock ideas?
Good morning, Subi. Good morning, everyone. As far as Nifty is concerned, I think it is stuck between the range of 24,600 and 24,900. So till the Nifty is not crossing 24,900 decisively, we are going to see range-bound sort of activity, and we need to be more and more stock-specific. But specifically, if we go through with stocks, then in that we like Kaynes Technology. It reversed from its important support levels of 5,600. Also, the stock was sustaining above 50-day simple moving average. Yesterday, we saw solid buying interest. There was good amount of buying attraction because of results. But while looking at its entire pattern, I think Kaynes Technology is heading for the levels of 6,500. We can keep a stop loss at 6,100 for the same. And the other stock on which we are bearish is IndusInd Bank. Currently, it is around 790, 800 sort of levels, but it is falling from the rising wage, which is something negative, and the stock may fall to the levels of 750 or 760 in the near term. So it's a sale at current levels around 790.95 with a target of minimum 770 and maximum could be 760. We can keep a stop loss around 805.
Okay. All right. Got that. Shrikant, thank you very much for the trades. We'll come back to you gentlemen a little later. We just got those numbers in from Bajaj Auto as well, and it continues to look a little subdued. Total sales are up just about 3%, 3.66 lakh units. But if you look at the domestic, and that domestic story, that's what I'm talking about. Domestic sales down 13% year on year. It's been a tough last couple of months for Bajaj Auto when it comes to the domestic sales. Exports have been improving, and that trend seems to be continuing in July. But for the time being, we'll put the spotlight on Niva, Bupa. Remember, Yash was just telling us about the numbers. Companies' net earned premium is up 19%, but losses have increased. The combined ratio has also gone up substantially, almost 117. Let's take this forward, discuss the trends and, of course, the prospects forward with Mr. Krishnan Ramachandran, MD and CEO at Niva Bupa Health. Mr. Ramachandran, thank you for joining in. So the growth seems to be coming in. That doesn't seem to be the problem. But I want to talk about the operational weakness that we've seen in the first quarter, this increase in the combined ratio. Can you just explain what the factors at play were and why we saw such weakness in some of the internal metrics?
Yeah, no, firstly, thank you for having me on your show, Surbhi. Just to explain our results, I think it's very important to explain the results in the context of the right accounting standard. We've been saying that although it's not yet the statutory standard, IFRS is the right way to look at our company. And if you look at our numbers on an IFRS basis, and also importantly on a like-to-like basis, because there was an accounting change middle of last year in October 1, that the insurance regulator announced. But if you looked at our results on a like-to-like basis, our GWP grew 28% for Q1 over last. Our retail GWP, which is a big focus area for us, grew at 32% over prior year. That's number one. In terms of profit, if you look at it on an IFRS basis or an INDAS basis, which is going to be the Indian adaptation of IFRS, our profit almost doubled from 36 crores last year to 70 crores this year. And our combined ratio actually improved from 103.9% to 103.2%. Again, the reason I say IFRS is the right way to look at us is because there's matching of revenues and expenses. On the Indian GAAP side, there is noise because of the change in accounting standard. And, it will actually take about 2 years for that.
Mr. Ramachandran, that IFRS, I completely understand, right? So, for example, what it does is premiums that you collect, it spreads it over the life of the policy, right? That's how you're supposed to account for it. Just to give an example for our viewers. But it's not. I mean, it'll come when it comes, right? And that perhaps is the right way to look at it, and it'll significantly change how all insurance companies report financials. But on the basis of the reporting standards now, sir, if you can sort of provide us with some outline, yes.
Yeah, it impacts companies to varying levels. For a fast-growing company like us, where there is seasonality, acquisition cost in IFRS gets matched to expenses, right? So there is a difference in terms of how it impacts different company financials. And look, at the end of the day, accounting and insurance accounting is fairly complex. So from a consistency and a like-to-like basis, that's why we repeatedly emphasize that IFRS is the right way to look at us. It is the standard globally. We consolidate our accounts with Bupa on an IFRS basis. So, I would urge you to examine our financial results on an IFRS basis, because that's the accurate reflection of our economics.
Could you give us so you can give us both, right? I mean, expectation on the kind of growth that you will see in FY26, sir. So net earned premium grew 20% for you. What can we expect for the full year, 26?
So, in terms of giving in-year expectation, it's a little early in the year, but broadly, over time, our guidance has been that we expect to grow faster than market, maybe between 5 and 10%, depending on the investments that we make during a particular year. But so that guidance broadly stays the same.
All right. Hi, Mr. Ramachandran. Good morning. Good to see you in. Nigel on this side. Your expenses of management, as you said, they've come down a little bit. But, there was, I think, there was talk of it going to around 35%. Do you think that will happen by the end of this fiscal? That's point number one. And combined ratio, I think earlier you were talking about it dipping sub the 100% mark. Is that possible by the end of this year? What would be the guidance on both these two parameters? Please go ahead.
Yeah, no, thank you, Nigel. On expense of management, the permissible limit to us as a standalone company is 35% plus allowances. If you looked at expenses of management, for Q1, for us, it's 36%. So we're not too far from what the regulatory requirement is. And we've been consistently saying the requirement is for us to confirm by this year, and we will do that. So quite comfortable on that front. On combined ratio, again, without providing guidance for this specific year, steady state on an IFRS basis, we believe a combined ratio of about 98% is what we want to target, maybe 3-4 years out.
So for the sake of understanding and reporting, because as of now, you're reporting your numbers in the accounting standard that's applicable as of date. So for the sake of understanding, that combined ratio, which is now above 116%, what can it come down to? We've taken your point on IFRS, but we need to understand, as per current reporting norms, what you report today, how much will it come down by? And also your underwriting losses have doubled. There's also an operational loss. So what happened there? And, will there be improvement in Q2?
So Surbhi, again, I want to emphasize that in terms of the underlying business fundamentals, there has been no shift. Which is, again, it's important that we separate accounting from economics, right? Because accounting, as I said, has introduced noise also because of the shift in the accounting standard. So whether it's incidence rates, whether it's the severity of claims, all of those secular long-term trends are as we have anticipated. And on a combined ratio basis, we will improve, but not in a position to give specific guidance at this point.
Okay. All right. So we'll leave it on that note then for today. Thank you very much for joining in and look forward to more conversations during the course of the year. That's Niva Bupa. Stock in the pre-open is down about 3%. Overall, the market is actually down just 33 points. The Nifty is not bad at all when considering what a lot of the Asian markets have been doing. So not too bad. Very quickly, just going for some final calls before we hit market opening. Mitesh, which stock?
Yeah. I'll go with a sell on Ambuja Cements for targets of 570.
Sorry, which one was that, Mitesh?
Ambuja Cements.
Ambuja. Okay. All right. 594. By the way, if you can quickly, I don't think we have time for that. I wanted to ask one more name, but Mitesh later. Thanks very much for joining us. Let's just focus on HUL and Swiggy once again with Mangalam. Mangalam.
Well, HUL reported numbers yesterday. The stock was doing extremely well. The street believes that worst is behind. Now brokerages have put pen to paper. Goldman Sachs has upgraded the stock to buy, target price of 2,900. Remember, they are saying that the earnings growth is turning around, driven by a combination of both macro as well as internal initiatives that the company has been taking. So revenue growth accelerates in the second half of this year to high single digits and in FY27 as well. Once that happens, even EBITDA improves on account of operating leverage because of the fixed cost that the company has and ad spends which will be maintained. So EPS growth accelerates in double digits over the next couple of years, which implies that, this is a positive and they've upgraded their target price to 2,900. The only risks that we have intuitively, a sharp increase in input costs that may take the margins off. Or the second thing is macros which are now improving. What if they get worse? So those are a couple of points that they put on the table. Swiggy, we've been talking about how, the internals are looking good from the numbers, and Motilal Oswal has gone ahead and written, they've said that Instamart's average order value is now within close distance of Blinkit. That was a concern earlier. Now, if that has happened, which implies that EBITDA margins for them will grow faster than expected, and Swiggy continues to gain market share in food delivery, with the key differentiator being Swiggy Bolt, which is a 10-minute offering that they have. So all these factors means that there could be notable operating leverage in their overall business and quick commerce. So it's a buy for them.
Okay. All right, Mangalam, got it. So Swiggy on our radar, 1% higher. But the stock you really have to look at right now is PNB Housing Finance. Look at it, 11% slam dunk on PNB Housing in the pre-open. Mr. Girish Kausgi has resigned. The market doesn't like that at all. Sudh's here with more details on this one, and I think a couple of other interesting brokerage notes. Sudarshan.
That's the main reason that of MD and CEO Girish Kausgi resigning from the company. Remember, in 2022, he was appointed MD and CEO for 4 years, but now he's resigning after completing 3 years. So that market is taking very negatively. If you take a look at the stock move, today it's opening with a cut of 11%. But since Girish Kausgi had joined, stock had almost increased by more than 300% from lows of 370 in November of 2022. It had gone to as high as 1,200. That's the recent high. Now today, Morgan Stanley has come out with a note. It maintains overweight call, but has cut target to 1,100 from 1,300. It says that MD resignation casts uncertainty on growth plans, and investors may be concerned on way forward, especially in terms of execution that Girish Kausgi had laid out. And it expects a sharp negative stock reaction that you are seeing on the screen. And given the reasonable valuation, it has cut the target price but maintains overweight call. Another stock that will be in focus is IIFL Finance. Yesterday, company after the results had held earnings call, and it has increased credit cost to 3% from 2.5%.
And the stock should be lower, but it's come off quite a bit from the highs already over the last 4 or 5 days. Market opening, a third of a percent lower, 24,768. The Nifty Bank is down about 0.16. Mid-cap index absolutely flat, but there's some green, 30-40 points, but essentially flat. The small cap index will come up on your screen as well, and gives you a quick sense of how we are starting this morning. 24,750 on the Nifty, 55,900 on the Nifty Bank. So this is a very, very muted Friday morning start, but this is just the start. The heat map gives you a sense of how many are up and down on the Nifty 50 at least, and then we'll take it from there in terms of individual names which are making and moving around. So I think it should be kind of sort of no real, it's more down than up, but in a small way, essentially, right? I mean, Sun is on the other one end of the spectrum. Lever is on the other end, as Mangalam just told us 3 or 4 minutes back. So that's the overall picture. 50 points lower on the Nifty. Surabhi.
I'm only going to look at positive things. It's a Friday, Prashant. Look at Chalet Hotels. Forget the Nifty stocks for a second. Look at Chalet. 18% up. What a star, what a performer. The company's top line and revenue, it's grown by 150% in the last quarter gone by. And we'll get perhaps Mangalam back in to explain more to us. Maybe we should just put Chalet on the radar if we can. We'll get to, look at that. Look at that star stock. So even in a tough environment, companies are managing to sort of get investors' attention. Big one over there. In fact, consumption overall is doing pretty good today. HUL is up, Nestle is up. HUL is up 3%. Nestle is up about 1%. Tata Consumer, Eternal, Asian Paints, Trent, even ITC for that matter. There's a little bit of green in all of these stocks, between 0.25% to about 1%. And of course, Lever is taking the cake with a 3% up move. Consumption is the one area which is definitely showing up green. Reliance is very flat. So let's see, if Reliance starts moving higher next couple of hours, it'll be good for the bulls. But on the downside, Sun Pharma, Dr. Reddy's, Cipla, Pharma seems to have an overall overhang. I mean, apart from the earnings, etc. I think this overhang on US tariffs is very clearly showing up. And pharma stocks had a very good last 4-5 weeks. So some of that is coming under pressure, profit-taking. M&M also, profit-taking 1% lower over there. L&T, some of the other big stocks on the way down. Bajaj Finance down about 0.5%. L&T down 0.5%. There's Wipro and Infosys, some of the tech names also on the lower side, but mid-caps are brighter. Mid-cap index showing some green, Nigel.
Well, that's right. Chalet, you mentioned, Chambal Fertilizers, the other one. That's up close to around 6.5%, dancing away, so big up move out there. And HUL, for the last few years, everyone's been saying the stock didn't give any returns. In this month, it's given 10% returns. You had the change at the helm, you had the numbers that came out, and there's optimism that consumption will pick up from here on. Just take a look at that stock, 4.5% higher, and that's the big heavyweight. That's the top gainer on the Nifty this morning. What else is doing well? City Union Bank is up close to 2%, moving on rather large volumes, so keep an eye out on that one. On the flip side, Niva Bupa, we just spoke to the management. That's under some pressure. Wellspun Living, that's down close to 1%, falling on large volumes, so just highlighting that. And Sun Pharma, actually, yesterday the stock ended lower with a cut of close to around 2%. And today, in fact, it's down another 3.5%. So in a couple of trading sessions, the stock has lost close to around 5%, and that's a large name that we're talking about. Other big winners in the broader markets, UFO Movies, that's moving higher. In fact, volumes are at around 2.5 lakh just in the first couple of minutes. So big move out there. And Team Lease as well. We'll have the management later on who'll be joining in. One more stock I wanted to highlight is NMDC, and I think we should get the stock up and, we should get some details out. Sources indicate to us here at CNBC-TV18 that they've gone ahead and they've increased prices by around 400 rupees. Keep in mind, we're in the midst of a monsoon and they've gone ahead and increased pricing, which is encouraging because they had cut prices for 2 consecutive months. That's in June as well as at the start of July. And the total quantum they had cut it was 650 to around 740 rupees or thereabouts. So because of the price increase of around 40 rupees, that's why, in fact, we're seeing the stock outperforming other metal stocks. It's up more than 2%. And keep in mind, it's a monsoon quarter, but global factors are supporting. So that's one factor. The second factor is, I just had to check that the OMC auctions, there was a price increase as well. So NMDC used the opportunity and said, let us as well push through a price increase. Explains why that one is up 2%.
Absolutely. And, just take a look at the index again. So it's that 45, 50 odd point cut. So not really running away in either direction. It's a very, very slow Friday morning start that we've got happening right now. By the way, the top, I'm not sure if this top volume-led losers. Reliance Infra is down about 4%. It's coming up with large volumes at this point in time. What else? Sun, of course, we've been highlighting. Sun is down about 4% as well. 3.5, about 4%. There is Star Health, which is coming up with volumes. Aurobindo, actually, it's Pharma, right? If you had to pick up one kind of trend, it is Pharma, and maybe the Nifty Pharma index will show you it should be down at least 1%. So what have we heard in terms of 1.5% lower on the Nifty Pharma index? Sun, Aurobindo, Dr. Reddy's, Lupin, all these Cipla, they're all down varying degrees. We heard from Commerce Secretary Lutnick earlier today, essentially saying that President Trump is going to come up with those pharma tariffs in the next few weeks. He's going to finalize and declare them. So that's the overhang here. It's been an overhang for a while. With regards to a country like Switzerland, pharma companies based out of Switzerland, If you look at the Swiss index, pharma companies dominate. He sent letters to 17 companies, but that's different. That's not. But it kind of tells you where this is. Perhaps this is going, asking them to lower drug prices when they supply to social security programs like Medicaid, etc. But that's for innovator companies. Here in India, we are talking about generic companies which sell at a much lower cost into the US market, where President Trump is perhaps looking at some tariffs in the coming days and weeks as well. So
Prashant, just wanted to add to that because I was going through a lot of notes on Sun Pharma. So this is not a company-specific thing. If anything, most notes are very optimistic. Plenty of overweight and buy calls on the stock.
Yeah.
But it's just that the extent of their exposure to the US perhaps makes them one of the most vulnerable stocks, in the Indian pharma space. So that's coming off very sharply. Also, the pharma index has been among the best performers in the last several weeks. So it's just quick profit taking and gearing up for what happens.
The thing is, actually, if you remember the conversation with Lupin, Cipla, I remember they gave us numbers, right? The cost of producing a same drug. Forget drug, I mean, I'm talking about like a capsule or whatever, right?
Yeah.
I remember Lupin telling us it's about 8 times in the US as compared to India.
Yeah.
So the real impact may be very, very little, even if there is a 10% tariff which is imposed on goods exported, because the
you still have
difference
to import.
is so large.
Yeah.
But it's not a good feeling, right? I mean, it just puts uncertainty in the air in terms of what really can happen. And that's essentially what's playing up as far as these stocks are concerned. We have Sandeep Bhatia now is joining us, Managing Director and Head of Equity India at Macquarie Capital. Sandeep, good to have you with us here. Thanks very much. Let's just start with that pharma question. And then maybe we can pedal back and talk about the bigger 25% plus penalty question as well. But pharma, your sense, Sandeep?
Good morning, everyone. I think pharma raises multiple issues. One is the immediate issue of whether Sun Pharma and some other innovator drug companies will get notices like what the Swiss and the other multinational companies have received from the Trump administration. In the last quarterly conference call, my analyst says that Sun Pharma derives around 20% of its revenues from innovative drugs. Sold in the US, said that they had not received any such communication. But this is anyway, with the Trump administration, everything is work in progress. Everything can change. Even when things are moving in a certain direction, they can move suddenly in the other direction. So that's where we are. So right now, there's a fear that this most favored nation treatment for Medicaid and other US administered medical programs, the pricing of that should match the pricing which the companies charge in other wealthy developed nations. So clearly, there's potentially a pricing pressure that can emerge for the US supplies. So that's where the worry is from. We need further clarity to make a real judgment on whether this is what it is, or whether even I would say that many things can be mitigated by lobbying. And whether, because this is a very industry-wide issue, as correctly pointed out by you, whether this will be lobbied away.
Sorry, that's an interesting point, because so far we are looking at US generics into the US, but you're saying the thing to look at, the metric to look at is exposure to innovator companies, right?
Yeah, so innovative, as far as India is concerned, right?
Yeah, absolutely. So Sun, your analyst is saying Sun's exposure to innovator companies like Pfizer, Merck, Eli Lilly, etc. is about 20%.
Innovative drugs. So that's what I'm saying.
It's about 20%.
Yeah.
So that is the number we need to pull out, and we'll do that and put that up as well, because that is the new part. These letters to innovator companies to reduce what they charge US consumers, and in turn, if these sort of innovator companies pressure their suppliers, right, like Indian Generic and others around the world as well. Surbhi.
Okay, so pharma definitely a watch point for sure. Sandeep, hi, good morning.
But remember, everything can be lobbied in this administration.
Yeah, everything can be lobbied.
Lobbying, negotiation, pressure. We've almost run out of adjectives to describe this on a daily basis. But Sandeep, morning, the rest of it also doesn't give a very happy feeling, right? And the market's been reflecting that. That's why the slow grind all through July, because anyway, those global tariff headlines are not very supportive in terms of India sentiment. And then you have our own earnings issue. What is your read-through of Q1? I mean, there's no single sector which can really spark off, anyone's imagination. It's not there in IT. FMCG maybe. I mean, people are now hoping that, look at Lever today, for example, this morning. So tell us if you think FMCG can be that safe haven that the market is desperately looking for.
FMCG can be a safe haven is a strong word. I think we need at least 6 months at the very least. I would think 12 months of strong volume growth, which comes to at least 6 to 7%, at least in the line of GDP growth. We are not there. Hopefully, we can get there by the October-December quarter. So that's where it is. I think the real challenge is at multiple levels. If you look at it, the market has continued to re-rate, and that's been the primary driver of the market strength, which is just the PE multiple expansion. On the other side, I would think that the retail participation is a good thing, but we know for a fact that fundamentally stock prices should track earnings, and we have seen earnings lag. So would I mind if there's a sideways or even a correction of 10%? I would absolutely don't mind that. A correction is actually welcome.
But that's my question. That's precisely the question that I wanted to ask, Sandeep. That as you see it from your vantage point, the next 6 months, are you looking at a time correction, which perhaps is not that bad then, or that price correction, like you said, 10% downside?
I would be in the camp of a time correction, just for the technical reason which I was just elaborating, which is the strong retail flows. A price correction is actually more welcome than a time correction because you get done with the pain very quickly. A time correction can be 6 months or even more than a year, and that's actually more painful for the market. A quick and sharp 10-15% correction is what is better from a market perspective. That depends on whether we see any big incremental bad news. I think the tariff news which came out yesterday is not actually that kind of a trigger for the market to correct 10 to 15%. So we'll wait and see if there are more bad news coming out which can correct the market.
All right. So the low of the year at least will get protected, that 21,700 that we saw earlier.
Sorry, I didn't hear this. Your voice was very, very faint.
The low that we saw, Sandeep, earlier this year was around 21,700. So even though the earnings haven't been very, very great, a lot of...
I'm still not hearing that. Someone else can repeat that question, please, because the other two anchors do better.
Yeah. So Sandeep, Nigel's basically saying that we're just trying to, clutch on to all optimism here. Since you're saying the likelihood of a time correction is more than a price correction, so at least the lows of the year should be protected.
I would think so, but I would actually recommend a price correction. Is the sentiment I'm expressing, that a quick price correction would be more welcome than a
better. Okay.
Yeah, but I take your point. I mean, but we have to see, Sandeep, the flows also, and I track that data on a monthly basis. And thankfully, those SIPs are very steady, but overall flows have halved from 40,000 crores. Now we're tracking, 26,000 crores on a monthly basis. But in this kind of an environment, okay, then in this new normal, which would be the sectors where you would park if anyone has additional money, if anyone's looking at, deploying, where should the money go?
I think I would look for a couple of triggers in the market. I would want to see where we are in terms of the US Fed rate cut cycle. I would definitely think that we would see one rate cut coming through from the US this year, probably around the big shopping period there, which is the October-November Thanksgiving period, pre-Christmas. That actually means that we could also see a rate cut. That's not something which everyone talks about, but I would think the likelihood of another 25 bips rate cut post-Diwali for India is increasing, especially if the US cuts rates. So in that sentiment, I would think autos look interesting. We will definitely see consumption impetus in the October-December period. That's the base case that everyone's working on. But the larger high-value autos could see, therefore, improvement if there's one more rate cut. We have seen a 100 basis point rate cut till now, and we could see another for the year, and we could see another 25 basis point, which would be good for consumption, especially for large ticket items like autos.
All right, Sandeep, I hope I'm audible now.
Yeah,
what about the hotel space? The last time around we had a chat that, that's a sector that still looks good. Now, some of those numbers in the first quarter have been a little bit soft, but as we heard Mr. Puneet Chhatwal, he was saying that actually this year is going to shape up extremely well, and there was a lot of confidence in his tone as well. Do you think that's still a sector that you would look to get into?
Yes, I think autos is the quasi-consumption kind of story, FMCG, which we were discussing at the beginning of our conversation, but it's a faster growing and more stable. The last quarter was anyway expectedly weak with all the negative outcomes on air travel, crashes, and so on, and the war. But this festival season, again, high ticket consumption like autos and travel could definitely see impetus come the fourth quarter, and hotels therefore would be a big beneficiary.
Okay. And so hotels and hospitality continues to be a space that Macquarie likes. So remember that. We'll keep that on board. Thanks for joining in, Sandeep. Good conversation. You have a good weekend, and we look forward to connecting again soon. Well, that's a view from Macquarie coming through. Let's just check the market again. There's some more pressure now. 75 points lower. The Nifty is just below the 24,700 mark. So let's see how this progresses early in the morning right now. Let's quickly move on to lots and lots of earnings that have come in post-market hours yesterday. And of course, Thermax is one of the companies on our radar. For the first quarter, the company's revenues actually declined. Not too much of a decline, 2% drop, but it's the first decline in several quarters. However, there's tremendous margin improvement that the company has exhibited. So let's discuss the trends with Ashish Bhandari, Managing Director and CEO at Thermax. Ashish, great to have you back on. And we'll start right there. So the margin improvement is looking very good. You're in double-digit margins. But let's first understand what happened with the top line and where the drag came in. I'm just looking at the, the split as well in terms of the specific sectors that saw some pressure. Industrial products and chemicals, they were up in the previous quarters, but they're subdued now. So just take us through what's happening with the revenue.
Okay. No major red flags. That's the top line story. We have a decent backlog. We just need to work that backlog through the system. In Q4, we had a reasonably big, more than 3,000 crores of revenue. So we started this particular year with deliveries that we were relatively short of delivering, that we had to deliver in Q1. But we also had several customers because of the early onset of rains, where many of our equipment that goes to project sites and all, where projects were running late. So I would say in our math, about 250 to 300 crores worth of orders that we would have liked to ship in Q1, where we were ready with equipment, customers did not pick up. Don't see anything particularly of concern. Most of that got cleared in the first couple of weeks of Q2. Some amount of delays even in Q2 on project side. I think weather's a big pattern overall right now, but nothing to be concerned of. We are building a decent backlog. I expect a good Q2 and a Q3 on the orders front as well. And as we work that through the system, we will increase the revenues as well.
Can you give us some sense, Ashish, on how the year could be? I mean, would it be fair to expect at least double-digit growth? I'm still talking top line, by the way, because you also have exposure to exports, and there's just too much going on with the export markets. So just give us some more color on the revenue. Will it be double-digit growth, and how will the exports business be?
At least we are planning for good growth on both fronts. Some of the events of the last couple of days notwithstanding. And our revenues will follow from our orders. We need to make sure we continue to grow our orders, but our backlog is close to double digit. We just need the book and bill portion also to grow reasonably well, which is what we plan to be able to deliver double digit growth this year. At least that's what we are planning for. On the exports front, if you take a look, the first 2 years post-COVID were largely driven by India growth. India growth was much faster than our exports. In the last 1 year, international growth has started to go up as well. And as we enter this year, we are starting with our biggest pipeline for export projects. That includes Middle East, includes Africa, includes Southeast Asia. To the US specifically, our exposure is through our chemicals business and portions of our cooling business. Those are the two businesses. And in our chemicals business, about 20% of our top line comes from the US. That business will go through some amount of uncertainty in the short term. We hope that uncertainty is short-lived as well.
Okay, all right. Hi, Ashish. Good morning. Good to see you in. Well, last year you said it was a year of planting seeds, and now it seems that, the street will be hoping that fruit is what you'll be bearing in the next few years or so. That said, one positive in the numbers was gross margins going back to around 50%, and the EBITDA margins back in double digits, 10.5% or thereabouts. Could you tell us any kind of those one-offs, those problem pockets that we saw in the previous quarters? Are they all behind us? And will the margin trajectory gradually improve from here on?
I think the second part is right. The margin trajectory will gradually improve. We have a couple of areas where we have bad projects in low profitability projects. FGD, a good example of such projects. And in our view, there is about a 1.2% improvement in margins compared to Q1 of last year. That's driven almost entirely by having fewer things that went bad. Yeah, so last year was a tough one in that sense. This year, we would like to continue to show improved margins. We have got some bad projects to work through still. Most of those should get cleared. Yeah, so this year I expect it to be better than last year, but everything that we have been getting in the last 18 months has been things that we like. So our backlog that is building up is of reasonably profitable projects, nothing that is government, large, high civil and construction related stuff where previously we haven't done that well.
So the exit rate of your margins could be, close to around 50, 100 basis points higher than what you have done, in the past quarter?
Let's see how the year goes, but at least that's the work and that's the effort. Yeah.
Ashish, I just want to clarify in terms of exports, what is your total exposure to the US? As a percentage of total exports, how much is going to the US?
I'll say what the US number is. The US number is about $40 million a year. Yeah, which is very small. It's less than 5% of our total numbers. Chemicals is the big portion, and the second biggest is chillers that we sell to the US.
Okay, but that's helpful to know that overall it's just 5% of your total revenue, right?
Yes.
Total revenue, less than 5%.
Less than 5%, so it's not much of a, there's no need to...
Not much, but there's a secondary impact. We've got many customers in India, especially customers in textiles, pharma, that were expanding quite a bit. Yeah, and those are, if you think about, those are some of the sectors that are investing quite a bit. And as they go through some amount of uncertainty, I expect there would be some. But for Thermax, the news direct connect is relatively smaller. We just have to wait through the next couple of weeks and see how this plays out.
No, but thanks for that important call out that a second order effect could come in via textiles. What's your exposure? I don't know if you have it by industry, but roughly speaking, your exposure to textile players?
We are all 6 to 7%. Pharma would be similar, 6 to 7%. That kind of outlook. But good, most of that, their work is also domestic. Yeah, it's not all driven by exports. So I would say overall for India, I mean, given we export close to $150 billion to the US, there will be an impact. I do hope saner minds will play out and we will find a resolution that works for everyone.
Ashish, always a pleasure having you on the show. Thanks a lot for joining in. You're sounding optimistic about the coming few quarters. Yeah. We look forward to having a chat with you and hopefully things improve on the ground because you're a bit of a barometer with regard to whether or not the economy is recovering or not. Thanks a lot for joining in. Let's focus on JSW Energy then. They posted a steady performance in Q1, healthy growth in profit. That was aided by scale-up in thermal as well as renewable segment. Mr. Sharad Mahindra, the joint MD and CEO of the company, joins us on the show. Hi, sir. Good morning. Thanks a lot for joining in. Well, congratulations. Pretty steady quarters, what you reported. Can you tell us about the contribution of Mahanadi and how will it scale up from here on?
This Mahanadi, KSK Mahanadi and O2 have played a really important role in our Q1 performance, which we feel is one of the highest performances what we have delivered But at the same time, we have to remember that apart from KSK and O2, there are two more factors which have contributed to this performance in terms of generation, in terms of margins, is our wind capacity which got commissioned last year was mostly in the second half of the year, post the peak wind season. So this time that capacity being available in the peak wind season, which normally starts maybe around May and continues up to September and part of October, has also played a significant role in the generation growth, wherein our RE generation has grown by 54%, driven by this organic capacity which we had commissioned last fiscal, and also the O2 acquisition. Apart from that, this our Ind Bharat Utkal, JSW Utkal plant of Odisha, wherein our second unit of 350 megawatt got commissioned in March 25, has also contributed significantly in terms of energy generation and the EBITDA in the quarter one.
All right. Well, sir, how did merchant rates pan out, especially in a soft demand year? How much is open capacity as of now?
Yeah, coming first, starting with the demand, of course, the demand growth we have seen has witnessed a negative 1.5% growth over last year. But last year, we have to remember that there was a very high growth of 11%. So on a high base, there has been a negative growth, one on the high base. And also, we have to understand that this time, early onset of monsoons also has resulted. So these two factors have driven a negative demand growth, but we feel that this is very temporary. Fundamentals of the country in terms of the demand, in terms of the growth drivers continue to remain strong. In our case, when we started the quarter one, it was the open capacity was almost close to about 1.3 gigawatt. As we are talking now, the open capacity is only 900 megawatt, and out of which only about 100 megawatt, 10% approximately, less than 100 megawatt is on imported coal based. Our Vijayanagar plant, full capacity of 860 megawatt is now tied up under long-term power purchase agreement and has shown a significant increase in the generation as compared to last year. Out of our balance 800 megawatt of open power, which is based in JSW Utkal plant in Odisha and the KSK Mahanadi plant. We have to recall that both these plants are in the coal belt. The fuel cost is extremely low. This gives us a big advantage because of the low cost of generation to sell in the merchant market. Lastly, what you asked about the tariffs, merchant tariffs during this quarter have averaged in the exchange at 4 rupees 41 paisa. But I'm happy to tell that we have been able to sell our entire untied capacity, which I just mentioned, at an average price of 6 rupees 14 paisa through bilateral and medium-term contracts.
Okay. So, Mr. Mahendra, putting it all together, I mean, you've got 3 new units on stream and that O2 platform. Can you give us some sense or a guidance for fixed EBITDA growth for the current year, FY26?
See, in terms of KSK Mahanadi, we have already demonstrated the performance with 857 crores of EBITDA in quarter one. And we all know that last year, the KSK Mahanadi, the operating EBITDA was about 2,400 crores when we were not there. We only came on 9th or 10th of March last year. So we are absolutely certain that seeing the quarter one performance and the efficiency improvements which we had started immediately after the acquisition in the month of March, some of them have already been implemented, some have been partly implemented, and balance will be implemented during the balance part of the year. We are quite confident that this benchmark EBITDA of last year, operating EBITDA of 2,400 crores, will be definitely significantly higher than that. And that will remain higher on a sustainable basis going forward, or maybe next few years. So in terms of the EBITDA, as I said, quarter one performance has already given us an idea. Maybe it can be checked upon. We normally are not in a position to give the numbers for going forward. No one knows. But we are absolutely certain that with the sustainable operations, sustainable EBITDA, entire capacity tied up, barring this 90 megawatt of untied capacity. We are certain that we'll be consistent and will be demonstrating what we have demonstrated in Q1.
Okay, well, Mr. Mahendra, what is the capex required for reaching the 2030 target? If you can wrap it up with this, what are the internal tweaks between earlier and right now? How will you fund this capex program as well?
As we had said earlier, when it was earlier before our announcement of Strategy 3.0, we had said that 20 gigawatt by 2030. Then we realized with the order books, the PPA signed, work under construction, we had revised that to our capacity targets to 30 gigawatt by 2030 and 40 gigawatt hour of energy storage by 2030. And we are absolutely on track. As we have said immediately after the acquisition of O2 Power with 1.3 gigawatt of operational portfolio which we acquired, and we reached about 12 gigawatt of capacity, that will be adding another 3 to 4 gigawatt in the current fiscal over and above that 12. And going forward, the PPAs which we have to deliver maybe in next 2 to 3 years time, which is total 10 gigawatt, we are certain that we will be achieving. So we are absolutely certain of reaching 30 gigawatt of capacity, operating capacity by 2030 and 40 gigawatt hour of storage. As capex, we have given the guidance for this 30 gigawatt by 2030 and 40 gigawatt hour storage. The total capex we envisage will be almost 1,30,000 crores during this period up to 2030.
Okay, we'll take a quick commercial break. Thank you very much, Mr. Mahendra, for joining us and running us through all those updates. We come back with Arul Selvan, Managing Director of Cholamandalam Finance, Investment and Finance, to talk about their first quarter numbers. Welcome back. Just a quick look at the market. We're down about 60 points. 24,710 is where we are at right now, about 0.25% lower. Let's just look at the Nifty Pharma index, because that is essentially where the big pressure has been coming from all morning. And we've been trading for about 40-50 minutes or so. DRL, Cipla, some 2% of the Nifty Pharma index. You know, there is an issue with regards to news flow, which is impacting something new, which is impacting at the margin. Let's talk about the first quarter performance from Chola now, and we have the company's president and chief financial officer, Arul Selvan, who is now with us as always. Mr. Selvan, good morning. Great to have you with us here on CNBC-TV18. So two questions, and I think you know what's coming. One is growth seems to have slowed a little bit. Maybe you did point this out, call this out earlier. So on a quarter-on-quarter basis, disbursements are a little lower. So one, if you can guide us towards what kind of growth and disbursement you will see for the year. And second is there is some asset quality deterioration across segments as well, across most segments actually. So I think some guidance on that will also help. Go on, sir.
Sure. First on the growth, so the growth has been impacted on two counts. One on the consumer and small enterprise loans, where we had consciously reduced our exposures to the fintech partnerships. We have spoken about it. We started reducing it from Q4 and continue to completely exit this in Q1 this year. So that has had an impact on the overall growth, because that by itself was a 40% disbursement drop compared to previous year first quarter, where this was going full steam on all the partnerships we were having at that point in time. The second area is where in SME we have consciously reduced growth in certain parts of the SME segment, which is the supply chain finance and the loan against shares, because these are not adding ROTA to the bottom line of the company. So we have consciously slowed down on these two segments because this is not turning out to be a better ROTA product. But for this, the LAP has grown. Actually, VF has grown around 7%, which is better than the industry growth by itself. Industry by itself is muted in VF. And this is a general phenomenon that happens in Q1 of any year. And so we are not really unduly perturbed about this particular slowdown. We will see that it will catch up. As you know, we consciously focus on AUM growth, and we still stick to our stance on the AUM growth, that it will be in the range of around 20 to 23% for the full year also, which is what we have already clocked in Q1 now.
Okay, so 20 to 23%.
Just to follow up. So you're saying growth has come off because of specific issues at fintech also. So I had two or three questions. One is on the fintech side. I mean, I think this happened 3 quarters back, right? You're kind of slowed down consciously.
Started slowing down 3 quarters back, progressively exiting one after another of the fintechs. And in Q4, we exited completely end of Q4. So in Q1, we had 0 disbursements through the fintech.
Okay, so it's completely now come to 0 then, right? I mean, and that's
on
essentially...
the fintech part, which is 25% of the CSL book. The traditional book continues to grow.
Okay, fair enough. And the other question was asset quality deterioration, sir, across the board. So what's the guidance there?
So in every Q1, you would see the comparative to Q4 asset quality will come off. If you see last year, it was even more pronounced, change over Q4 of the previous year, FY24 versus Q1 of FY25. But this year we actually hinted that while the Q4 benefit was not that much, we also hinted that the movement from Q4 to Q1 would not be that high. Last year it was more than almost like 100 basis points. This year it's around 30 basis points, 50 basis points if you compare Q4 versus Q1, and 30 basis points if you compare Q1 versus Q1. Yes, there is a little bit of a higher stress. This is primarily arising out of 2-3 reasons. The early onset of monsoon had pushed the vehicle finance NCL to be slightly on the higher side, because the the vehicle operators were not able to operate. The open cast mines are flooded, and that has also resulted in certain segments of the construction equipment borrowers not able to earn, through this particular Q1. As you know, most of our customers are earn and pay type of customers. They are not fleet operators with large pockets. So that is where you will have this sort of immediate reflection of something happening in the economy or something happening in the environment impacting them, but they also quickly bounce back. We expect them to come back with the better.
Mr. Selvan, one of your competitors called out a broad-based issue, a slightly broader issue, and that, of course, I'm sure you've seen it. You're not seeing that, sir? A generalized kind of stress across segments?
No, we are not seeing that. For us, if we see our only expectation is to have a decent monsoon, which gets completed by at least by the early September. Unlike last year where it got extended to November, if that happens, yes, the stress will continue into Q2 and a bit in Q3. But if the monsoon, because it has come in early, and the prediction so far is that we will have a decent monsoon and it should also end in Q2. If this happens, they bounce back and the customers.
So can you give us some numerical sort of range to understand this? Because the rise in credit costs was in the first quarter was more than what the market had in mind, 50 bips. And you've explained why monsoon seems to be one big trigger. Now, where will your credit cost be as things stand? If things normalize, there's Q3, Q4 as well, no monsoon issues over there. Where will you end the year with respect to your credit costs and also the GNPs? Now, provisions also have gone up in the first quarter. So clearly you see something ahead. So just give us some guidance on, gross NPA levels by the end of the year, credit costs by end of the year, and whether you'll need to take higher provisions in Q2 as well.
All of them are interrelated. So the moment the gross NPAs should be similar to what we are closing this year, closed last year, that is around the 3% number. And we expect the credit cost should be in the range of around 1.5%, 1.4 to 1.5% when we close the full year.
Okay, credit cost of 1.4 to 1.5% full year.
Yes.
Okay, so that your shareholders will be happy to hear, because that means it will come down from where it is at the start of Q1.
Come down. So the seasonal fintech exit has created a certain amount of larger credit costs on that segment, which will come off by the time we close the year.
Got it.
We'll see that in one more quarter and slowing down in the subsequent quarters. So that would.
Yeah, no, that's great to understand, sir, because from what you're describing, this looks like a seasonal issue and not a wider structural economic issue that will last through the year. Got that point. Just a quick word on margins as well, because in the first quarter, we've seen, I think, about a 20 basis points compression. What do you expect for the rest of the year as the cycle continues and maybe we get another rate cut from the RBI? Margin expectations for full year?
See, as I spoke earlier, the rate cut benefit has not come through in our numbers in Q1. You will see that rate cut benefit coming through from Q2 onwards, because there is a lag effect of the pass-through happening by the banks as well, even on the EBLR, because that was only the larger cut came in at the fag end of the Q1. So you'll see that benefit coming through. To some extent, on the floating rate book, we may have to pass it off, but on the still, we will benefit on the larger fixed rate book. So we will see that coming through. So overall, around 15 to 20 basis points improvement on cost of funds will be clearly visible when we close this year, and that should flow through to the NIM. OPEX should be held at 3%, and if we cut down the NCL to the 1.5% from where we are today, we expect the PBT ROTA should be in the range of around 3.4 to 3.3%.
Thanks a lot, sir, for joining in. We look forward to having a chat with you, wishing you a good day ahead and all the best. Hopefully, things look up for you as well as the industry. The next management on our show is Amber. Well, the numbers look quite good, but to detail the past quarter and explain why was it so good, we have Jasbir Singh, the Executive Chairman, CEO and whole-time Director at Amber Enterprises that joins in. Hi, Mr. Singh. Good morning. Thanks a lot for joining in. Well, the growth in the RAC business was very, very strong, but in a weak demand environment. So explain it to us. How was this possible? Was it pre-lag manufacturing? If yes, then Q2 in all probability could be a washout. Explain that to us.
Well, the good performance in the Q1 has been a function of a couple of points. First of all is our component business, which has paid dividends, which we have been working on from last four years. Then the commercial air conditioner segment, which we added about 2 years back, that is also gaining traction. And then the mix of the gas charging companies, which we were doing gas charging for, that has been converted into full ODM products now. And of course, the non-room AC components, which we have added last year. So all these four points are actually adding us to deliver a good result in Q1. As far as Q2 and Q3 are concerned, normally these are bleak quarters for the AC industry, and I think we will move in tandem with the industry. But we have guided, and I don't mind repeating it again, that we are very confident of outnumbering the industry growth by 10 to 12% by the year end.
Okay, all right. And in terms of volumes, you want to give us a number? RAC volumes, last year what was it? This year what will it be?
It's actually very unpredictable because we have comprehensive solutions which we deliver. We deliver components as well as finished goods. We don't control the demand side from the customer, so we give a complete package as in the form which they want. So it's very difficult to predict the volumes.
Okay, all right. Mr. Singh, you know what looked up as well as the electronics vertical? It looked very, very strong. You're doing ballpark, what, 770 crores in the first quarter itself. And you've given a target of around $1 billion of revenues from electronics in the next 3 years, with margins scaling that 11 to 12.5% range. Could you help us out with, maybe in the next few quarters, you get to around the $500 million target on a run rate basis, on a quarterly basis? Will the exit rate for this year actually be in that vicinity or a little bit more?
So actually, if you see the journey of our electronics sector, we started electronics vertical in 2018 by picking up 70% stake in Indegene Electronics. It was at that time a 300 crore company with 2.8% EBITDA. After 2-3 years, we started adding different applications in the industrial part on the electronic side. First of all, we added the hearable wearable in 2022. Then we added automobile sector. Then we added some customers in smart meters. Now we've added a small customer in the defense sector. So industrials, defense, aerospace, and the medical was missing. The two acquisitions which we have recently done, Power One as well as Unitronics, has added the industrial vertical. And with all these add-ups, we are confident that achieving $1 billion number by 3 years, next 3 financial years, is very much possible. And that's why we guided the market about this number. And I believe as a India, we are consuming a lot of electronics, and the content of electronics in every sphere has also increased. Just to give an example of air conditioner, earlier we were using about 400 rupees of PCB in an air conditioner. Now it is about 2,500 rupees. So that's where we are confident of delivering that number.
So FY28, Mr. Singh, good morning. FY28 $1 billion, right? From this business.
FY29. Next
29.
3 years after, FY29.
Okay, so 27, 27, right. 28, 29. By 29, $1 billion in revenues.
Yeah.
And with regards to electronics, you've entered into, you ran us through all the segments. You are where you need to be, or will you continue to sort of enter newer verticals there as well within electronics?
So within electronics, one thing we did in 2024 was we acquired Ascent Circuits, which is into bare PCB board. Now, bare PCB, why we did it was because we wanted to give a comprehensive solution in terms of the components of PCB applications and the complete electronics as a whole. So that was our first step to backward integrate into component sector. And that is one business in which there is a big TAM. Today, out of $4 billion of PCB getting consumed in the country, only 10% is getting manufactured. So that is the first addition we have done. Second addition we have done is Power Electronics, which is Power One company. They manufacture battery energy storage systems. They do UPS and they do solar inverters. So that space itself is growing pretty well at a CAGR of about 20%, 25%. And the third one is Unitronics, which is into industry automation, 4.0 products, which is programmable logical controllers and also the human-machine interface and also the drives. So this whole sector, we have added the TAM of almost about all three products, PCB, power electronics, and the HMI PLC. This is a TAM of almost about $12 billion. And I think we will continue to add some more products in the defense and aerospace by organic and inorganic way.
Okay. $12 billion from these three segments in electronics, right?
That's right.
And this is the India TAM?
This is India TAM.
Yeah.
See, India as a whole...
And your focus in all three is India?
Yeah. So India as a whole, 8 years back, India was consuming $32 billion of electronics. In 24, it consumed 115. In 25, it consumed 130. Business as usual, it should touch about 300 billion electronics getting consumed in the country by FY30. So we are taking care, we are building blocks carefully and gradually.
And the margins, Mr. Singh, will that 11.5%, as you continue to backward integrate, and we've heard from some of your other peers we speak to as well, that as you backward integrate, margins get a lift. So so that 11 to 11.5 FY29, you'll exit 29 with $1 billion and 11.5% margins, or it could be higher.
That's right. I mean, as of now, the building blocks which we have done, it looks possible 11.5% with $1 billion by FY29. And if we continue to add some more applications which are at a higher margin range, then of course it can go further up.
Okay.
Okay. All right. We'll leave it on that note, sir. Thank you very much for joining in. Good to get perspective on the business, and we wish you good luck for the rest of the year. That's Amber. Stocks showing up in green, and they've had a good quarter gone by. By the way, check the market out and check Mahindra & Mahindra. Again, solid numbers coming through, 20% rise in their PV sales. And the stock is recovering from the lows, from the lowest point, though it's still, of course, slightly down. Another stock that's down and down quite a bit is PNB Housing. Let's bring Sudarshan back in. It's this sudden resignation of Mr. Kausgi that has taken the market by surprise. Sudarshan, tell us more.
So after today's fall of around 15%, stock is now down more than 30% in last 2 weeks. And today's fall is mainly on the back of sudden resignation of MD and CEO, that is Girish Kausgi. Remember, in 2022, when he was appointed MD and CEO, his term was for 4 years. But now, after 3 years, so basically his resignation effective date would be October 28, 2025. So basically, he'll be resigning after completing 3 years. Now, if you take a look at the stock move out, once he had joined or once he was appointed MD and CEO, that time stock price used to be around 370 rupees, and from that level it had moved as high as 1200, so it's up almost 320% from that level. So it shows you, and he had some aggressive growth target going forward also for FY26, but now his sudden resignation has come as a shock for the market. And after that, MS has come out with a note. It has maintained overweight call, but has cut target price to 1100 from 1300 per share. It says MD resignation casts uncertainty on growth plans, and also investors may be concerned on way forward, basically in terms of execution. And MS expects that it may have a negative reaction on the stock that already you are seeing on the screen, down almost 15%, but it has maintained overweight call mainly because of the reasonable valuation. But overall, it's negative for the stock.
No, absolutely. So thanks very much for that. Very useful. We'll take a quick break, Mitesh, on the other side with some trades. Stay tuned.
better.
Welcome back. As promised, Mitesh is with us with what he'd wanted to do in terms of specific trades. Markets bounced, by the way, off the lows. Mitesh, take it away.
So, the market still is showing signs of mostly, contracting kind of an activity. The buying which happened, yesterday didn't see follow through. The selling today morning didn't see follow through. So it's a market which is not giving you directional bias. So trade with stock specific biases. I have a sell on Tata Power. If it breaks today's low, so 391 is the low. I think if it starts trading below that, there's a pivot around the 391, 392 zone. If it starts breaking below that, sell with a stop at 397. Look for a target of 380 to begin with, maybe even lower. And Power Grid is another one on the sell side trade. Keep a stop just above levels of 292.5. Look for targets of 275.
Okay, all right, got it. Mitesh, thank you very much for that. Well, with that, let's quickly shift focus to commodities as well and see what's happening over there. Manisha, tell us what's on your radar.
Well, I'm looking at copper. While almost all commodities or major commodities have seen a decline, but copper clearly continues to get pounded on the lower side. We've seen 6% of a decline in the overnight markets, and this is after 18% of a crash that we saw on 30th of July, the biggest intraday decline that we've seen since 1988. That is exactly when the market started to keep sense or record of prices. So this is the biggest intraday decline that we've seen come in for copper on 30th of July. So with this, when you look at the overall prices, on the week, we are down by 24% for copper. In last 1 month, it's turned into negative by 15%. For the year until now, we still are into the positive of around 10 to 11% there. But this is all happening after US has excluded refined copper imports from that 50% tariff that gets implemented from today onwards. Well, copper did hit record highs of 5.9. This was until the market did not know what the clarity was and what kind of copper imports would be allowed or excluded. So the markets continued to buy into the US, and we saw all-time highs at 5.9. Currently, with all that profit taking and the premiums absolutely vanishing, we are down to 4.3. Also weighing onto the markets is the China factory activity that shrunk to 49.5. Expectation was 50.2. Last month was 50.4. So in all senses, we saw a weaker number coming in there, also weighing on many of those industrial metal prices there. Interestingly, when you look at the stockpiles in the international markets as well, that is clearly messed up, as you would say. When you look at the COMEX markets, ahead of this 1st August implementation of 50% tariff, you saw a lot of excess inventory coming into the US markets there. So when you look at the overall inventories in US right now, they are at a 21-year highs. Take a look at the overall supplies as well. In COMEX, we've seen supplies go up by 170% to the tune of 253,000 tons there. In the LME, in the meanwhile, you've seen supplies get declined by 50% in the year till time. And markets do believe that with the kind of excess that US has right now, you will see that supplies going or flowing back into the London markets. So the next couple of months perhaps is exactly what we will be looking at, that balance being recreated when it comes to copper availability across the world. Interestingly, what the White House continues to tell us is that, and this is as per the paper released, that they have not ruled out future tariffs, especially when it comes to refined copper. So that tells you or doesn't tell you much there. But the Commerce Department has recommended a phased universal duty on refined copper. This could come into the tune of around 15% in 2027 and nearly 30% in 2028. But whether or not this is going to happen or not will be only known by the month of June or July in 2026. That is when the next review for copper imports is going to be happening. So clearly, it's not over yet. We have tariffs in place today, but this could change anytime.
Okay, all right, Manisha, thank you very much. Very helpful primer as far as where tariffs on copper really stand at this point. Time for a break. We're back. It's our segment, The Economy, Latha in Conversation on the state of the global and Indian economy post-tariffs with Khaitan Eicher of Morgan Stanley. Coming up.
Welcome back. Asian markets are somewhat sulking after the announcement of the final tariffs for most nations. India, which has suffered a worse shock of 25% after hopes of around 15% tariff, is actually holding up in terms of at least stock market performance, especially in the last half hour. There are still many moving pieces. The rate on China is still under negotiation. India faces a threat of possible additional penalties sometime soon. But some of the dust has settled. So how are the current rates likely to impact global growth, Asian growth, and hence India's growth? I have with me Khaitan Ahya, the chief Asia economist at Morgan Stanley. Good morning, Khaitan. Thank you very much for joining me on what must be a busy morning for you. What are you all marking down, either global growth or Asian growth, after we now know the final tariff numbers?
Well, not really, Lata. I think we were all expecting that tariff numbers will be high. The last round that we had seen was a minimum of 15% for most of the large Asian economies, and then some of them had 19 and 20. So in that context, the development overnight is not really a big news that we need to change our numbers. Remember that in India's context, we have always mentioned that the framework to look at would be to see who is more exposed to global trade, i.e. goods trade. And we therefore had India getting impacted the least across the region. And that framework still is intact pretty much, Lata. So it's not the direct effect of tariff as much as the indirect effect. And the indirect effect is basically that global capex and global trade would slow. And in that context, India is sort of least exposed, and that remains the case.
Okay, fair point. India is least exposed. It's only 2% of our GDP that is comprised of exports to the United States. That point is taken. But y'all must have penciled in a 15% kind of tariff. We are now hit with 25 and possibly more. Let's wait and see if we are able to negotiate our way out of that. So because of this 25, are you all giving a downward bias? What is your GDP number, and is there a downward bias?
So our GDP number is, it's on for the full year, we are at, full year calendar year 2025, we are at 6.4. And we had built a slowdown in growth on account of the expectation that tariffs would be lifted up across the world. And as I mentioned, we have built a lot more out of global trade downside, and that affects India's overall trade, not just exports to the US, but overall trade would slow because there is a slowdown in global economy and global trade that is coming up upon us. And with that, we had seen we built quarterly GDP growth in India slowing to 5.9% in the fourth quarter, and that would have been the worst in terms of the downside impact. Now, clearly, if there is, this 25% number that has been announced for India, if it stays for longer, our current expectation is that there will eventually be negotiation between the two countries, and the tariff rates will come down. But let's say, assume that this tariff number stays, and we have additional tariff on account of Russian crude purchases, then there is definitely some downside risk that we have to consider. And just one other thing I wanted to highlight, you mentioned India's exports exposure to the US is 2% of GDP. That's actually 1.4. Because if you take out the stuff which is exempted, this electronics is exempted, as you know, that's a big line item from us to the US now, and it's probably going to get bigger with iPhone exports. That bit is exempted. So that is 1.4% of GDP. So that's even smaller. But as I would just want to keep reminding that the bigger story that we have to worry about is the global trade slowdown and downside from that, less about the direct effect of tariffs on India.
No, I take your point. There is the larger one, but the market is worried about current EPS and next quarter's EPS. And there you have to, write in the tariffs for textiles. Incidentally, it's also pharmaceuticals that have escaped the tariff for now, which is also somewhat of a line item in India, electronics being the bigger one. But Khaitan, what about the subsequent years? Morgan Stanley was pretty bullish that India is going to have, up till 2030, probably a 6.7, closer to 7%, 6.5 to 7% kind of growth. Do you think that with this tariff uncertainty and the China plus one story, therefore, kind of losing its sheen, will we have to, look for downside risks down the line as well?
That's unlikely, Lata, because I think we're sort of building in this downside on account of tariff to be there for the next 12 to 18 months from a global standpoint, and therefore that would sort of weigh in on India's numbers as well. But beyond that, we think that we will sort of still be looking at the India story, which is to be decided by the Indian policymakers. I think there is a lot more that the control in terms of India's growth outlook is very much with the Indian government. Unless we're expecting that there will be a significant global trade slowdown persisting for the next 3-4 years, this should not be an issue that kind of affects the medium-term growth story for India.
Okay, what are you expecting in terms of inflation? Will there be further disinflation because you're not exporting much to the United States? And therefore, India, what is your India number and what is your expectation from the Reserve Bank?
So right now, we're expecting inflation to be in the range of 4.5%. But we are getting, and if you look at the core inflation numbers, they're pretty much in line with that. The downside risks are still there. One is because monsoons have been great, and so food prices may remain low. And at the same time, we still continue to see this disinflationary pressures emerging from China. Also on account of the fact that there is a global trade slowdown that is upon us, that will also have further additional disinflationary pressures on India from the external side. So we think that the risks are that you probably would see inflation surprising on the downside.
Okay, and therefore rate cuts more. Therefore, you're expecting rate cuts.
Yes, yeah, we are. Sorry, I missed your question. So yeah, I think we are expecting one more rate cut in October. And if there is more downside risk materializing to inflation, then we'll probably see additional rate cuts.
Okay.
Look, I think it's already kind of quite weak. If you look at core WPI, I would say look at manufactured products inflation. That's running at around 2%. And it's been running between 1 to 2% for a while. And so, yeah, I think the risks are to the downside on inflation, and therefore there is a chance that RBI actually does more rate cuts than what we have in our base case.
Okay. Khaitan, we have some breaking news coming in, and therefore I have to run into a break. Just a final word on when do you all see US inflation coming up and therefore your Fed rate trajectory?
So for the US, we are building in core PCE inflation, which printed yesterday at 2.8%. We expect that to go to 3.2% by the year end. And therefore, our US economics team is actually not building in any rate cuts for this calendar year. They have it only in the first quarter of next year. Of course, it depends upon the labor data that we get today in the evening. But to the extent to which we are not expecting a very sharp deterioration in the labor market, and we see that inflation is going up to 3.2%, we think that Fed's hands would be tied in terms of rate cuts this year.
Okay. I'm sorry, I'll have to wind this up a little faster than I thought. We have some breaking news coming in. Khaitan here, thank you very much indeed for sparing time for us this morning. It's a quick break, but we are back in a jiffy, and there's some big breaking news awaiting you.
You're watching us here on Chartbusters on CNBC-TV18. The stock of the morning has been PNB Housing Finance. This on the back of Girish Kosgei's exit from the company. So the stock is down 16% as we speak. Let's get a word in from the promoter of the company, PNB. We have, the management, the MD of PNB joining us to detail the developments that are taking place in PNB Housing Finance. Ashok Chandra, who's the MD and CEO, joins in. Thanks a lot, Mr. Chandra, for joining in. The first obvious question, why exactly, did Mr. Girish Kosgei resign? The official reason that's given is that he's seeking external opportunities. But was it him initiating the resignation discussion, or was it something that was collectively made from the promoters as well as his side?
No, I will make it very clear.
Yes.
Nothing from the promoter side, nothing from any other shareholder side. In fact, he has some family commitments at Bangalore, and that is the only reason for which he has put up his paper. Otherwise, nothing to be seen other than this now, in this particular case now. I think we are one of the highest shareholder in this. We have more than 28% shareholding in this, and we are holding that entire shareholding for many years. And I have firm belief that this company is growing fast, and this company will continue to grow fast in future also. Yesterday, the PNB board had the meeting, and NRC meeting also took place. And he has put up the paper, and subsequently already the NRC has and the board has engaged.
Mr. Chandra, a couple of things don't tie in together. On the one hand, you're saying that he's going for family commitments, etc. But at the same time, if you look at the prior few days as well, we had Mr. Dilip Vaiteeswaran, who resigned as the chief sales officer too. So a top rung of the company's leadership is resigning. Is there something more than just personal reasons?
Absolutely. It is only the personal reason, nothing more than that.
Nothing more than that.
Yeah.
What happens now?
Yeah. So Mr. Chandra, a couple of questions out here. When a big name like that leaves, there's always fear, asset quality, something with regard to, smelling a rat in some way in the books. Could you assure your investors that nothing of that sort, the guidance that's been given with regard to growth, asset quality, margins, all of that stands as per what it was earlier? Is that correct?
See, as a promoter, I can only tell that we don't see any challenge in this. This is the personal reason he has cited, and he is moving to Bangalore. I think PNB, the HFL, this board also, they are going to have some investor meet today, and they will clarify all those issues. But we don't see any big challenge, anything happening in the company.
You don't see big challenge, sir, but on April 8th, Anujai Saxena, who's the business head of Affordable Business, resigned with effect from 19th May. So a little over a month was the notice, and for a very senior leader. 23rd July, chief sales officer resigned. And then we have within 7 days, 31st July, Mr. Girish Kosgei resigning as MD CEO. 3 leadership positions resigning in a month and a half. Can't be a coincidence.
See, I can't make any comment on other resignation, what has happened. See, everybody looks for some better opportunity also in their
At the same time, sir, all of them look?
Yeah, they may be looking for that. We don't know, and I personally don't know what is the reason for others for resignation. But as far as I know about the MD resignation, definitely it is only for the personal reason. He has put up the paper, and he is moving to Bangalore. That is the reason he has cited, and he has discussed. I don't see more than this, and I don't visualize any other thing more than this.
Okay, all right. Mr. Chandra, then let's look ahead. The captain of the team has moved out. All eyes on who the new captain is. Yeah. When exactly will you be seeing the new captain taking charge of PNB Housing? Because till then, there's a bit of a flux. So could you tell us by when? Yeah. And do you have a candidate in mind?
No, nothing is in our mind. I think NRC has studied itself. They have engaged some HR firm, and I think they are very shortly they will be looking for some good alternative. And let us wait and see. I think PNB Housing, that board members also, I think they are also conducting the investors meet today.
That's already started.
They have also released the press release, I believe, today. So I think they will explain all those things, what is the process they are following.
From a PNB level, are you initiating any sort of probe on PNB Housing Finance's books because of the leadership changes that have happened?
No.
You know, because the growth has been extremely phenomenal. Ever since he was appointed to now, the stock market has rewarded the growth as well. And typically, when in a low credit growth environment, a company grows very fast, you can attribute it to, you know, the leader doing extremely well, or you can also attribute it to maybe that being risky growth. Could you give us some sense?
No, we have not visualized anything, and we don't see any such challenges which you are talking about.
So no asset quality problem, no growth-related issues, or supernormal growth taking place in the company, not impacting the balance sheet with his exit and the exit of the senior leaderships. You're confirming that.
One thing always you should see that we are one of the promoters. We are not managing the day-to-day affairs of that company. There is a separate board is there, and very good constitution is there of the board members. See, and all those things are being discussed in the board and other committee meetings. So I think they have not. Let us have the confidence in the board and let us move forward.
Okay.
All right. Could you tell us whether the new candidate will be coming in from the PNB group itself, or will it be an external candidate?
No, it is not coming from the PNB. That I can give you the assurance. I think the HR, they have already onboarded some HR firm, and they will be looking for some good candidate. And I think maybe you need to wait for some time, and definitely it will come out publicly.
All right, just a final question, sir, and this is for shareholders' comfort. I need to ask you this. 3 senior leadership resignations that take place post-April, and just around that time, on 3rd May, Carlyle Group goes ahead and sells their 10.5% stake in the company for around 2,700 crores as well. You do not put all of them together, do you?
See, when PNB is holding 28% plus share, and when we have not exited anything for the last 2 years, 3 years, and this year also, whatever instances you are quoting, we have not done any exit. So you should believe that, yes, we have...
a company growing very fast, then you have a PE exiting, then you have the top leadership exiting. So it's...
I can't make any comment on others' exit. I can just comment about...
it's not the action, it's the timing, sir. It's not the action. I mean, it's a PE. PEs have to exit at some point in time. And there are leaderships, which move out. It's not the action. The action is absolutely well in line with corporate, practices. But it's the timing of all of them happening together. That's what has the street so worried.
No, I have already explained the PNB position on that, and already matter has been seized at the board level and the NRC level. So let us wait and see that how the further things evolve. As of now, PNB doesn't see any challenge, and we are still holding our share in that.
And you're the promoter entity, and unlikely event, but I'll have to ask you, since the stock price is down 15%, your investors, PNB Housing Finance investors, they are fretting a little bit in spite of your clarification. Is there a possibility you go ahead and just, buy some shares from the open market as the promoter entity?
No, we are not. As of now, we don't have any such plan.
Okay. All right, Mr. Chandra, just had to ask you, clear the air on that front as well. So you're confident about business. You're looking at the new captain coming on. You'll have started the search as well, and the candidate will be from outside of the PNB group.
More importantly, he assures the street that there is nothing wrong with the books of the company. All of these exits, including the PE exit, are just coincidence that they've happened at the same time. So we take PNB's word on that. They continue to hold 28% stake in the company, but the street has other plans. The stock's still down 16%. Take a short break, come back on the other side. We get more markets and stock-specific action. Stay with us. Welcome back. You're watching us here on Chartbusters. Let's go to the earnings conversation that we have on the show today. Lined up for you, GE Shipping reported a 37% fall in profits. Revenues declined by 20% as well. G. Shivakumar, who's the Executive Director and CFO, joins in to discuss more. Mr. Shivakumar, not always fair to discuss these numbers on a quarterly basis because freight rates change regularly. So let's look ahead. Versus where the freight rates were in the first quarter, where do they stand at right now? And what's your outlook on them? If you could give us a sense, what's the current rate and how do they compare with the one that you saw in the first quarter?
Morning, Mangalam. Freight rates currently are at or slightly higher than where they were in the first quarter. For dry bulk, yes, they're a little bit higher. For product tankers, maybe marginally higher. Otherwise, they are more or less similar to marginally higher than in the previous quarter. That is Q1 FY26.
Could you give us absolute numbers? Where do they stand at? And how do they compare with the first quarter?
Yeah, so our product tankers earned somewhere in the $23,000, $24,000 blended across the different sizes of tankers. They're about the same number, maybe $1,000 more or $500 more. For the crude tankers, we probably average somewhere in the 30-ish region. We are around the same numbers in this quarter. Dry bulk are slightly better. They were probably in the low teens. We're probably somewhere in the $15,000 to $16,000 a day on average.
Okay, all right. Hi, Mr. Shivakumar. Thanks a lot for joining in. Well, with the potential ban on import of Russian crude, that's what various reports indicate. Could it reduce the demand of crude tankers? One of the tailwinds for the last few years has been demand due to long or increased route of Russian crude to India and to China as well. So do you see this as a potential demand disruptor?
Yeah, morning, Nigel. The disruption can happen in more than one way. So you're indeed right. If we just look at if the Russian oil gets removed from the market, then what happens? So one is it can get substituted by, say, Middle Eastern oil, which is the swing producer of oil and which has spare capacity, and which is, yes, a shorter voyage, and therefore has a negative impact on tanker ton miles and therefore on demand. But what's happening at the same time is that a lot of tankers are getting sanctioned. Ships that were carrying Russian oil are getting sanctioned all the time. Just yesterday, we saw 60 ships which are connected with the Iranian trade getting sanctioned. So it's not just the supply that gets taken out, it's also the supply of ships sometimes that gets constrained. But yes, the first impact of a removal of the Russian trade will be a negative for the tanker markets because it will be substituted by, and assuming that that can be implemented, it'll be a negative for the market because it'll be negative in ton mile terms.
All right. Last time, you did speak about looking at buying some vessels, and you've contracted to buy a Kamsarmax, if I pronounce that correct, dry bulk carrier. If you could give us a sense on what price have you agreed to buy it at, and what stage of the cycle are we when it comes to purchase and sale of assets?
Yeah, we don't give details of the price.
Rough estimates?
No, we should rather keep off that. These are confidential with the sellers. This is a second-hand ship. This dry bulk values, especially for the smaller bulk carriers, of which the Kamsarmax is one, are lower in historical terms than tankers. And that's why on a relative basis, they make more sense than tankers currently. What has also happened is that in the last 8 or 9 months, we have sold 2 of our older bulk carriers. We wanted to replace them. I think I've mentioned in the past that we are just, because we are not very happy with the prices currently, and we don't think you'll make a huge amount of huge return on these. We are just focusing on maintaining the capacity. So we switched from the older ships to more modern ships, more fuel-efficient ships. This is one of those transactions where we are replacing the capacity that we sold recently.
All right, so the reversing trend of order book for various categories of ships, from 2017, if I plot a chart all the way till around 2024, appears to have reversed. Now, shipyards, they appear to have a lot more orders in the last year or so. My question to you is, would that be a structural headwind for shipping rates as more supply is expected in the coming years?
Yes, at first glance, it is a headwind because there are new ships being delivered. However, one thing to keep in mind is that even as new ships are delivered, ships are aging out. New energy carbon emission norms can make it difficult for some very old ships to trade as well. So that's something to consider. There are old ships in the fleet as well that are running.
Okay.
But the first impact is that it's negative for shipping because there are ships joining the fleet.
But you're saying that it'll just be a near-term headwind, and then there are some of these ships that are as is obsolete and they're old. So then it matches. It could set off each other in the time to come. Is that correct?
That's the cycle corrects itself by removal of ships. That's the standard way the commodity cycle plays out. Capacity gets removed.
One would have liked for demand to increase as well for the supply to come by, but currently in the global scenario that we're in, that looks like a distinct possibility. So the next few quarters, perhaps not as good. The one thing that is good for you is, the delta that you would get from the renegotiation of rig rates, the offshore rig rates. Could you give us a sense on where you stand at right now and what is the next renegotiation coming up?
Yeah, so we have tied up some contracts for our rigs. Rates have not been great. The market, which was progressing very satisfactorily all the way up to early 2024, got a shock when Saudi Aramco off-hired about 24 rigs within a period of 3 to 4 months. Suspended contracts, technically. And as a result of that, rates have dropped off quite a bit for long-term contracts. The short-term contracts continue to be at pretty decent rates. So there's not going to be a whole amount of upward impact from improvement from rig rates. We currently have 2 rigs, one of which is idling and the other one is earning a very marginal standby rate. So that's not a big positive impact for our results. The vessels business has got repriced significantly higher, and that's contributing a lot to the profitability. The rigs, not so much. We have had 1 3-year also repriced, but at a lower rate than the previous contract. So there is no positive impact coming from the rig repricings currently. And we have all these rigs due for repricing, 3 rigs due for repricing next year.
So what would the normalized
scenario is there?
So once they're repriced, what would the normalized EBITDA run rate for this vertical look like for you from here on?
No numbers. Again, we don't give out projections, but we are not expecting an improvement from our run rate of the last quarter in offshore.
All right, sir. Always a pleasure talking to you. Thanks a lot for joining in here on CNBC TV18. I'll tell you what, with the way things are moving globally, I think we'll have to have a chat in the next month or so. So we request you to please join back and give us an update. For the time being, we take a break, come back, continue our focus on markets. Welcome back. You're tuned into Chartbusters, and as you can see here on top of Mangalam's head, he's in yellow, but he's got some green on top. These three indices, though, continue to trade in the red. So hopefully, as we wrap up on Chartbusters, the team of Trading Hour joins in, and maybe we'll have all the four indices that move into the green. Stay tuned. The team of Trading Hour is standing by.
Just continue to hold those. Just continue to hold those. Maybe, if you hold them, they'll move higher from here on. Thank you for watching.
Hello and welcome to Trading Hour live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me as always, Hormiz Fatakia and Reema Tendulkar. Well, it's the start of a new series, a new month, and we are getting a lot of data, whether it concerns with tariffs delayed by 7 days. We do have the auto sales numbers which are coming in. This is the month where we'll get RBI rate decision as well. And earnings, they are trickling in thick and fast. So we do have a lot of conversations lined up on the show. For now, Nifty flat with some negative bias, and it has continued to be quite volatile since morning as well.
But largely resilient, right?
Yeah.
I mean, we've not given up too much. In fact, just swinging between the red and the green line right now as we speak. But let's begin the show then with the auto sales numbers. Mahindra & Mahindra, the company saw the total sales surge by 26% versus last year. The passenger vehicle sales saw a jump of 20%. Total exports were up 83%. Nalin Kant, who is the CEO of the automotive division and M&M, is now with us on the show. Thank you very much for joining in. So we've got the numbers for the month of July, but can you give us an indication of how August and September is likely to be? What is your own internal expectation for SUVs? Go ahead.
Thank you, Reema, for having me on the show. So hard to predict. We are heading into the festive season. We are optimistic about having a strong festive season as well. But we are staying true to what we said we will do, which is mid to high teens growth in the SUV for the year. And that's what we've been delivering so far. As you said, July has been 20% growth. So we expect similar mid to high teens growth going into the festive season as well.
Okay, so your tractor sales have come in 6% higher, but the estimates that the street had was of around 16% growth for tractor business. Can you give us a sense of what the outlook is here? What has the demand been in July and coming ahead as well? We do have festive season, we do have rains which have been decent so far.
Yeah, again, tractors is something I wouldn't be able to comment on. It's a different part of the business, but in general, the monsoon has been doing well. We have 7% higher in terms of rains. So far, we have seen strong traction in general on the rural side of things. So I think that will hold us in good stead overall.
What about the SUV demand on ground? Because there has been, the SUV sales have been fairly robust, but there has been concerns with regards to the imports of rare earth magnets from China. And a lot of companies have also raised concerns with regards to that. What is your own situation right now at M&M with regards to the rare earth magnets? Has there been any disruption that you have faced because of this issue?
Yeah, almost. Thank you for that. It's a critical focus area for us over the past few weeks now. And we've taken a multi-pronged approach, looking at diversifying our supplier base, looking at different materials we can de-risk with. But overall, at this point in time, we haven't had any impact. And going into the festive, both Q2 and Q3 were well covered from a rare earth perspective. So we have no concerns there at all. There's a couple of components we are tracking at this point in time from a Q4 perspective, but we are confident those areas will be de-risked as well. But so far, nothing to be alarmed about.
Nalini, so why are you still guiding for a mid to high teens kind of an SUV growth? In July itself, it was a 20% growth, so you've beaten that. Plus, as you said, you're entering into the festive season with a lot of optimism. So, at least in the festive season, could you give us an indication of what growth for SUVs could look like? What is your own internal assessment?
Yeah, like I said, it's hard to see how it is going to play out. We'll have to see, as you know, that these numbers are coming in the backdrop of an industry which is flat to degrowing a little bit. And so we want to be a little bit realistic to ensure that we are putting numbers that we are able to totally be convinced about. So at this point, that looks like mid to high teens growth. Like you said, YTD, we have done about 22% growth. And we are optimistic based on the portfolio that we have, that we'll have a strong festive season coming in. But best to stay with the estimate we put out, which is mid to high teens growth.
Okay, mid to high teens growth. Exports are up 83% in the auto segment at 2,774 units. Is of course a smaller unit versus the others. Just wanted your take on export markets because a lot is happening globally. Be it tariffs, be it sanctions coming in. How does it impact you overall? What is the export growth that you're looking at?
Yeah, exports, like you said, is a relatively smaller number for us, and our focus areas have been primarily on South Africa and Australia so far. And we started with Scorpio and the 700 there, and we've had some good traction. Recently, we launched the 3XO in South Africa a couple of quarters ago, where we won the Car of the Year. And then we just launched in Australia a few weeks back, and we've gotten really good feedback, both from early customers and press as well. So clearly, an area we'll focus on, but we want to make sure when we go out there, it's with a set of products which will do well, and we have a strong right to win. Our EVs give us that right in the EV space as well. So that's something we'll be taking into these markets. UK is on the horizon in the next 18 to 24 months as we take our EVs there as well. So we will do it in a measured way and with products which we believe can do very well in these markets.
So would that mean, would it be fair to say that the focus of the subsequent product launches will be more towards EVs than compared to the ICEs?
No, so we've put out a plan in terms of launches over the next 3 to 5 years. It will be equally balanced for us. So for us, both are critical parts of our portfolio, and we'll have launches lined up in both. In fact, on August 15th, we're going to be talking about our platform, which will be helping us underpin the entire launch program for us going into the next few years. And it will be balanced between EV and ICE both.
All right, Nalindkant, thank you so much for sparing time and joining us. Wish you good luck for the rest of the year as well. Hope to have more often on this platform. The management of Mahindra & Mahindra's automotive division on the sales numbers for the month of July. Take a short break. From one automaker to another, the management of Maruti Suzuki joins us to discuss their first quarter numbers and the road ahead. On the other side, stay tuned.
Welcome back. Let's turn our attention now to commodity space. Manisha is now joining in and she's watching rice. Manisha, what's happening?
Oh, well, yes, because, there's a sell-off not just in the non-agro space, but in the agriculture commodities as well. And I'm looking at rice because the decline has been really sharp. If you look at the prices in the international markets, they're trading at a 2021 lows right now. In the last 1 year, we've seen 18% of a decline coming for the rice prices. In this year, 2025, we're down by 13%. In the last month, that is the month of July, also has been on the negative there. The global supplies have continued to outperform demand. India is returning to export markets with all the curbs taken away now, and that has created a situation of excess in the international markets, weighing onto the prices not just in India, but most of the origin countries and globally as well. So when you look at the global rice production for 2025-26, 538 million tons is what the street is working with, and that brings the total rice availability to around 743 million tons. Also, US, another major producer, is looking at rice stocks at around 5-year highs of around 47.5 million tons. That continues to weigh in as well. For the Indian markets as well, we are looking at a third straight year perhaps of a bumper or even a record rice crop right now. And when you look at the Indian stocks, they are up 15% year-on-year basis. So even as the government procurement or the government holding has to be just about 13.5 million tons, the stock that the Indian government has in sense of rice is a huge 55.6 million tons, and there's no reason or no way that you could be looking at rice prices increasing in this year in India or world.
Okay, so that's about rice prices. Lots happening in the commodity space as well. Let's go across to Hormuz. He's gone across to that big wall, going to tell us about the top movers in the market. Hormuz, tell us more.
Can't not talk about PNB Housing today because the top FNO loser continuing to extend losses. 16% down on that stock now is the biggest single-day drop that the stock has seen since March of 2021, and on very strong volumes as well. Almost 2 crore shares already traded compared to a 20-day average of just 3.7 lakh shares. So it's a big volume mover on the downside today is PNB Housing. Netweb Technologies came out with numbers yesterday, a result reaction. Almost 33.5 lakh shares have already been traded compared to a 20-day average of just 2 lakh. And from its IPO price of 500 rupees, the stock is up well over 4x now from those levels. Radico Khaitan is the other one. This is a 4th straight day of gains now for the stock, and more than 10 lakh shares now have been traded for 2 consecutive sessions. And even today, 13 lakh shares have already been traded. Yesterday was 11 lakh by the close of the session, and the 20-day average is just 70,000. And last name on the list is IIFL Finance. It was down yesterday. It's extending its losses today, 6.5% lower on the stock. It's down 4 out of the 5 days this week, and this is turning out to be the worst week since February of 2025 that the stock has had. 29 lakh shares traded already compared to a 20-day average of just 7.5 lakh. Back to you guys.
Thank you very much for that. By the way, Chalet Hotels has cooled off a bit. It opened straight away with gains of about 17-18%, but now it's up nearly 7%, again reacting to numbers. And as Mangalam was saying, it's boosted by the consolidation of the residential real estate business. So revenues are up 148% to 895 crore, but that includes 439 crore of the residential project income to the top line. And margins too have been proportionately bumped up. So the stock is still higher, going strong, but it's got a bit of, it just cooled off a tad bit from the opening level euphoria. PNB Housing Finance continues to slump. That's down nearly about 16-17%. IIFL is weak. Swiggy's lost nearly 2% as the overall losses have widened to nearly 1,200 crore. And quick commerce, that's driving a chunk of the losses, close to about 900 crores. So Swiggy is under pressure. And this performance is at a bit of a contrast to what Eternal did post their numbers. Netweb is a big mover on the back of their numbers. We'll get chatting with the management, but it's been a very strong performance. But let's talk about, Maruti Suzuki, very strong Q1 numbers. Expectations were muted. The company's profit, though, was aided by other income. Revenue growth was muted, but again, higher than expectations. Parikshit spoke to Rahul Bharti, who is the Senior Executive Director at Maruti Suzuki, and began by asking him about the drop in demand.
Retail domestic sales declined by 3.7% and industry as a whole declined by 1.3%. A large part of it is because of small cars. And, just to give you some statistics, in the financial year 17-18, we had 2.8 million small car sales with below 10 lakh rupees. Above 10 lakh rupees, we had 460,000 sales. Now that 2.8 million over 7 years has come down to about 2.3 million, which should have been a huge growth, but it is down 19% over 7 years. Cars priced above 1 million rupees rose from 4.6 lakh sales in that year to about 20.6 lakhs, which is a 4 times jump. It's a healthy growth and we are happy with it and we want to supply to that segment also. But we are concerned about that 28 lakhs, which was something like more than 80% of the segment that time, which is actually degrowing. So this is a cause of concern, and this is what is dragging down the overall sales of the industry to in the negative zone.
Could you give us a sense of how the raw material costs are putting pressure on margins? Any improvement in the situation?
Not really. It appears that the steel industry is taking undue benefit of the safeguard duty, which was not applicable for some grades, but there is some pressure from steel, which we think is not warranted. There are other commodities also. In Q1, copper and aluminium also showed some upward pressure. We hope that the commodities continue to be soft so that the customer is not impacted.
Right. When it comes to the rare earth magnet crisis, how badly is Maruti Suzuki getting impacted as a result? What are some of the alternatives that you're working around? And what's going to be the production impact in Q2?
So far, we have been able to, insulate ourselves from any kind of impact. Of course, the effort is on. It's work in progress. We are making alternate efforts. Mostly these efforts are in the nature of not importing the rare earth magnet itself, but importing a larger aggregate or a sub-assembly from abroad, maybe China, maybe some other country. But it does come with some amount of costs associated. If and when we have any problem in our production, we'll of course come back to you and announce through the stock exchanges.
Right. Just to ask you about deliberations with regard to CAFE norms. There are deliberations going on in SIAM, and Maruti Suzuki also has a view, which we have been reading about, that CAFE norms need to be revised in favor of smaller cars, considering there is a lot of costing pressure on small cars at the moment. Could you give us a sense of where these talks are and what is Maruti's rationale when it comes to revision of these CAFE norms, and why is it important for the industry right now?
Right. So the deliberations which are in SIAM, I think it's not appropriate for me to comment on that because SIAM is the best spokesperson. But since you asked the rationale, I can certainly explain. The CAFE follows a sloping line. It follows a differential methodology, which means lighter cars are given more stringent targets and bigger cars are given easier targets. Now, what happens is at very low weights or at, if you extrapolate the line backwards, which means at the lower weight zone of cars, it becomes technically impossible to achieve those low targets. And as a result, cars which have low absolute CO2 have to be either discontinued or have to be sacrificed to meet a regulation which counterintuitively was supposed to lower CO2. So we are sacrificing models of low CO2, low absolute CO2 to meet a regulation whose objective is to reduce CO2. So, and generally this anomaly is not a new thing. The whole world knows about it. And almost the entire world has some regulatory correction at the lower end of the curve. They have some kind of protection for small cars because it's a technical anomaly. And that is what we have mentioned. Fortunately, people understand this phenomena. And we hope that this would be addressed soon.
Okay, all right, that's the word coming in from Maruti Suzuki. With that, we'll slip into a break. When we return, we'll discuss market technicals with Mitesh Thakkar, also discuss the top trading bets. Great.
Welcome back. 65 points lower on the index, still fighting to hold that 24,700 mark, but on course for a fifth consecutive weekly loss. PNB Housing is now down 16.5%. What has also extended its losses is Niva Bupa. That is also an earnings reaction, 6.5% lower on that stock as well. So most of these names having a negative reaction to their results. Nuvama Wealth is the first day of an FNO stock for Nuvama Wealth, and that stock too is down around 4%. But on the flip side, Suzlon, which is also his first day in the FNO segment, trading with gains of close to 5%. Mitesh is now joining in for a quick chart check. Mitesh, well, you're still holding on to that 24,700 zones. Do you believe that this 24,600 zone will remain a very strong support and we'll keep consolidating in this 500-600 point band? And your stock recommendations as well.
Yeah, good afternoon. So I think in the short term, yes, because most of the volatility indicators are flat, which means that while we are seeing bouts of bounces and declines, there is no follow through happening over there. So my sense is that, in the short term, I think we might not do much and do a broader range, which is to begin with around 25,250 on the upside, about 24,600, 550 on the downside.
What about stocks?
Yeah, I was coming to that, sorry. On the stock side, I have a sell on ONGC with a stop at about 240 for a target around 228 over there. And sorry, and on the buy side is HUL. It's come off from the day's high, but the structure is still good. And this current price offers you a good risk-reward entry ratio. So keep a stop below 25.35 and look for a target of 26.10.
Okay, all right, Mitesh, thank you so much for joining us as always and have a great weekend ahead. With that, we'll slip into a break. As we do that, here's some good news for our viewers. India's business news leader is now click away. Introducing CNBC TV18's all-new app. Get instant access to breaking news, in-depth articles, and financial world updates at your fingertips. Download the CNBC TV18 app now from the Apple Store or Google Play Store, or just scan the QR code on your screen.
Welcome back. Let's get the latest trends from the futures and options space. Mangalam now joins in. Mangalam.
It's a relatively quiet start to the August series, and that's something that the bulls would like as well, because July series we lost nearly 800 points on the Nifty after 4 series of gains. So let's see what August has in store for us. The Nifty, the mid caps as well as the Nifty Bank are, just flitting between red and green right now, marginally in the red for the frontline indices. The broader markets, however, lower by almost 0.5%. FMCG stocks, they are outperforming. So all the domestic consumption themes are likely to return as we move towards, one, better demand conditions ahead, also a lot more uncertainty in the global facing names. So as a result of which, the street is bidding these FMCG stocks higher. So you have HUL, Asian Paints, Britannia, ITC. And remember, August also is the start of the festive season for India when we have, Ganesh Chaturthi and all of that. So from here on to the second half of this year, typically 60-65% of the consumption of the country takes place post-August. So that's why these stocks are fairly well bid. But right now, the market expected by, all these option writers is likely to be in a range. The 24,700 put, these are options that expire next Thursday. 150 rupees in terms of premium, telling you that at lower levels, 24,550 thereabouts, there is support. But belief is that the market may not even go 24,550 because yesterday's low is fairly crucial. On the way up, however, there's not enough confidence to, for the market to go above that 25,000 mark, because the 24,800 call writers also equally active, and they're looking at a premium upwards of 80-90 rupees odd as well. So that tells you that at higher levels, there is some supply coming in, 100 rupees on 24,800 calls. So if you're looking for a broad range on the Nifty, 24,550 to 24,900 is what the option writers are betting for the next 3 or 4 trading sessions. I'm just looking at the August series, big triggers for August series, because in the past, August series has been known for moves, big moves on the upside as well. So you have global updates around tariffs, something we'll be watching out for, RBI policy outcome next week as well. And then you have remainder of the first quarter results, along with the festive season kicking off. So we'll keep an eye out on all these triggers for the month of August. For now, a quiet start, bulls would like that.
Oh, yes. And festive season, something that all of us will watch out for as well, right? Mangalam, thank you so much for joining us with those cues from the FNO space. Let's talk about Netweb Technologies now. Saw strong revenue growth in Q1. Margins improved sequentially. AI workstation segments saw 300% growth on a YY basis. Sanjay Lodha, who is the chairman and MD at the company, is joining us now. The stock is up 11.5% as we speak. Let's talk about the guidance going forward in that case. Mr. Lodha, good morning. Thank you so much for joining in. Strong growth in revenues, almost doubled on a YY basis, and the AI segment did really well. What's your guidance for FY26 in terms of growth and in terms of segments? Which will be the segments that will drive the growth that you'll see in FY26?
Thank you. Thanks for your time. So basically, it has been a very, very robust quarter for us. As you know, basically from the very beginning, the company is somewhere around 25 years old. Our focus has been into the high-end computing area actually. And we have been focusing on Make in India and developing and trying to do the hardware design, manufacturing, and even the software and the services, everything in India. So that is definitely, we have developed the all kind of skill sets over a period of time over the past few years. And that is actually helping us so as to basically help us grow and to keep our growth momentum on. The other thing which is very important for us is basically the focus, the niche focus which we have. The 3 areas we work upon. The first is the supercomputing, that is HPC, and that we have been doing for 20 plus years. So that is around 25%, that is around 35% of our business. Private cloud and HCI is another 35% of our business. The AI segment is a bit surprised this time because AI segment used to be around 7% of our business 2 years back, but now it became around 15% of the business. In this quarter, we are seeing it around 29% of the business. But really speaking, the kind of, if you see, since we got listed, this is the 9th quarter result which I presented. We have shown a consistent growth of 40% CAGR plus actually across all the quarters without any fail actually. And I will remain to guide at the same level that basically we'll keep on growing at the same momentum. And because the business is highly predictable. As regards AI is concerned, definitely this quarter we had a very large deal. That's the reason you might be seeing a small kind of a spot there. But I personally would like to guide that 20% or 22% kind of a basically share in my total business for the AI segment. Because the other 2 segments are also very growth segments. They're also growing very well.
Got that. So AI revenue contribution of 29% in the current quarter was caused by a one-time spike, a large deal. But you expect AI contribution to settle around 22 to 23% for this year, correct?
Yeah, I used to guide it around 20%, but now I'd like to increase my guidance there to 22% on their total revenue, because my other segments are also equally growing. You see
Right.
the data center is growing, the private cloud market is growing, the HPC listen 2.0 is already out. So basically,
Sure.
that's all there. Thank you.
Yeah. So since you've increased the guidance on the AI contribution from 20 to 22%, why not on the margins? On EBITDA, you had guided for 13 to 14%. But this quarter, you've done EBITDA margins of 17.7%. So you've beaten the guidance significantly. So what's the new EBITDA guidance? And even on net profit, what would your guidance be? And again, I know we ask you this every time, but after a 100% jump in revenue, why not raise the revenue forecast? Why are you still holding on to that 35-40% kind of a revenue run rate?
Actually, in the current situation, basically this business, as you know, this is completely focused into enterprise and high-end government. Actually, 50% of business comes from government, 50% of business comes from high-end enterprise. All large customers primarily we focus upon. All the large customers depend on the production workload for us. As regards operating EBITDA, it was around 14.9% this year, while it was basically around 13.2% last year-on-year basis. So definitely EBITDA has slightly increased, but basically my EBITDA guidance will be around 14% only. I'd like to keep it around that, because basically we are seeing the growth momentum, and basically we want to price our products very, very reasonably, so that basically people are able to take the value for money. Since basically all our customers are long-term customers, we have a very good repeat customer base, so we don't want to overcharge our customers. So we will the EBITDA guidance, which I will like to operating EBITDA guidance, I like to keep it at 14% only, ma'am. And as regards the PAT also, my guidance will be between 10 and 10.5% approximately. We like to maintain that as well.
Mr. Lodha, what about your order book position? Your order book has come down compared to last year, and if I'm correct, that might be because of the fact that you're executing orders quickly. But what about replenishing the order book? What the kind of pipeline you have currently, that has gone up, but how much of that is likely to translate into orders going forward? What's your order? What kind of order book growth are you envisaging for this year?
Yeah, so basically our kind of business really, I think this is the first time I'm talking to you maybe. So basically our kind of business cannot be judged from the order book kind of thing, because our order book cycle is very short for us. Order basically gets executed between 8 to 12 weeks actually. So basically we are a funnel driven company, but if you really see the L1, where basically we are already we have won the order, but the purchase order is yet to come. So that is 100% sure kind of a situation. So basically if you add 464 crores and 229 crores, so that is somewhere around odd 600 plus crores actually. So that is kind of order book which we have. So in totality, the order book has not gone down. It's up only, and our funnel is also going up, as basically we are proactive sellers. As I have been telling, we are not reactive. That basically any tender is there, any RFQ is there, we just bid for it. We primarily basically define and devise our solutions around that. So basically it takes us around 3 months to 6 months to work on projects. So that takes basically the funnel closure time is also long. So that's basically this funnel actually gives me the confidence that I'll keep on growing at the 40% CAGR, which I have been telling you, and we have been performing quarter on quarter.
All right, Mr. Lodha, take that point. Thank you so much for joining us, sounding confident about the future growth prospects as well after a stellar performance in Q1. That's the word coming in from Netweb Technologies. The stock, though, has come off from the highs since the time we had that conversation. But we'll slip into a break. A reminder for our viewers, unlock a world of exclusivity, expertise and influence. Become a member of CNBC-TV18 Access, our premium members-only experience on CNBC-TV18.com. The membership includes access to CNBC-TV18's flagship events, interactions with our journalists, along with curated studio tours, e-learning sessions and masterclasses, and curated lifestyle benefits. Welcome back. Still tuned into Trading Hour. RR Kabil reported their Q1 numbers. The company saw its revenue rise 14%, EBITDA surge 50% versus last year. Wires and cable segments saw a growth of 23%. Rajesh Jain, the CFO at the company, is joining in now to take a few questions. Mr. Jain, good morning. Thank you so much for joining in. Can you talk to us about what the outlook is for FY26 going forward in terms of volume growth? You had guided for 18% growth. Does that stick? And what was the volume growth in Q1 itself? And what is the demand looking like in Q2?
Morning, and it seems FY26 is on track, and we see a very positive development in terms of value and volume growth. Looking to the various factors of infrastructure growth or our capacity expansion, we are confident to get this 18% volume growth for this year, FY26. Though in this quarter, like our volume growth was at 7%, which was like led by wire growth, and in cable, the growth was not as per our expectation because there were some spillover orders which will be executed in this quarter. So it seems that we are on track in terms of our projections and execution.
Okay. 7% volume growth in Q1, 18% for the full year. So what about the decline in copper prices? We've seen a sudden drop, more than 20% recently in copper prices. How will that impact you going ahead? And even, on your margins, you've managed to expand your margins by 7.6%. You had last time spoken about 100 bips improvement in margins this year. Is that on track?
Yes. We will get the improvement of 100 bits in this year, though it will be like gradually quarter on quarter, it will keep growing. And see, copper volatility is part of our business, but this 20% was for US for some time only. Otherwise, copper is volatile on both sides. Like we have seen upward trend also during the month of May and half of the June, and now it is on like some softening to some extent. But this is it is part of our business.
Mr. Jain, because of this, do you see any bearings on your margins going forward? Because what is the kind of margin profile you are envisaging for the full year? Because you had mentioned earlier that you wanted to see hold on to that double-digit guidance around about 2 to 3 years down the line. Do you still stick to that?
Yes, we are on track. We are working towards margin improvement on all the fronts. So it is achievable.
Let's talk about the FMCG business. What about reaching that break-even level there? Do you think that will happen in Q2 itself? Because losses have contracted quite a bit in Q1.
Yeah, but Q2 is always a soft quarter if you see industry-wide, because since we are like almost 50% our revenue comes from fan, which is Q3 and Q4 item. So maybe not for Q2, but we are certainly sure for getting back even in this year at EBITDA level.
Okay, so some point in H2 you see FMEG breaking even, not in Q2.
Yeah.
What about exports? I think 26% of your revenues comes in from exports. Now, with the whole tariff situation, how do you see exports playing out? Because I think you've spoken about how export cable margins are higher than the domestic margins. So if exports get hit, there could be an impact on your overall margins too, and there's guidance of improving.
There is a lot of uncertainty about the US exports, but the good part is since we are the largest exporter and our export is spread over many countries, so US is part of that strategy. We see a very good scope in coming future. So there may be some impact only on US, but overall when we see our cable strategy, our product strategy, export is still a very good sector and we are doing very good. Overall export to US is around 2.5 to 3% of our overall revenue. So, and still see things are not clear. So we are not sure how things will move. So let's wait and see how things will shape up in near future. But it will not have a very big impact on our business.
But did you see any impact of this in the current quarter, Mr. Jain? And if this uncertainty with regards to the US market, do you plan on offsetting that uncertainty by diverting your exports towards other growth markets? And what is the current export to domestic mix, if you could share some light on that?
So see, still export is like contributing, even if I consider only wire and cable, then it is contributing almost 30% in my revenue. And since we are exporting very huge quantity in Europe and Middle East also, so we have a good scope based on our cable capacity expansion and new product, new geography. So we are keeping a close watch on our export side, and we are quite positive that we'll do good.
Okay, all right. So what's happening with US tariffs also is a developing situation, but we'll come to you for more conversations, Mr. Jain. Thank you so much for joining in today with the update on the outlook going forward. With that, we'll slip into a break, but remember to tune into the all-new CNBC TV18 Prime, bringing you insights from policymakers, business leaders and economists shaping both the world and India's future. CNBC TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune into CNBC TV18 Prime at 12 noon for the Global Reset, at 1 p.m. the Big C and the Global Lens at 8:30 p.m.
Welcome back. The Nifty has seen a bit of a dip now towards the lows of the day. We moved below the 24,650 mark at one point. We've just seen a slight recovery from the lows, but still almost 100 points lower now on the index, below the 24,700 mark. And one sector that has taken it on the chin today is Pharma. And in particular, it is Sun Pharma that has taken a bit of a hit today. And that is on concerns that after Donald Trump's directive to 17 big pharma names to make drugs more affordable, the company's innovative portfolio may be targeted. Ekta, Ekta is joining in with more details on this. Ekta.
Well, yes, pharma stocks are in focus today as the US President Donald Trump has sent letters to 17 major global pharmaceutical companies, including the likes of Eli Lilly, Pfizer, AstraZeneca, and Novo Nordisk, strongly urging them to reduce US branded drug prices and align it with those charged in other regulated markets such as Europe. While there is no immediate impact on generics, analysts warn that the long-term addressable market for generic drugs could possibly shrink. This, coupled with already existing pricing pressures, could pressure the generic market in the US further and possibly even rejig plans, long-term plans you'd have to say, when it comes to, for example, in-licensing deals. For Sun Pharma, besides earnings, which we will just get to, the spotlight is also on its global innovative medicines portfolio, which is basically their specialty drugs portfolio, which includes branded drugs such as Ilumya, Secure, Lexelvi, Winlevi, and Odzombo. This segment, which accounts for nearly 20% of the total revenue and grew nearly 17% year-on-year in the fourth quarter to $311 million, while the company has not heard from the US administration and its point that any move to cut the US branded drug prices could result in the company reducing their specialty drug prices. And when it comes to earnings, the company has also flagged that its effective tax rate will normalize to 25%, up from 16%. This has resulted in EPS downgrades, with some analysts cutting their FY26 to 28 estimated core EPS estimates by anywhere between 8 to 13%. Adding to the uncertainty on pharma, while pharma is currently exempt from tariffs, the pharma imports into the US are being reviewed under Section 232, a national security provision typically used to evaluate whether certain imports pose a threat to US interests. Analysts believe it is a medium-term overhang, and any adverse finding under Section 232 could have major implications for Indian drug makers. India imported around $11 billion worth of pharmaceuticals to the US in FY25, accounting for 35% of the total pharma exports and nearly 47% of all prescriptions filed or filled in the US in 2022.
Thank you very much for that. By the way, the market has moved southwards. It's down about 100 points, so it's taken a turn for the worse. Pharma continued to reels under pressure. Sun Pharma, Ekta was talking about it. But look at Dr. Reddy's. That too is down nearly about 4%. And now the cuts are getting deeper in some of the IT names. Infi, Wipro, both down nearly about 2%. But as we wrap up on the show, here out Sandeep Bhatia of Macquarie Capital and his call on the pharma stocks.
It raises multiple issues. One is the immediate issue of whether Sun Pharma and some other innovator drug companies will get notices like what the Swiss and the other multinational companies have received from the Trump administration. In the last quarterly conference call, my analyst says that Sun Pharma, which derives around 20% of its revenues from innovative drugs, sold in the US, said that they had not received any such communication. But this is anyway, with the Trump administration, everything is work in progress. Everything can change. Even when things are moving in a certain direction, they can move suddenly in the other direction.
Stocks trade soft but ranged after Trump imposes 25% tariff on India, higher than most trading peers. Healthcare and oil and gas are the big drags, while FMCG ekes out gains.
Sun Pharma takes a beating on concerns that after Trump's directive to 17 global pharma names to make drugs more affordable, the company's innovative portfolio might be targeted. This basket accounts for nearly 20% of the company's sales.
Swiggy's quick commerce losses mount even as food delivery profit expands. The digital platform calls this the peak of quick commerce losses and drawing buying calls from analysts, but the stock slips on profit taking.
Girish Housing Kosgi, the managing director of PNB Housing Finance, quits much ahead of his term end. Worries over the lender meeting its set targets spooks the stock following key exits. PNB says his resignation is only due to family commitments.
Good afternoon. You're watching us here on Halftime Report. We come to you live from the CNBC-TV18 Motilal Oswal studio. I'm Mangla Malu, with me Ekta as well as Winnie. The start of August series was supposed to be fairly muted, soft, but it's getting worse right now. Any recovery is being vociferously sold into. The Nifty is at a very important level, 24,647. Why do I say that? Because yesterday's low was 24,635. So the intraday panic that we saw, which was bought into in yesterday's trading session, the question is whether we are going back below those levels or not. And could yesterday's recovery just be an expiry-related move? So we'll watch out for where the market goes from here on. The street is pinning its hopes, as of now, on 24,550 to 24,650 to stay as a support. Midcaps faring much worse on day one of the August series. There are 1,500 stocks which are declining for every 1,000 stocks which are gaining.
Hi guys, yes, it's not only the start of a new series, but it's the end of the week as well. And it's not looking good in terms of the end of the week for the market. So, for example, the Nifty at current reckoning has lost around 0.5%, but the mid-cap index has lost around 1%. The small-cap index has lost around 1%. And not to mention in terms of the sectors, Nifty Pharma index has lost the maximum at current reckoning. Week to date, it's probably exaggerated in terms of losses, considering that it's currently down around 3%. We have the Nifty IT index, which is down around 1.3%. At this point and has lost close to around 3% for the week, and the Nifty Bank, which is down around 0.3% and lost around 1% on a week-to-date basis. So it's a tough week, you would have to say, and a soft start to the new series as well, guys.
Soft start to the new series as well, but some of these earnings candidates that came in overnight, they're managing to hold on to gains. We had Netweb Technologies, smaller end of the broader end of the market type of companies. Netweb Technologies, we had other companies also which are managing to hold on to gain. Indegene as well, and Radico Khaitan, we're seeing second day of gain that's coming in here.
Yep, Radico Khaitan post the numbers yesterday that came in incredibly strong numbers. The stock saw a bit of profit taking. Maybe it could have been, the post-result sort of impact that we saw sell on news. But now, today, it's holding up with gains which are more reflective of the kind of numbers that were there for the company. A strong set, the revenue jumped more than 30%, margins expand, and volume growth of over 40% as well. Abhishek Khaitan, the managing director of the company, joins in. Thanks a lot, Abhishek, for joining in. It's 2 quarters of straight 30% plus volume growth coming in for you. How much of that is sustainable, and how much of that is on account of the markets like Andhra opening up for you?
We started the year on a very, very positive note. And I think the last 7 years or 10 years of work of Radico is now finally playing out. And we are getting growth from all over, especially a lot of growth we got in Andhra because the market opened from a closed market to an open market. And there our market share is close to about 29 to 30% of Andhra's market. Then all our brands are doing exceptionally well in states like Uttar Pradesh, Rajasthan, Madhya Pradesh. Everywhere the brands are growing. And that should, the year has started on a positive note.
Okay, all right. But Abhishek, can you tell us what's the outlook for the next 3 quarters when it does come to volumes?
See, as of now, what I personally feel is that in this fiscal year, we should be easily doing 20% plus volume growth.
All right, 20% plus volume growth for the full year, for the company, that is. Okay, and what about P&A specifically? What kind of volume and realization growth are you working with?
See, as far as the P&A growth, as I've always guided that we concentrate on the P&A a lot, and we want the P&A to grow by at least 15%. But in this quarter, the P&A has grown a lot. It's grown by about 40%. But I think going forward, my guidance will be the same. Our concentration is in the P&A, the luxury and the semi-luxury segment. And for the next 3 years, we feel that at least 15% growth in the P&A is easily possible.
Don't you think that 15% volume growth would be a bit conservative, given that you have grown 40% plus in Q1 itself?
I think next 3 years, the P&A should easily grow because all our brands are doing exceptionally well. Starting with let me start with a little bit on the brand, how they are behaved in this quarter. Our flagship brand, Magic Moments Vodka, which did 7 million cases last year, and now it is the 5th largest vodka in the world. And we command a market share of 60% in the entire vodka space. So that grew by 20%. Then our, in 2022, we repositioned After Dark in the deluxe segment, which is one of the largest segment where Imperial Blue, brands like Imperial Blue, etc. are there. So in 2022, we did a volume of 9 lakh cases, which last year we did 1.9 million cases. And this year we are surely going to double it. And Royal Ranthambore, we are the only Indian company to price Indian whiskey higher than the bottled in India Scotch. And that brand also in the current quarter has grown by 89%. And I think by next year, we should be close to 500,000 cases. So I think overall, we are on the right track. And in our last interview with you, said that our concentration is in the semi-luxury and luxury, and which has grown by 50% in this quarter in terms of value. And we are well in target to cross 500 crores in the current fiscal.
Okay, fair enough. But will Imperial Blue having a new owner impact the competitive scenario, Abhishek?
See, I would not like to give any remarks on the competition, but I said that we have a brand After Dark, which is doing exceptionally well, and the number is speaking for itself. In 2022, we repositioned it, did 9 lakh, then 1.9, and this year we'll double it. And the brand all over is showing great response.
All right, great response for that brand, and you are not very perturbed by the competition coming in from new owners of Imperial Blue because your brand stands with them. What about the potential benefit from the India-UK FTA? You've been alluding to some margin improvement on account of that because of the Scotch that you import. But on the other hand, the offsetting impact could be from the Maharashtra excise policy. Do you have some numbers for the same?
See, as far as the UK FTA goes, if you see, we are one of the largest importers of Scotch in India. In the current fiscal, we are going to import about close to 250 crores of Scotch. And I think in the years to come, it's only going to increase by leaps and bounds. So with the duty reduction from 150 to 110, the max is very clear, which will come to us. As far as competition goes, I think a lot is to be seen because the state, it also depends on the state duty, but what maths we have done, that the prices of the imported Scotch should be in the range which will go down by about 5 to 10%. And as it is, if you see our Rampur single malt is priced much higher than most of the imported malts. So I think it's more of the brand perception, the brand quality which will play. And UK FTA will be definitely a great benefit to Radico. As far as Maharashtra goes, about only 4 to 5% of my volumes come from Maharashtra. And definitely the industry is going to see a decline. But I think as far as Radico is concerned, it won't be much of a concern.
So Abhishek, then what kind of margin improvement should we expect now to continue from here on in FY26?
See, as far as the UK FTA goes, is if you see, we are one of the largest importers of scotch in India. In the current fiscal, we are going to import about close to 250 crores of scotch. And I think in the years to come, it's only going to increase by leaps and bounds. So with the duty reduction from 150 to 110, the max is very clear, which will come to us. As far as competition goes, I think a lot is to be seen because the state, it also depends on the state duty, but what max we have done, that the prices of the imported scotch should be in the range which will go down by about 5 to 10%. And as it is, if you see our Rampur single malt is priced much higher than most of the imported malts. So I think it's more of the brand perception, the brand quality which will play, and UK FTA will be definitely a great benefit to Radico. As far as Maharashtra goes, about only 4 to 5% of my volumes come from Maharashtra, and definitely the industry is going to see a decline. But I think as far as Radico is concerned, it won't be much of a concern.
Right. All right, Abhishek, we're going to leave it on that note. Thanks very much for joining in. So that's Radico Khaitan. The stock is up around 5% They're targeting a 20% growth in volumes going forward. We need to take a short break on that note, but we'll be connecting with one of the important managements of today, Sun Pharma, to decode their Q1 numbers and also quiz them with regards to the situation on tariffs in the US. Welcome back. Well, let's talk about one of the top Nifty losers today, which is Sun Pharma. The company's Q1 performance was mixed as revenue was just shy of estimates, but margins improved. To discuss the quarter gone by, I did catch up with the company's CFO, Jayashree Satagopan, and began by asking her about the topic which is on everybody's mind, the impact of the letters written by President Trump to pharma companies to provide most favored pricing for American consumers. Listen in.
As of now, we have not received any letters, and as and when there is a further development, we will be in a position to assess it for our specialty portfolio.
Okay, so just to clarify on this, your specialty portfolio does consist of only branded drugs.
Yes, you're right.
Which are patented, and then once they go off patent, you will see generics come in. Is that correct?
Absolutely.
Okay. So what is the price difference of these specialty drugs that you sell, you know, Winlevi, Illumia, Sequoia, etc., in the US as well as other regulated markets? What's the price difference?
The price difference between US and the other market varies. And at this point in time, these products are mainly in the developed markets.
Correct. But if in case Big Pharma is eventually forced to regulate their prices, say for their branded drugs, would Sun Pharma feel the pressure and have to follow suit?
Yeah, as and when we get the letters from the US administration, this could have an impact on some of our specialty products.
Okay, all right. As of now, you've not got a letter. If you don't get a letter, but you see your peers reducing their prices, would you be compelled to?
Yeah, we'll have to wait and see how this pans out.
Okay, all right. What would the impact be on generic drugs? Because does it shrink the size of the addressable market for generic drugs?
MFN does not have an impact on the generic drugs, as I understand.
Okay, all right. What is your sense in terms of the tariffs on pharma? As of now, we are on the exempt list, but what is your expectation? Do you expect any kind of tariffs, if in case they are imposed, say on the final product or on the supply chain, they would eventually be passed on?
See, at this point in time, the investigations under 232 is going on. Post that, we will get to know what is the thinking around the tariffs for the pharma sector. So we'll have to wait and watch on this front. And as far as the generics are concerned, we also need to consider the supply chain, the economic considerations of manufacturing in India versus US. All of these will be looked into on a case-to-case basis as and when.
But you're not looking to expand your operations or manufacturing operations in the US?
We do have 3 facilities in the US, and at this point in time, we are not considering expanding the facilities further.
I just wanted to come back to the generic market in the US because, you know, the dynamics seem to be changing. There's price pressure. Key drugs such as Revlimid generic are now going to face competition. And the size of the addressable market of generic drugs is probably going to shrink if in case branded drugs eventually have to reduce their prices as well. Do you think it's becoming a tougher environment for generic drugs in the US?
See, the market per se is pretty large. And as far as the generics is concerned, we have been seeing challenges in terms of price erosion, and that's nothing new at this point in time. And therefore, we do believe that despite the MFN and the price pressures that could be on the specialty segment, the generics will continue to play a much larger role in the US market.
Well, let's get to the numbers now, because one of the things that's probably deterred the street is your tax rate, which has risen to around 25%. Just take us through that.
Yeah. See, over the past few quarters, we have been guiding the street in terms of our tax rates moving up. As a company, we did have the benefits of integration and MAT benefits, plus our plants in Sikkim and Guwahati also had the tax exemptions. With the sunset clauses, we will be getting back to the normalized tax rates, which is around 25%, and this is nothing new. I think we have been open about it. We have spoken to the street, we have spoken to the media, and it's a normal course of business. But Ekta, what I would really like to highlight here is the overall business performance of the company. As you could see, that the top line growth has been at around 10.1%, and the EBITDA growth has also been at a higher 19% or so.
Correct.
EBITDA margin has also expanded during the quarter. The tax is a function of some of the exemptions that were available earlier, and it will go through a sunset clause, and for the whole year, we do estimate that the tax rates would be in the range of 25%.
All right. Your guidance is still mid to high single-digit growth, correct?
Yeah.
Okay. What is that predicated on, and does it factor in the uncertainty from tariffs?
Yes, it does factor in the uncertainties from tariff to a certain extent.
Okay. You've also mentioned a $100 million investment on commercialization of 2 specialty products. Will you be deploying the entire $100 million?
At this point in time, we do believe that the investment of $100 million would happen during the year. These are for 2 products, which is Lexelvi and Unloxit. Lexelvi has been recently launched in the US. It's about a couple of weeks back, and Unloxit is planned for a launch in the second half of the year.
Okay. What is the impact of margins given that you will be spending this $100 million additional, and you will also possibly have a higher R&D spend, something that the company had guided towards in the previous quarter?
What we look at with these investments of about $100 million is the long-term impact that it could have for the company's business and its margin profile. We do not specifically look at a very short term or a quarter to quarter in this front, because these specialty products is going to have a longer life period, and initial investments would be required to help them, to help us unlock the potential of these products.
Specialty sales, what is the run rate that we could expect? You touched around $311 million this quarter. Is this the base rate that we can expect in the coming quarters?
Look, the specialty sales will be growing, and we believe that the sales growth will definitely be higher than the overall guidance that we have given for the company.
Okay. 3 of your sites have warning letters now. What is the plan on remediation?
So the sites are working on the remediation plan, including the actions that have been committed to the regulatory authorities. And we expect that we would get into a compliant state on this front.
What about the 8 observations?
As far as Halol is concerned, we did have the FDA inspection that happened during the last quarter, and the site has filed detailed response to the regulatory authorities. We will be awaiting for their feedback further.
All right. We understand that you're planning to launch semaglutide in India. What is the opportunity that you expect, considering that there will be multiple players that will be launching the drug in the country, plus the fact that there are growing concerns with regards to the side effects? There are newer drugs coming in. Novo Nordisk, in fact, slashed its guidance based on slower sales.
Look, semaglutide is a product where we think there is a very large opportunity in the country. At the same time, it is going to be a competitive landscape. This product will have room for many players, and it is also a pretty safe product. As far as Sun is concerned, we intend to launch this product on day 1, and as you know, we are the leaders in the cardiometabolic segment, and we plan to leverage our presence in this segment and launch the product on the day 1.
Okay, that's the management of Sun Pharma. Interesting insights coming in there. But on that note, we're going to slip into a very short break. Remember, viewers, you can tune into the all-new CNBC TV18 Prime, bringing you insights from policymakers, business leaders, and economists shaping both the world and India's future. CNBC TV18 Prime decodes the global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune into CNBC TV18 Prime at 12 noon for the Global Reset, at 1 p.m. for the Big C, and Global Lens at 8:30 p.m. Welcome back to Halftime Report on CNBC-TV18. As of now, the Nifty is still at 24,660 levels. Keep an eye on that. But a lot of stocks that are buzzing in trade today, moving in trade on the back of their earnings and other news flow. Vivek is joining in with us to talk to us about that. Vivek?
Well, thank you so much for that. It's an afternoon where you're actually seeing more laggards than gainers, especially as far as the broader end of the markets are concerned. Very limited gainers, especially on the back of news flow. First on the list, Radico Khaitan, volume growth of 37% for the quarter gone by. Very strong set of results. That stock higher by over 5%. A couple of stocks as far as the wind energy space is concerned, especially wind turbine manufacturers. So Suzlon higher by 6% today. Remember, there has been a notification indicating that there has to be a higher domestic content usage as far as wind turbines and as well as renewable energy using wind is concerned. On the other hand, quite a few laggards as well. First on the list has to be PNB Housing. Now that particular stock, you have seen the resignation coming in as far as the MD and CEO is concerned. We did have the promoter PNB speak to us earlier, but the street is not convinced. And on the back of that, almost 18% lower. Chola Finance, this particular company just concluded its conference call. They've gone ahead and increased the growth guidance as well as the credit cost, and on the back of that down by over 2% today. IIFL Finance, this particular name, again, credit cost inch higher. Couple of key worries, especially as far as asset quality is concerned. That stock lower by 7%. Tata Motors, a surprise resignation coming in as far as the JLR CEO is concerned. That stock lower by 2%. And Sun Pharma, a downgrade coming in from Investec. The effective tax rate higher than what the street was anticipating. That stock low by almost 4% today.
Right, those are a bunch of buzzing stocks. But what's the FNO update at this afternoon? Let's go across to Nigel. Nigel.
Well, that's right, Mangalam. The Nifty is a little bit skittish, but the only positive that I would see is that the India VIX is still not running away. The last time I checked, it was up only around 3%, with the Nifty down more than 100 points. Now, I'm looking at the options data, and the call writers are getting very, very confident. The 24,700 call, just take a look at the kind of open interest addition we have seen on the first day of a new series. 70-80 lakh shares being added around 24,700 call, 24,800 call as well. So aggressive writing is what we're seeing on both those two strikes. And the last time I checked, the PCR had come down to around 0.8. It's not yet reached that 0.65, 0.6 odd, from where we did see a technical bounce, but that's gradually coming down because the kind of aggression we're seeing on the call writing side. So, if you're looking at levels, then the important mark to look at is there's a crucial support at around this 24,400 to 24,600. That's the important mark. You don't want that level to break because the bulls will believe they're still in the game. On the upside, yesterday's high, 24,950, important mark on the upside, which is a distance away from current levels. But the recent low was in that vicinity of around 24,600. On a closing basis, you'll at least like to defend that mark. Individual stocks, these EMS plays, they're in a world of their own. For this week itself, they've seen a good amount of, of buying, and there is fresh long addition. You look at Keynes, it's one of the stars of the week, up more than 10%. Long addition being seen out there with the stock moving up. And Amber Enterprises, the management joined us earlier today. They were talking about the electronics vertical itself scaling up substantially to $1 billion. That one as well is seeing long addition. And PNB Housing Finance, the stock is slammed down. There's a massive open interest built up out there. And just take a look at the built up. And I was looking at the MWPL, that's the market-wide position limit. If you look at it as a percentage, the open interest as a percentage of MWPL, it's in that vicinity of around 90-91%. Just to alert our viewers, when open interest hits more than 95% of MWPL, then it will go in the FNO band. So we're some distance away from that particular level, but there's a big surge, massive shorts in the system out there. Now, the markets are looking a little bit jittery, but two factors I wanted to highlight. One is the FI net short positions. They're the highest they've seen in multiple weeks and months. And at the start of the series, it's almost at the highest ever at around 90%. So that's giving a glimmer of hope that if you get a positive trigger, they'll be forced to cover some shots. And the other one is, we have seen a 1,500 point correction from the recent peak. But yet, we're not seeing the India VIX surge up. Till it holds below that 15-odd mark, the odds are that maybe, in fact, we see some kind of a recovery sometime during the August series, particularly towards the second half, we are likely to see that. So those are the technical indicators. Back to you.
Okay, all right, Nigel. Thanks very much for that. Just want to point out that while that's the FNO update, there are a couple of stocks which have really taken it on the chin on a week-to-date basis. Strides Pharma, for example, That company came out with its results this week. It's down 6% today and it's lost around 10% on a week-to-date basis. JM Financial also is down around 9.5% on a week-to-date basis, and Aarti Drugs as well, down around 7.5% at this point. We need to take a short break, but as we do that, a reminder for our viewers: unlock a world of exclusivity, expertise and influence. Become a member of CNBC TV18 Access, our premium members-only experience on CNBC-TV18.com. The membership includes access to CNBC TV18's flagship events, interactions with our journalists, along with curated studio tours, e-learning sessions and masterclasses, and curated lifestyle benefits.
The Nifty is down almost 110 points, 350 points lower for the mid-cap index. Let's talk about cryptocurrencies then. It's been almost a year since crypto exchange WazirX was hacked, spurring losses of $238 million in investor funds. The exchange has ceased to operate, and soon after, WazirX, in fact, has been reorganizing operations under its new Singapore-based entity. There have also been reports of them moving funds from Bybit. The last year has been about litigation, court hearings, and funds stuck in lost opportunities. Manisha caught up with industry experts Chirayu Bagri of 9 Point Capital, digital payments experts Sanjay Saxena, and IndiaTech.org CEO and President Ramesh Kailasam to take stock of all that has unfolded in the last 1 year, but more importantly, the road ahead. Listen in.
The last 1 year has more or less been like knocking on closed doors, because I personally have tried approaching various authorities, various courts. Anyone who wants to hear me on this matter, seek cognizance of the same. I am personally an investor in the cryptocurrencies market in the VDAs since 2021, and I was a firm believer in this one coin called XRP. This coin has now gone up 600% in price. What WazirX is now doing is, there were two types of tokens, hacked and unhacked. My coins were not hacked, there were coins which were hacked. For example, Ethereum and Shiba Inu. XRP has gone up 600% in price. Ethereum and Shiba Inu are still at the price at which they were 4 years ago. WazirX is now in a conundrum. What has happened is no doubt very unfortunate. WazirX is now using funds from other users to pay the users who got their tokens hacked. This is something which I personally see as a violation of my fundamental rights because they are socializing their losses. It is the onus of the reserve. 2 weeks ago, CoinDCX got hacked for $41 million. Within 17 to 24 hours, not only did they resolve the entire thing, but also made sure that any person who was an aggrieved party could withdraw their assets and could take the more money and move to another exchange if they wanted to. It's been a year. We are now fighting this in Singapore. WazirX since 2017 was carrying out its operations in India. Most of its customers are Indians. They are registered with the Financial Intelligence Unit in India. Why have they gone to Singapore? Right?
So, I get your point here, but let me come to you, Mr. Saxena. And you look at digital payments, and with the way things have really worked out and everything that Chirayu put out, I'll add one more to it, that is that the refunds perhaps are happening in rupees and not in crypto. So that is where another loss perhaps comes into these investors there. How have you read it all, and what is the solution that you would want to put forth?
Thank you, Manisha, for having me on this. Let me tell you the current resolution. It leaves many questions unanswered, rather providing a solution to the beleaguered investors or platform users. To cite few such, without going much into the detail, cite few such examples, there is no clarity as of who is the owner, where the ownership lies of the cryptocurrency on WazirX, to whom it belongs, whether it belongs to Binance, ZI, or the users as an unsecured creditor, There is, I generally say, clarity in the currency, clarity is the currency in the digital ecosystem, and much more when we dealt with the VDA. In the proposed resolution, the funny part is in the proposed resolution, it is the majority or the 75% of the voting, those who vote, not the total, the creditor which represent, unlike in the NCLT resolutions, where the committee of creditors, 2/3 of the total have to vote in favor of the resolution. There is nothing such as such in this case. So my point is, there are many operational issues and the unresolved questions which is not there in the proposed in the resolution plan. And in fact, the current plan doesn't respect, if I have to say, the user's asset right. This is not a mutual fund. Crypto asset class need regulatory fairness. This is what I want to say.
Mr. Kailasam, interestingly, Mr. Saxena also talked about NCLT here. Now, we are talking about an area where it's more about KYCs, the regulatory authority, grievance cell, etc. is not there. What's your sense? What is the solution that you see even after a year where we are still looking at third-party audits, where we are still looking at some accountability?
Well, I think hearing both the panelists, I think one thing is pretty clear, that there is a need for guidelines and standards in digital asset resolution per se. Investors are raising these concerns, and that also signals that there is a need for maturity in these areas from a governance standpoint. The observation that there is growing need for all of this signals the need for I would say a standard or something of that sort to be built in the digital asset resolution process. Investor concerns about resolution refer to clear procedures for handling things like insolvencies, asset recoveries, dispute resolution, and overall legal certainty in the event that we are supposedly facing such issues. And regulators worldwide are grappling with this and refining the frameworks quickly on digital assets. For example, jurisdictions are already implementing what is called digital asset resolution packages, DARP, to address insolvency scenarios. In essence, investors are also raising concerns about resolution standard and so on. That also signals the fact that investors are not here just for high returns, but also foundational elements of a well-functioning and secure financial market in the virtual digital asset space. And there were examples given on how quickly one exchange was able to resolve versus other which wasn't able to. And this is, I think, a critical step which India needs to take towards digital assets being fully integrated, investor, I would say, rights and the methodology being clear-cut laid out from what you call a governance standpoint.
Welcome back to Halftime Report on CNBC TV18. Let's talk about numbers of team lease services. Muted set that came in Q1 FY26. Margins largely came in line with what the street was expecting. The stock did open up sharply in the green and then has seen a bit of a fall, but as of now holding on to gains of 3%. To talk about the outlook of the company, we have Ramani Datti, the CFO at Team Lease Services, joining in with us. Ramani, good afternoon and thank you so much for joining us. Let's start by talking about the big point that's coming from the IT hiring trends. Now, TCS has obviously spoken about that layoffs coming in at 2% for its global workforce. What are you seeing in terms of IT hiring trends? Q1 as well as in Q2, how is it shaping up? Also, between permanent staffing and contract staffing, is there any change in terms of those trends in IT as well?
Yeah, sure. See, as far as IT is concerned, let's discuss in two parts, because on IT services, we are not seeing any kind of green shoots as of now. And now with reports like TCS going with aggressive layoffs, it can further go down, because on contract employment, it has already got corrected substantially. So now the numbers that they're talking about are largely on full-time employees on their roles. So on IT services, as of now, we are not seeing any kind of indication in terms of pickup in hiring trends. So the current sluggishness may continue into this year as well. However, on the other side, the IT hirings in GCC captive companies and non-IT companies, like because many non-tech companies are also setting up large tech teams for their internal digital projects and transformations, digitizations, those kind of aspects. They're all setting up their own large teams internally. So there the hirings are very good. So, but these numbers may not offset the job losses or the sluggishness of overall hiring on IT services. In terms of volume, they may not be able to offset. But for niche skilled people, there are still openings in GCCs and captives.
Mr. Mani, just wanted to get a sense in terms of how exactly is AI affecting hirings, if that's the case as yet?
To some extent, but it's very difficult to kind of translate what exactly is the impact of AI on jobs, because it is increasing the productivity of existing base, and companies are also using AI tools as one of the major drivers for cost savings. And definitely it is having an impact, but if you ask me to translate that into either a number or saying the entire impact on hiring, is it solely because of AI? Definitely not, because the global IT headwinds, drop in overall discretionary IT capex, these are the main reasons for not having a pickup in IT hiring. And also AI to some extent, but I would put that in the least of the concerns right now. Mainly would be macro headwinds.
That's macro headwinds that you are citing as reasons for weakness. But, Ms. Dadi, what we also understand is that a lot of the blue-collar jobs are now in serious demand. And that is a growth opportunity for a lot of companies that are in verticals like this. Are you looking at this as an opportunity? Do you have any, revenue coming in from this vertical?
Definitely, because for us, the largest chunk of our business is mainly into grey collar and blue collar. White collar, we do under our specialized staffing segment, but that contributes to roughly about 5% of our revenue. But the rest of the business is mainly into these segments. And as you rightly mentioned, there we are seeing significant pickup in demand, and specific to blue collar industries like manufacturing, infrastructure, engineering, pharma. So there we are seeing very good demand in the coming quarters.
Could you give us a sense of what proportion of your business comes in from there, and what are the margins like in that business?
See, broadly for us, our largest segment is BFSI, but there it's largely grey collar and white collar. We don't do blue collar. BFSI contributes to about 22%, followed by FMCG, FMCD, retail, that's another 20%. Manufacturing is about 12%. Again, if we take industrial, engineering, pharma, these kind of sectors, that would be another 8 to 9%.
Ramani, are you still seeing a bit of a slowdown in that BFSI sector, which you were seeing in the last couple of quarters, or are we seeing a recovery here?
We are expecting a recovery in Q2 because this year the monsoon has been good and the festive season outlook is also good. So as of now, we are getting very good pickup in the open position specific to BFSI sector, because over the last 1 year, we have faced heavy headwinds in BFSI, both on NBFC side as well as last year, even on the bank side. So Q1 is also kind of flat as far as BFSI is concerned, but the open positions for the upcoming festive season in BFSI are good. So
okay, GCC is currently 64% of your revenue. How much do you probably expect it to grow to? And in Q2, how many clients are you probably going to onboard from GCC?
I may not be able to give the exact number of clients because we are having very active discussions, and some of the largest GCC setups are under discussion for onboarding in the next few quarters. So this percentage this year we are targeting to end by about 70%, to take the current 64% to about 70% to the GCC share.
Okay, that's great. 70% will be the GCC share that will come in for the specialized staffing side as well. Thank you so much, Ramani, for speaking with us this afternoon. But on that note, we're going to slip into a very short break. We'll get you more on the markets and stock-specific action on the other side.
Welcome back. Well, still pressured for the market. So we have the mid-cap index, which is down around 0.6%. The advanced decline ratio also firmly on the declining side. So it's currently standing at around 1:2 on the Bombay Stock Exchange. Talking about specific stocks, however, from the broader end of the market, we do have a couple of movers. So Kaynes Technology, we did speak to the management yesterday. That stock is currently up around 3.8% and it's done well for the entire week. It's up around 12.5%. So doing well for that particular counter. We also have a couple of others such as Affle in Industries, which is up around 9.6% on a week-to-date basis. But overall, texture of the market is definitely on the negative side. Let's see what the second half holds. It's a wrap on Halftime Report. Business Lunch will take all of the action ahead. Stay tuned.
Stocks trade soft but ranged after Trump imposes 25% tariff on India, higher than most trading peers. Healthcare and oil and gas are the big drags, while FMCG eke out gains.
Sun Pharma takes a beating on concerns that after Trump's directives to 17 global pharma names to make drugs more affordable, the company's innovative portfolio may be targeted. This basket accounts for 20% of Sun Pharma's sales.
Swiggy's quick commerce losses mount even as food delivery profit expands. The digital platform calls this the peak of QCom losses, drawing buy calls from analysts, but the stock slips on profit taking.
Girish Kosgi, the managing director of PNB Housing Finance, quits much ahead of its term ending. Worries over the lender meeting its set targets now spooks the stock following key exits. PNB says that his resignation is only due to family commitments. Good afternoon. You're with us here on Business Lunch. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Hormuz Fatakia. With me as always is Mamakshi Dhuria. Mamakshi, good afternoon. We're finally coming to the end of what has been an absolutely crazy week, if you could call it that. And it looks like it's going to be a fifth straight weekly loss for the index.
Well, absolutely, Hormuz. You know, at least the bulls will be saying, thank God it's Friday, because you cannot trade for 2 more days and the markets cannot fall for 2 more days because it's the weekend. It's been an absolutely, bad week for the bulls, if you can call it that. The Nifty for now is trading close to the day's lowest point, down almost 125 basis points. The mid-cap end of the market is also taking a very sharp knock today. It's down almost 0.7%, and that is reflected in the advanced decline ratio, which has been broadening since the get-go. But lots of stocks that are reacting to their numbers. Take a look at Indegene. That stock is up almost 6% today. Chalet Hotels earlier in the day was up almost 17%, but it has now cooled off. It's trading close to the 950 odd mark. It's still trading in the green with a gain of almost 4%. But what's not doing too well is the Pharma pack. Take a look at all of these counters. Sun Pharma is down almost 4%. Aurobindo Pharma is down almost 4.5%. And that comes after Trump has directed pharma companies on cutting the drug prices under the most favored nation order. So pharma stocks under pressure as of now, Hormuz.
Indeed, and there are a lot of other earnings reactions as well, right? Barring pharma names, a couple that I wanted to highlight. Adani Power is one of them, just came out with numbers. The board also has approved a 1:5 stock split. So Adani Power, the stock is now at the lowest point of the day, 2.25% lower, and the other one is Godrej Properties. That came out with numbers. They've managed to, on the guidance front at least, they have managed to achieve 21% of their launch value, 22% of their booking value, and 17% of their customer collections for the full financial year when it comes to the guidance. But the fact that the company reported an EBITDA loss this time around, and the stock is down 1.5%. So we are still counting down to some other major numbers from ITC, from Tata Power. So keep an eye out on those names as well. MCX is the other one that you need to keep an eye out for. Numbers to be out later in the day. But going to the top story of the day, and the tariff deadline has now arrived, with US President Donald Trump signing an executive order that modified reciprocal tariffs on several countries, with updated duties ranging from 10% to as high as 41%. Now, the Trump administration has stuck to the 25% tariff on India, making it the highest in this region. However, the quote-unquote additional penalties which Trump had threatened to impose on India for doing business with Russia still remain unclear. The modifications shall be effective with respect to goods entered for consumption or withdrawn from warehouse for consumption on or after 12:01 a.m. Eastern Daylight Time, and that is 7 days after the order has been signed. White House Press Secretary Caroline Leavitt said that almost 200 countries have reached out to the trade and tariff teams, and added that countries which do not have a deal will hear from the administration by midnight. Listen.
So yes, tomorrow, August 1st, the reciprocal rates will be going into effect. If more deals are cut between now and midnight, I will never count out the president. You've seen him do it before. He cut 3 deals in 1 day very recently. So we'll see what happens. I do know foreign leaders are ringing his phone, realizing this deadline is a real thing for them tomorrow, and they're bringing offers to the table. Well, there's a lot of countries that I know have reached out. I believe it's upwards of 200 countries around the world have reached out to the trade and tariff team. Of course, as I said previously, and the president said, we're going to prioritize our key trading partners, which we have done. Like I said, of the 18, 2/3 of those we have cut these tailor-made deals with. But I do know that the trade team has been working around the clock to try to be in correspondence with as many countries as possible. But if they haven't heard from us yet, they will in the form of a letter or an executive order by midnight tonight.
Well, Parikshit joins us now with more details on the tariff-related announcements. Parikshit, take it away.
Well, the White House has announced reciprocal tariffs, and India has got a 25% tariff as expected. Now, this is the highest in South Asia. Let's look at some of the other countries. Afghanistan has got a 15% tariff. There's a 19% tariff on Pakistan, Cambodia, Thailand. Bangladesh and Sri Lanka have been hit with a 20% tariff. So this makes India the highest tariff region in Southeast Asia. The August 1st tariffs, we were told by the White House, will be implemented from the 7th of August. The White House spokesperson told CNBC-TV18 that this is not to be seen as an extension of the tariff deadline, but only time given to the Customs and Border Protection in the United States to implement these tariffs effectively. Similarly, the exceptions that were there on the 2nd of April, that is on pharmaceuticals, on semiconductors, on lumber, critical mineral, energy and energy products, all of those exemptions to continue. Exemptions for sectoral tariffs, such as steel and aluminum, which are as high as 50%, sectoral tariffs on auto, which are as high as 25%, those sectoral tariffs continue and are exempted from these latest tariffs. So, which means that it doesn't mean that autos will become 25 plus 25 and aluminum and steel will become 50 plus 25. They will remain as it is. No additional penalty for India as yet. This could be decided in the next few days, and that's why India is in a wait or watch mode. The US has made it very clear, and Marco Rubio said this to Fox News last evening, that India's purchase of Russian oil, despite there being so many alternate sources of energy, is an irritant in talks. And both Scott Bessent and President Trump have been indicating that they are frustrated with India with the pace of the negotiations.
Eicher, thank you for those updates. And moving on to the pharma space, which was the other big announcement overnight, Caroline Levitt also added that Donald Trump has written letters to big pharma companies to provide most favored pricing for American consumers. Listening to what she had to say before we get Ekta in on this.
The president signed an executive order earlier this year to solve the problem of exorbitant pharmaceutical pricing. According to recent data, the prices that Americans have been paying for brand name drugs are more than 3 times the price other similarly developed nations pay. The president is determined to solve this problem and took further action today. He has signed 17 letters to pharmaceutical companies' CEOs. Moving forward, the only thing I will accept from drug manufacturers is a commitment that provides American families immediate relief from the vastly inflated drug prices and an end to the free ride of American innovation by European and other developed nations.
Well, let's put the spotlight on Sun Pharma because that stock has taken a beating on concerns that after Trump's directive to 17 global pharma names to make drugs more affordable, the company's innovative portfolio may be targeted. We now have Ekta joining us with all of those details. Ekta?
Well, yes, pharma stocks are in focus today as US President Donald Trump has sent letters to 17 major global pharmaceutical companies, including the likes of Eli Lilly, Pfizer, AstraZeneca, Novo Nordisk, strongly urging them to reduce the US branded drug prices and align it with those charged in other regulated markets such as, for example, Europe. While there is no immediate impact on generics, analysts warn that the long-term addressable market for generic drug makers could possibly shrink. This, coupled with already existing issues such as pricing pressure, could pressure the generic drug market in the US and possibly even result in rejigging long-term plans such as, for example, in licensing deals. For Sun Pharma, besides earnings, which I will just get to, the spotlight is also on its global innovative medicines portfolio, which includes branded drugs such as Ilumya, Sequoia, Lexelvi and Winlevi. This segment, which accounts for nearly 20% of its total revenue and grew nearly 17% year-on-year in the fourth quarter to $311 million, while the company has not heard from the US administration, analysts point out that any move to cut US branded drug prices could possibly result in the company reducing their specialty drug prices as well. And when it comes to earnings, the company has also flagged that its effective tax rate will normalize to 25% from 16% earlier. This has resulted in a few EPS downgrades, with some analysts cutting their FY 26-28 core EPS estimates by anywhere between 8 to even 13%, but most of them have maintained their rating on the stock. Adding to the uncertainty on pharma, while pharma is currently exempt from tariffs, the pharma imports into the US are being reviewed under Section 232, which is a national security provision typically used to evaluate whether certain imports pose a threat to the US interests or not. Analysts believe it is a medium-term overhang, and any adverse finding under Section 232 could have major implications for Indian drug makers. India, remember, exported $11 billion worth of pharmaceuticals to the US in FY25, accounting for 35% of total pharma exports and nearly 47% of all prescriptions filled in the US in 2022.
Indeed, pharma names taking it on the chin today, and Sun Pharma in particular, that is the top Nifty loser. We also spoke to the company's CFO, Jayashree Satgopan, about the impact of these letters written by Donald Trump to pharma companies to provide the most favored pricing for American consumers. Listen in.
As of now, we have not received any letters, and as and when there is a further development, we will be in a position to assess it for our specialty portfolio. As and when we get the letters from the US administration, this could have an impact on some of our specialty products. At this point in time, the investigations under 232 is going on. Post that, we will get to know what is the thinking around the tariffs for the pharma sector. So we'll have to wait and watch on this front. And as far as the generics are concerned, we also need to consider the supply chain, the economic considerations of manufacturing in India versus US. All of these will be looked into on a case-to-case basis as and when. We do have 3 facilities in the US, and at this point in time, we are not considering expanding the facilities further.
Well, that was the CFO of Sun Pharma highlighting that they do not have a letter from the US administration yet, but if that could come into place, they could see a hit on their specialty products. But take a short break, then we'll get you more news and updates on the other side, so don't go anywhere. Welcome back. You're watching Business Lunch on CNBC TV18. Well, let's put the spotlight on the casualty of the day. PNB Housing is the stock that I'm talking about. The stock is down and out in trade today as the company's MD and CEO has resigned. Earlier, in fact, we spoke to the CEO of PNB, Ashok Chandra, about Girish Kousgi's exit from PNB Housing. Let's listen into that conversation.
Nothing from the promoter side, nothing from any other shareholder side. In fact, he has some family commitments at Bangalore, and that is the only reason for which he has put up his paper. Otherwise, nothing to be seen other than this now, in this particular case now. See, as a promoter, I can only tell that we don't see any challenge in this. This is the personal reason he has cited, and he is moving to Bangalore. I think PNB, the HFL, this board also, they are going to have some investor meet today, and they will clarify all those issues. But we don't see any big challenge, anything happening.
Well, that was PNB Housing Finance, the promoter of PNB Housing Finance, that is PNB, and clarifying about the issues there at the company and saying that there is no such issue currently and it was only personal commitments is why Girish Kousgi has quit. But it is that time of the month, it is the first day of the new month, and on expected lines, we are getting a slew of auto sales data coming in from various companies. Sudarshan is here to summarize all of those companies that have reported results so far. Sudarshan, how do the sales figures look like?
So far all the companies which have reported sales for the month of July, sales are looking largely in line or slightly better than estimates. So we'll start with two-wheeler companies. Bajaj Auto has reported earnings in which domestic sales remain under pressure while exports continue to do very well. Total sales here were up 3%, but if you look at the segment-wise, domestic sales were down 13%, but exports have seen an increase of 30%. That's the reason the stock is slightly higher. Coming to Eicher Motors, total sales continue to do well, have seen a jump of almost 30%. And here also it's led by export segment, which has seen a growth of 95%. But for Eicher Motors, the contribution of export segments is very low. Here, domestic segment has not done that great, but largely in line with estimates. For M&M, SUV continues to do well and led by SUVs, which has seen a growth of 27%. Total sales have increased of almost 20%. In the tractor segment, total sales have come in slightly below estimates, but it was largely in line, or say it has also seen a growth. For Escorts Kubota, it has seen a muted growth of just 2%. Coming to last, Ashok Leyland, sales were much better than estimate. Total sales have increased by 8%, which was led by MHCV segment. That has seen a growth of 13%. And in the bus and truck segment, bus segment continues to do very well, and that segment has seen a growth of 42%, and truck sales have seen a growth of just 4%. So overall, so far, sales have largely been in line or slightly better than estimates.
Well, thanks so much for that, Sudarshan. That's the whole roundup of all the auto numbers that have come so far during the day. But moving on then, hospitals like Max and Apollo won't be able to compete with PB Health. That's the word coming in from Yashish Dahiya, the chairman and group CEO of PB Fintech. Listen in to the excerpts of the exclusive conversation as Shireen Bhan quizzes him on PB Healthcare and PB Fintech's growth roadmaps.
You have to understand, I changed the incentive. I did not become a better seller. I changed the incentive so that I was no longer in competition. That's what I'm doing here. I'm changing the incentive structure altogether. So nobody is competing with me.
Yeah, so you're not up against the Max and the Fortises of the world.
How will they compete with me when I start reducing the incidence rate? They don't want to do it. Because I know where we are headed, and it's a very good future from a market's perspective. But there's no point saying it, because it'll take time.
Yeah.
And I don't want to live that time saying, I say things. What did I say? We will make 1,000 crores of profit in 27. We'll do that. What am I now saying? We'll do 1 lakh crores of insurance premium in 2030. So I say things. I say things which I'm okay to have an argument about. If I have my customers whom I say that, listen, you'll have a walk-in, walk-out experience at hospital, at any claim, right? People should be willing to take that. I think 4 years is 1 lakh crores of insurance premium.
Okay.
That puts you at a pretty large scale, right? And I think we'll be growing from then on also. We'll be part of the solution, not part of the problem.
So this 40-50% growth rate, you think is sustainable?
I just said 1 lakh crores premium. Do the math. Last year we were at 23,000 crores. From that time we have 5 years. So all I'm saying is we are quadrupling in 5 years.
Yeah.
that's pretty average for us, right? I think the real issue, I would say, is when we do that, we will be the solution, not the problem. See, you can be the problem by becoming large because you're causing more and more difficulty for the consumers, for your industry, for the social security in the country. We will be the solution, not the problem. When I look at 15 years, I think we'd be a very, very large player in social security, healthcare, pensions, life insurance, and child education.
Yashish Daya of PB Fintech. Take a short break. More news and updates on the other side. Stay tuned. Welcome back. Now, the Election Commission has announced the schedule for the election of the next Vice President of India. As per the Election Commission schedule, the last date for nominations is the 21st of August, while the date for polling is the 9th of September. Now, the votes will be counted on the same day as the polling takes place.
Well, as international criticism grows over the humanitarian crisis in Gaza, U.S. envoy Steve Witkoff meets Israeli Prime Minister Benjamin Netanyahu to try and get more aid into Gaza. NBC's Matt Bradley is here with more details.
In the midst of growing criticism of Israel over the humanitarian crisis in Gaza, President Trump's envoy Steve Witkoff meeting with Israeli Prime Minister Benjamin Netanyahu. President Trump has described some conditions in Gaza as starvation.
Those are kids that are starving. They got to get them food, and we're going to get them food.
while the president calling out Hamas, posting the fastest way to end the humanitarian crisis in Gaza is for Hamas to surrender and release the hostages. The U.S. and Israel blame Hamas for blocking a ceasefire deal. The Hamas-run Gaza Health Ministry says the death toll from hunger in Gaza has risen to nearly 160 people, more than half of them children. Since Sunday, Israel has been allowing more aid drops from the air, hundreds of desperate Gazans carrying away sacks of food.
What we're seeing here is a crime scene.
These American doctors in Gaza warn for the most vulnerable, help may be too late, inviting Witkoff to visit their hospital when he comes to Gaza tomorrow.
It's not unusual to see 5, 7-year-old children just pass out and to be disoriented from lack of food.
And for the first time today, several Arab and Muslim countries issued a joint call for Hamas to disarm and relinquish power in Gaza.
With that, we call time on this edition of Business Lunch. We leave you with the market seeing some recovery from the lows of the day. From Ramakshi and me, thank you for watching. Midcap Radar on the other side.
Good afternoon. Welcome to Midcap Radar live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me is Vivek Iyer. Well, we saw that sharp fall from the highs. We were down around 90 points at a point in time. But there's some recovery which we are seeing right now. But we'll have to see whether that sustains or not.
That's right. So it's a very muted start as far as the August series is concerned. We actually saw quite a bit of a sell-off. But in the last half hour, what markets are attempting to do is to manage or attempt a very slight recovery. What is it that is leading the recovery? Well, some of the PSU banking stocks, they are doing quite well. Indian Bank, that particular stock near the day's highest point. Some capital market players, they are doing quite well. But we have a lot lined up on the show. So let's start off with the top headlines. Stocks trade soft, but ranged after Trump imposes 25% tariff on India, higher than most trading peers. Healthcare and pharma are the big drags, while FMCG ekes out gains. Mid-caps under pressure.
Girish Kousgi, the managing director of PNB Housing Finance, quits much ahead of his term ends. Worries over the lender meeting its set targets spooks the stock following key exits. PNB says his resignation is only due to family commitments.
Nifty Pharma index under pressure after US President Trump sends letters to 17 global pharma companies to equalize prices of US branded drugs with other regulated markets. Aurobindo Pharma, Granules and Glenmark down over 3% amid profit booking.
Netweb Technologies up nearly 9% after strong revenue growth in Q1. AI workstations saw 300% YY growth. Management tells CNBC-TV18 that they have increased the AI contribution guidance to 22% versus 20%. They will also continue with the 40% growth level.
Radico Khaitan shares surge over 5% after it sees a strong Q1 with volume growth of over 37%. The management tells CNBC-TV18 that they expect the prestige and above volume growth at 15% in the next 3 years.
Those are the top headlines that we are tracking, but a lot of action which is happening in the mid-cap space as well. So let's go across to Hormuz. He's joining us with the mid-cap movers that we have today. Hormuz.
It's an interesting day for the broader markets, and it's turning out to be yet another down week, of course, make no mistake about that. We start off with some of the movers then from the broader markets on the gaining side, though, some that are bucking the trend. You take a look at Hester Biosciences, that stock is up around 18% now. This is a very sharp spike that it saw. Nelcast continues to move higher. We spoke about it yesterday as well. And Matrimony.com has moved down on the list of gainers, now 8% higher on that stock. Earnings are coming in thick and fast, awaiting more results later in the day. But IIFL Finance was down yesterday, extending its losses now. Niva Bupa too, a result reaction down 6.5%. And GSK Pharma came out with numbers a few minutes back. That stock too is down 5.5%. Among the newsmakers of the day, of course, can't not talk about PNB Housing. The casualty of the day, 17.5% lower. Suzlon, first day as an FNO stock, 7% higher here. And Vari Energies too, seeing good gains today, 4.5%. A segment that has been sulking through the day is Pharma, and most of the stocks on the Nifty Pharma index trading with losses at the lowest point of the day, be it Aurobindo, be it Gland, be it Strides, all of them seeing losses of anywhere between 3 to 6%. And lastly, some of the other movers in the mid-cap space on the losing end, Credo Brands as an earnings reaction here, 20% lower circuit for the stock. KPR Mills, of course, the textile names continue to bleed today as well, 6% lower here, and ASK Automotive too at the lowest point of the day. Back to you guys.
Thank you so much, Hormaz, for taking us through all of the movers as far as the broader end of the markets are concerned. Before we slip into a short break, here's a reminder for our viewers. You can unlock a world of exclusivity, expertise and influence. Become a member of CNBC-TV18 Access, our prime members-only experience on CNBC-TV18.com. The membership includes access to CNBC-TV18's flagship events, interactions with our journalists, along with curated studio tours, e-learning sessions and master classes, and curated lifestyle benefits.
Welcome back. You're still tuned into Mid-Cap Radar. LG Balakrishnan, that's the first management on the show, reported a subdued set of Q1 numbers. Exports continue to be a concern. We are now joined by B. Vijay Kumar, who is the chairman and MD at the company. Mr. Vijay Kumar, good afternoon. Thank you so much for joining in. Well, Q1 earnings have been muted versus what was expected in general as well. Profits are up just 3%. Margins have declined on a YOY basis. But you have managed to achieve targeted revenue growth. And for FY26, you are targeting a growth between 10 to 14%, and in Q1 the growth is around 15%. Are you on track to achieve the levels that you had indicated earlier? And there's so much happening in the exports market currently. What's your take on that one?
The Trump taxation is new, so that opens up a whole new area. So the export is going to, I feel the export will be subdued for a lot of companies, and we will also be part of it.
Understood that. Mr. Vijay Kumar, at the end of the last quarter, clearly there was a worry, especially in terms of the industrial chains business, especially when it comes to the export market. So what is the kind of slowdown that you witnessed over there? Q2, H2, do you expect any kind of incremental improvement as far as the demand environment is concerned?
In Q2, one of our major markets was the US. We were targeting the US for our industrial chains.
Right.
So that will be a little slow, but it is not going to hamper our overall performance.
What is your exposure to the US markets, Mr. Vijay Kumar?
Our US market is currently about 100 crores.
About 100 crores?
100 crores.
Okay. And is there any indication as to what will happen to those exports currently? It's 25% tariffs that has been announced. Have you had a word with your consumers, your customers, because it has just happened?
There's a lot of confusion, so nobody really knows what is going to happen. My gut feeling, we will probably stabilize around 10%. So we have to wait and see what will happen.
Okay, so you're hoping that it settles around 10%. Any initial assessment, number one, will you absorb part of the hit or will you be passing it on to the customers? Any kind of assessment that you've done? And the second part of the question, sir, are you holding on to your revenue growth target of 10 to 14% as far as FY26 is concerned, or will you trim that lower?
No, I will answer the second part first. We are holding on to the 10 to 15% growth. 10% definitely. And depending on the stabilization of the export markets, maybe we could go a little higher. But the first part of your question,
in terms of the assessment, will you absorb or will you pass it on, sir?
No, we don't know yet.
Okay.
If we can absorb on a long term, then obviously the buyers are not doing their job properly. We can't have a margin of 25%. So it's not possible to absorb 25%. That's why I feel that anyway it has to come down to about 10%. Even that will have to probably be shared. So this is why I said in the last quarter itself that our net profitability may take a little bit of a hit.
Got it. Mr. Vijay Kumar, I wanted to generally understand what kind of capex plans do you have for FY26? What was the contribution from new generations facility that you saw in FY25? Some market share improvement, will that be the outcome of any additional capacity?
We are looking for not additional capacity, we are looking for other products that we can get into and other markets that we can get into. We are studying the possibility of getting into some operations in Vietnam or Cambodia. So all this is going to take a little time. But we also have plans through our subsidiary to put up an operation in Mexico. So whether that will help us overcome the tariff barriers also, we have to study.
Understood that, sir. Quite a lot of uncertainty is what you are looking at currently. So, in another structural question, in terms of content per vehicle, you quite good when it comes to the ICE segment. Now, when it comes to the EV part of the business, has the scale-up been according to what you had initially envisaged, or is it slower than expected? And going forward, what will be the revenue mix like?
It's been slower than what I expected, so I really can't answer that question. Unless the EV pickup is there, we are only a supplier. We are not manufacturer of the full product. So we have to wait and see.
Okay, it is a developing situation, so we'll get a lot more answers in quarters to come. Thank you so much, Mr. Vijay Kumar, for joining us and being candid about the outlook, especially on the export markets. They have 100 crore sales coming in from the US, and they expect it to slow down or see some slowdown in quarter two itself. With that, we'll slip into a break, but remember to tune into the all-new CNBC TV18 Prime, bringing you insights from policymakers, business leaders, and economists shaping both the world and India's future. CNBC TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune into CNBC TV18 Prime at 12 noon for the Global Reset, at 1 p.m. for the Big C, and Global Lens at 8:30 p.m.
Welcome back to Mid-Cap Radar. Well, the next company on our radar is Inventress Knowledge Solutions. It reported a stable set of Q1 numbers. The company reported a stable revenue growth and margins improved on a year-on-year basis as well. We are now joined by Nithya Balasubramanian, who is the CFO at Inventress Knowledge Solutions. Thank you so much, Nithya, for joining us. Well, what the first question is, revenue growth for the company has essentially been in the range of 15 to 16% in the last 3 quarters. Will that sustain going forward, FY26? Can you quantify the guidance as far as the 3 main parameters are concerned? And what are the incremental growth drivers for you?
Thank you for having me. We're obviously pleased to report another strong quarter and strong set of results. I think we've always maintained that not just in the next quarter, not just the next year, but over the next 5 to 7 years, we would want to continue to grow faster than market. Our market is, the outsourced market in the US is about $34-35 billion, which is expanding at about 12%. And we want to be able to consistently beat that market growth so that on an ongoing basis, we continue to gain market share. So along those lines, therefore, this quarter as well, we have reported a 16% growth in revenues. And of course, a much higher growth rate in terms of EBITDA. Our margins came in at 32%, which represents a 36% year-on-year growth. The margin expansion is also reflective of the business transformation that we've achieved in the equity asset that we had acquired a couple of years ago.
Nithya, you're talking about this growth to continue over a couple of years that would come by, and your top 5 customers, that's where the revenue has been increasing, the share has been increasing as well. Can you give us a sense of, is it particular to a certain geography that you're seeing that kind of growth? Is it particular segment? If you can throw light on what kind of percentage share will you get from top 5 customers down the line?
So the growth is actually being quite, it's actually across the board, right? So one, in terms of geography, our focus is entirely in the US market. So all the growth that you're seeing is actually coming from the US market. But within the market, if you look at different market segments, I think our growth has been fairly secular across the various segments as well as the different features of the platform that we offer. We have seen growth from new customers and new new deal wins. We've also seen growth from our platform customers continuing to scale up. And we've also seen our land and expand strategy with our existing older customers also play out. So it's a healthy mix across the board, and therefore we believe it's sustainable going forward as well.
Got that. Nithya, the other question is, as far as a couple of your top clients are concerned, quite a bit of transition going in over there. Number one is Palomar, there could be a change of control over there. The second one is United Health. Remember last time we had you on the show, we spoke about United Health and the troubles that they were facing. Now, given that churn, do you continue to stay confident of growth as far as these particular clientele is concerned?
No, absolutely. I think both of these are very important customers for us and growing customers for us. Palomar, if you will remember, was our first customer for our entire platform. So they've bought all 16 features of our platform from the get-go, and it's a very long-term, 15-year deal, in fact. So our relationship with them continues to grow, and we continue to get to 100% implementation of all 16 features of our platform. And in fact, more recently, I think what's been in the news is that they're in conversation with UC San Diego, which is obviously one of the largest health systems in the US, about a potential partnership. So we believe that that signals to us continued health of Palomar, the Palomar health system. And of course, we are cautiously optimistic about the opportunity that brings to us as well in the future.
Okay, you briefly mentioned, how the asset equity has been performing. Going forward, what is the kind of ambitions that you have over there? And Nithya, a quick word on how the entire emerging tariff situation, could impact the pharma market in the US. And do you see any spend impact as far as your own prospects are concerned?
So your first question was on equity and what we hope to see in the future, right?
Right.
So I think for the large part, there were 2 very important reasons why we bought equity. One is, of course, the margin transformation that we could achieve through a deployment of IKS's technology, as well as getting the right balance of the onshore-offshore mix. I'm very happy to report that a large part of that transformation is already played out, which is what is reflected in the very healthy margins that we've posted. The second big vector why we acquired equity was actually the cross-sell opportunity. Again, very happy to report that we have started seeing green shoots In fact, last quarter as well, we had mentioned that there are 4 cross-sell wins that we have now been able to bank. And this quarter as well, we had reported expansion of a relationship with the top health system, which also is a cross-sell win for us. So going forward, you will start to see a ramp up of these deals that are now in the mix. And of course, we believe that there is more to come in the future. So that's with respect to equity. And to your question on tariffs, thankfully, I think the services, technology and services is outside the purview. We do not see any meaningful impact, therefore, based on the recent tariff conversations and the ongoing negotiations.
Take that point, Nitya. Thank you so much for joining us with your thoughts and outlook on companies' plans and growth going forward. That's the word coming in from IKS. So with that, we'll do one thing. We will take your leave on this edition of Midcap Radar. Stay tuned. Your stocks when we return.
Hello, good afternoon. You've tuned into Your Stocks coming live from the CNBC-TV18 Motilal Oswal studios. I'm Vinny Motiwala. Thank you so much for tuning in as always. Now, the markets seem to have seen a bit more of a decline coming in. As of now, 24,650 is what the Nifty is at, almost near the day's lowest point, down 0.4%. Let's pull out the broader end of the market because that's not doing well in today's trading session. That too is seeing a bit of an underperformance versus the benchmark indices. Nifty mid cap, that is down 0.6%, day's lowest point. Small cap also similarly seeing a bit further more of a decline coming in, and that is why that advance decline ratio clearly in the favor of declines versus advances that we're seeing, and the gap seems to have just increased through the day as well. At one point of time when Nifty was managing to hold on to that green, that slipped, and look at the lines. We're seeing more of declines coming in versus advances, and that is what we'll be keeping an eye out on. But where the bright spot is today is only the FMCG pack, which is managing to hold on to some bit of a gain. Other than that, Pharmas, ITs among the top sectoral losers in today's trading session. But that's how the market setup is looking like. Let's start with the show where we solve all your stock-related queries. And to do that, we have our independent market expert today joining with us, who is Shaina Mukaddam, as well as Vaishali Parekh, Vice President Technical Research at Prabhudas Lilladher. Vaishali, just a quick check in terms of the charts for the Nifty. What are we watching out for right now? We're just managing to hold on to 24,650 levels. What is the support that we have? What is the resistance that we have?
Very good afternoon, Vinny. Yes, the market has been very, very sideways. And I think with the way we are seeing erosion also, Nifty is just in a very narrow range, 24,550 to 24,500 on closing basis. That should act as a crucial support. So let's say 24,500. And now the upside is capped at 25,000 levels. So either ways, we see a decisive move will give us a further clarity as to which way the market is going. And Bank Nifty also is currently at a very crucial juncture. It's really at a make or break. 55,500 should act as a final support level for market to sustain in a narrow range. But if these levels break decisively, we could see further selling pressure coming in.
Okay, that's a word coming in there on the market front. Keep an eye on those levels there. But let's get started with the stock-related queries. The first query for today is coming from Shiva Raju, who's writing to us from Mumbai, holding 1,000 shares of Yes Bank at a price of 15 rupees per share, currently making slight bit of that profit. The stock is at 18.5 rupees. Wants to know if he can add more shares or exit. Shaina, what is your view coming in for Yes Bank right now? We'd obviously heard about those SMBC seeking that not to buy around 4.9% stake in Yes Bank. So what are we watching out for now?
Yeah, correct. So basically, they are looking at a price of about 21.5 rupees, which is, of course, higher than the current price. What I would suggest is that since the investor has gotten at a good price, he continues to hold. And any dip that he gets, he can add. Because, though they are going to buy 20% stake, it's not that, 100% of whatever you hold is going to get absorbed by them. So to that extent, buy it at dips. Valuation is not expensive. It's about 1.2 times book. And if you see on all parameters, fundamentals are improving, including first quarter numbers were quite decent. So I would say hold and add at dips.
Okay, hold and add on dips. That's a word for you on the fundamental front. On the technicals, Vaishali, would it be an add on dips kind of a chart as well?
And so currently it is really showing signs of improvement. But at the same time, I would say it's also at a support level. If 18 level breaks, then I think the trend can weaken further. But if this level is sustained, then I think we can see a bounce coming to 21, 22. But if longer term is the perspective, then the clarity and confirmation comes only about 22, 23 levels. So for now, I would just say follow the range and trade accordingly.
Okay, let's move on to the next query for today. We have Vikas Khanna, who's writing to us from Noida. It's an investment query that they have, and it's coming for railway stocks. How should they be looking at it in the next 3 to 4 years? He's looking to invest in Texmaco Rail or Titagarh Rail for the long term. Shaina, your view for the railway stocks and the two names that I mentioned, would you say that's the best bet in the railway sector right now? Or are there other names that you would suggest?
Well, these are good bets for the railway sector. They both of them have got good order book position. Texmaco has got about 12,000 odd crores of order book, and which is 5 times its current turnover. So the run rate is about, it's got enough to grow. And Titagar also is in a similar range. It's got about 14,000 crores of order book. But of the two, if I was to pick one of the two, I would go with the Texmaco, which basically is, half the size in terms of market cap compared to Titagar. Texmaco is about 5,500 crores of market cap. But in terms of all other parameters, they both are almost equal. I believe, after the correction of Titagar, not to say that it is not good, because the promoters themselves have actually issued themselves warrants at a higher price than the current market price. They have issued it at about 945 pretty recently last month. So I would say both the stocks are good. But if you're looking at maybe a 1 year, 1.5 year period, I would still go with the Texmaco if you're choosing one of the two, or both look decent.
Both look decent, but if you have to pick one, then it will be Texmaco Rail. That's the word from China. Vaishali, what's your view coming in? Is this what you would look at these two stocks, or are there any other railway names the viewers willing to hold for a 3 to 4 year time period?
Also, there is a stock called Jupiter Wagon that also is good according to me. Technically also, it looks quite fairly priced at this level. So I do like Jupiter Wagon along with Titagar Rails and the other stock.
Okay. Jupiter Wagon is another stock that Vaishali likes along with Titagar Rail. So keep an eye out on those names over there. Hope that was helpful. Let's move on to the next query for today. Ramesh is writing to us from Hyderabad. Long-term investor, and he's holding 60 shares of Route Mobile. Price is 840 rupees per share. Currently, the stock is trading at 884. Now, he wants to know if he should book profits or continue to hold the stock. Route Mobile, what are we watching out for here, Shaina?
If you're looking at maybe 6 months to 1 year, I would say you could take some profits off the table. The reason being actually that while the long term there is potential, and I still do think that the long term potential is good. At the same time, if you look at the first quarter numbers, the management themselves, the numbers were pretty weak, and the management has actually not really guided for 1 year, given the fact that average realizations are under pressure. Volumes are under pressure, especially in the domestic market. There are some important clients wherein some revenue softness could come in from there. So to that extent, I would say take some money off the table, relook at the stock after a couple of quarters.
Relook at the stock after a couple of quarters right now is the word coming in. And yes, like Shaina also mentioned that, it's nothing exciting in terms of numbers that came in from Q1. And specifically, since the time that numbers were reported around that mid-July time, we've seen that fall coming in for the stock as well. So Vaishali, on the charts and technicals, what's the view?
Well, chartically, it doesn't support a view for a buy, but only consolation is that even on a weekly chart, I'm looking at it, it's coming towards the oversold zone and perhaps would retest the 860 levels, which was the previous support. So if those levels break, that could call for further weakness. So according to me, it should be an exit right now. If he's already in profit, I think should book.
Okay, better to book. That's the word coming in from both our experts. We have some numbers also at the bottom of the screen right now. Tube Investments reported the numbers. Keep an eye out on that one. Margins seem to have seen a bit of a contraction coming in as of now. Revenues, a slight bit of an increase there. But yes, that's Tube Investments for you all. The stock is not doing pretty much anything, down 0.7%. Also, Maruti's numbers that we're seeing of auto sales also coming in. Total sales are up by 3%. Domestic sales also down 1.5% is what is flashing at the bottom of your screens. Keep an eye out on all this. But let's move on to the next. Actually, on that note, we're going to slip into a very short break. And, after the break, we'll come back and, we'll solve most of the stock-related queries. But here's a reminder for our viewers. Unlock a world of exclusivity, expertise, and influence. Become a member of CNBC-TV18 Access. Our premium members only experience on CNBC-TV18.com. The membership includes access to CNBC-TV18's flagship events, interactions with our journalists, along with curated studio tours, e-learning sessions, and masterclasses and curated lifestyle benefits. Welcome back to your stocks on CNBC-TV18. We still have with us our experts, Shaina Mukaddam as well as Vaishali Parekh, to solve all the stock-related doubts. Ladies, let's move on to the next query for today. We have Kiran, who's writing to us from Pune. He's holding 120 shares of Adani Wilmar. This is at a price of 537 rupees per share. Long-term investor wants to know the outlook for Adani Wilmar. Shaina, your view for Adani Wilmar, FMCG pack as a whole, what are we watching out for now over here?
And the main change that has happened in the recent past is basically Adani has actually decided to sell off its 31 stake back to the promoter, co-promoter Wilmar, and offload 13% of its stake to the public. Now, having said that, I would still say continue to hold. Actually, this news had actually seen a correction in the stock, quite substantial correction. But if you see at the current levels, valuations are not expensive. It's just about 3 times price to book. Also, first quarter numbers were pretty strong. It's the balance sheet is quite strong. So I would say you continue to hold while he's making, the investor is making money. I would say continue to hold.
Okay. Continue to hold. That's a view coming in. Actually, the investor is not making much money. Or
sorry.
At 537 rupees. Would you say that they should average also, because it's half the buying price of theirs right now?
Yeah, I would say so. He could look to average. Probably Vaishali can give technical level.
Absolutely. Vaishali, technicals, what should the viewer do? Because it's at 260, bought at 537. Interesting to add some more right now.
I would say actually, rightfully, the stock has been consolidating. There's really nothing happening in the stock right now. What we saw in the recent past, from 330 to 260. So I would say maintain a range of 250. 250, there is a long consolidation going on. So accumulation, so if you want to average out, 250 is the support level. So we are pretty much close to that. And I would say, well, add more if this stock sustains about 280. Because that would get this stock back into a trend, and perhaps from there on you can look at a target of 300, 330. So that's the way I would look at it. Right now, just add some more to average it out, but 280 to 290 levels is the level to watch, because that would be getting the stock back in the trend.
Okay, keep an eye out on those levels over there for Adani Wilmar. Now it's known as AWL Agri Business. Let's move to the next query. We have Gurbinder Singh Bedi, who's writing to us from Noida, holding 200 shares of Bharti Airtel. Price is 1,173, so they're making a loss on Bharti Airtel. And 120 shares of BSC at a price of 1,920 rupees per share, making a profit on this one. He is asking, what should he do now? Which one would be a better wealth creator for the long-term, and which one should he continue to hold? Shaina, so this is a question between BSC and Bharti Airtel. Which will be the better wealth creator?
Very tough question, because if you look at a 5-year history, BSC has given you a return of 4,000%. And if you look at Airtel, not bad, but it is still given a return of about 250%. So in terms of performance, BSC has outperformed. Now, if you take it from today, like let's go forward, I think both of them have their strengths. Like Bharti Airtel, of course, telecom is the backbone of Indian economy, and the growth that we're likely to see, at least 10%. We are talking of 10% ARPU increase over the next couple of years. So Bharti should do well. The management has managed their balance sheet very well. And I think there is going to be a decent growth, decent return over the medium term, long term period. Having said that, I personally also hold BSC for quite some time here, for quite a few years. And there, what I believe is the valuations are a bit more expensive. If you look at it over the next 2-3 years, it's about 55%, 55 times, P multiple. And also, if you look at it on almost all parameters, it is expensive for the shorter term. But having said that, I think in terms of the technology between the two, I think Bharti will have to keep investing in upgrading the technology. So it's going to be a more capital intensive industry, whereas BSC is not going to be that capital intensive in my view. So between the two, if I was to continue to hold for the long term, I would stick with BSC. But otherwise, you can add both of them and keep them in your portfolio.
Okay, can hold both also. It's not a good bet. Both can, continue to do well fundamentally also. If you have to pick one, yes. Shaina did mention her pick there. Vaishali, what's your view coming in? BSC as well as Bharti Airtel on the technicals and charts. What is a better bet right now for the longer term?
Well, so I do concur with Shaina that yes, I think the person can buy both. But well, I would not be in a hurry because Bharti also has seen a good run up. So if you get a chance at around 1800 levels to 1750, that would be a good level. And likewise, even for BSE, wait for a little bit more of a dip, perhaps towards 2200, 2000 levels. That would be really ideal, and that is a way that you can get good returns, because right now we are in a very iffy position as far as market is concerned, and both these stocks are concerned. In all likelihood, we can see further more corrective move coming in. So look for a dip to buy both these stocks.
Okay, that's the word coming in there for BSE as well as Bharti. Next query for today is coming from Soham Chatterjee, who's writing to us from Mumbai. He's holding 18,600 shares of IREDA. Price is 124 rupees per share. Currently making a profit on this one. Now, for the long term and short term, he's saying, what is the view coming in here? What is the target price that they should keep an eye out on? What would be the suggestion? If he's the long term view, should he continue to hold? And short term view also, if he wants to part sell some of his stocks that he's holding. And China, IREDA in terms of numbers, not a great set of numbers that came in Q1 FY26. So is it interesting and does it merit holding the stock?
I would say it is better to exit, because the main problem that they've had is because of Gensol. And there the exposure was close to about 700 crores, of which already in the first quarter the numbers were impacted because of, I think they wrote off around 275 crores already. But there's still something hanging back. So, and in terms of the cost also, in terms of their cost of loans, that's also, cost of funds is also going up. I would say exit for now.
Exit for now. That's your view for IREDA right now. And Vaishali, your view coming in for IREDA as well. What should the viewer do?
I think the stock has really given a good corrective move. So currently it's quite in an oversold zone. So I would say keep a stop loss of 140. Wait for it. Once it shows signs of reversal, it can go towards 160. That would be the level that you can exit. But keep 140 as stop loss. And maybe, it can show a bounce and you can get out at a better rate.
Okay. Next query for today is on Cochin Shipyard. We have Subramanian, who's writing to us from Chennai. 35 shares of Cochin Shipyard, which is bought at 2,311 rupees per share. Now, he wants to know whether there's a possibility that the shares would and the stock price would move up in the next 2 to 3 weeks, or should he just book out his losses? What should he be doing? Shaina?
I would say that looks tough, 2-3 weeks, because valuations are expensive. If you see price to book, it's about or EV by EBITDA. Let's take EV by EBITDA. It's about 20 times current year. Price to book is about 66 times. And Mazgaon Dock, actually, the numbers were so disappointing that the overall sentiment for shipyard shipping companies is like a little bit weak. Order book position is pretty strong, 22,000 crores. So if you're looking at the long term and you're looking to be in defense stocks, then yeah, you should continue to hold. Shorter term, I believe you could see some weakness, consolidation.
Okay. And that's a view coming in there. And also, the viewers just bought it at that peak because they said that they bought it around a month ago. Now, that's where it is at the highest level this year that we're seeing. Vaishali, your view for the stock, what should they do now, Cochin Shipyard? Should they just book out their losses?
I don't think so, because these are the stocks which are good for long term. Of course, with a trading perspective, please book loss. But if I were to give my view for a long-term perspective, the stock has corrected right from the high, and now it's coming close towards the crucial support levels. So 1550, 1600 levels is a very good support. So if time is not a problem, then add more at these lower levels and wait for a good reversal. And this way you can lower your cost, and when the going is good, you will get your returns.
Okay. If time is not a concern, then, maybe add some more and, you could see some recovery coming in there. But yes, if it's just a trading bet, then might as well just book your losses right now. Next query for today is coming from Ravi, who's writing to us from Hyderabad. He's holding 120 shares of HDFC Bank at a price of 403 rupees. Wants to know what should he be doing with the stock? Should he book out partial profits or continue to hold it? Shaina?
I would say continue to hold. In terms of valuation, over a number of years, actually, it's now at a very attractive level. and things are falling in place in terms of the merger now having fully, they're sort of taken it in their stride, and the balance sheet looks much better now, and the more aligning themselves in terms with what RBI had prescribed. So I would say continue to hold.
Continue to hold it is your view coming in. Vaishali, what's your view for the stock as well, given that obviously seems like the viewer is a long-term investor, right? Because they bought it at 403. So would you say book some profits or continue to hold the full part of their investment?
Banking stocks have given good run-up. So especially HDFC Bank, ICICI. I would say book partial profit because market can give you a chance to buy it lower again. So partial profit booking, according to me, should be done.
Okay, and averaging, is that also an option? And what levels can they look to average if they want to?
I would say wait for a dip because ICICI Bank also, I would say 1380, 1400 levels, and even HDFC Bank, perhaps 1900, 1850, that would be the level to watch for.
Okay, keep an eye out on those levels over there. But that was the last query for today, ladies. So thank you so much for joining in with us, Shaina, as well as Vaishali on the show, giving us your insights as well. But with that, we'll wind down this edition of Your Stocks on CNBC TV18. Remember, you can always email us your queries at the email ID that's flashing at the top of the screen for you all. But with that, it's a goodbye from myself as well as the team who put this show together. You have the last hour of trade that is still pending. Closing bell will take you through all that action.
beyond market headlines. To understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
The Taiwanese index is trading lower by 1%, and that is after a 20% tariff was imposed on Taiwan.
200 countries around the world have reached out to the trade and tariff team.
Certain critical minerals, energy products, those will continue to be exempted from reciprocal tariffs.
Way up resistance is the recent high of 24,956. 24,750 on the Nifty, 55,900 on the Nifty Bank.
With the Trump administration, everything is work in progress. Everything can change.
Nothing from the promoter side, nothing from any other shareholder side. In fact, he has some family commitments at Bangalore.
For now, Nifty flat with some negative bias, and it has continued to be quite volatile since morning as well.
And there is a further development. We will be in a position to assess it for our specialty portfolio.
Effective tax rate will normalize to 25% from 16% earlier.
What markets are attempting to do is to manage or attempt a very slight recovery.
$146 points lower. That is the latest. You saw, of course, the run-through, the read-through in terms of what has happened through the course of the day. It's been sideways to lower. The big story, of course, is pharmaceuticals. The Nifty Pharma index started about 1.5 lower, was down 2. Now, it's a 3.5% cut on the Nifty pharmaceutical space. This is Closing Bell. We are coming to you from the CNBC-TV18 Motilal Oswal studios. I'm Prashant Surabhi and Reema with me. Guys, afternoon.
Hi, good afternoon. And folks, I don't know if it's any comfort. We're not alone in this today. We can just say that. Look at how a lot of Asian markets have closed up, including markets like the Hang Seng or even mainland China.
Kospi, that's down nearly 4%,
Kospi, almost
3.9%.
Europe is down almost 2%. So while, of course, we always argue that some of these countries or many of these countries have got a better deal, trade deal than us, I think the overarching sentiment is that tariffs are overall higher. And that means overall, perhaps a pressure on inflation, maybe lesser trade, maybe more confusion. That's showing up in equity prices today.
It's just that the global markets were resilient up until now. Today is the first time you've seen that crack. For our own markets, we've had this slow, painful grind, and this would be the 5th consecutive week of losses. This week, we're down close to about 0.75% on the Nifty, and month to date, the Nifty is down close to about 3.5%. The mid-cap index is down closer to 5%, and all the indices are down, except in FMCG index. You've got cuts in consumer name, you've got cuts in IT, banks, Pharma, of course, has been weak, especially today. But barring FMCG, I think there is weakness all over.
Absolutely. I know the comparison with global markets, I think what you guys are saying is misery loves company. Right? So I think...
No, also the fact that it's a final reality check, because yesterday it became a White House document. Yeah. Till then, markets were like, dekhenge, we'll see, maybe there's more negotiation.
It's not, it's 7th.
So actual collection of the money.
No, I think it can change. I wouldn't say, anything is possible. But, you got lots coming up, and Pharma will be top of the pack right here. Ekta will run us through a potential impact in some detail in just a bit from now, right? Because this is the space where there is maximum concerted selling across the board. Look at that. So that's the new bit. PNB Housing, of course, is down 17%. Sharp cut after Girish Kousgi resigned as CEO and MD. We will get you, excerpts of our chat with the CEO of PNB on the program. In terms of earnings expectations, ITC is set to report, so we'll get you a preview a little later on the program. So that's what's coming up. So just quickly run through the index, 24,634. So we're down 130 points on the index, but we've still not broken the lows below which I think there'll be confirmation that perhaps there is pressure. And that low is very simple. That low is the low that the market made 2 days back, 29th of July. And the low was 24,598. That level was not broken yesterday, and that level holds even as things stand right now. And I think same is the case with the Nifty bank as well. We've yesterday's low matters. I mean, these are levels we put out in the morning as part of the sort of setup, and that level holds. It's not been violated. So it's lower. I think it's broader markets which I think are a bit more problematic. 2:1 is the decline to advances ratio as things stand right now. So 800, 850 higher, and you've got about 2,000 stocks which are in the red at this point.
So how should you position yourself in the last hour of trade? Mitesh is now joining in with a few closing strategies. Mitesh, afternoon, it's been a tough market the last couple of days. It's just been a grind down. Your thoughts, any trades in the last 1 hour, and how are we positioned for next week?
Good afternoon. So, I've been advocating that we might be range and chop around and not give a direction move. I think that's happening. But what has happened today is that the bank Nifty is slightly, turning on the weaker side. And if that kind of movement follows, then you might see that the bank Nifty will decline, which in turn, obviously, as we understand, will put pressure on the Nifty as well. So the level which I'm watching on the bank Nifty very closely is roughly about 55,600 to about 55,550 zones. And we are only about 150, 170 points away from that. In case we start breaking below that, then I think I will look for and prepare for a slightly deeper correction. 55,547 also happens to be the low for this week. So I think that could be an alert. Below that, I think, good chance that we are looking at about 800, 900 points kind of a decline, and we could see the markets turn weak. But as of now, just watching that level. On the stock side, I have Asian Paints. Had a good move in the morning and then slightly tapered off right now. But from the structure-wise, it's a positive structure. So would recommend buying here with a stop below levels 2405. And then, I will look at targets of around 2480. And ONGC is something which to me appears slightly weak. It's just trading above its pivot of 236. So sell below 236, 235 zones, then keep a stop at 240 and look for a 225 kind of a target.
Okay. Got that. Mitesh, just stay on. We want to talk to you about a couple of pharma stocks as well. But before that, let's get to Ekta. A lot of pharma stocks have seen plenty of profit taking today, and the cuts are ranging between 3% to as much as 5% on big names like Sun Pharma. Obviously, the overarching concern is what happens to Indian pharma exports. Remember, overnight developments, we've seen that 17 pharma companies, these are innovator companies, they have been sent missives by the US administration to make drugs more affordable. What does that mean for Indian companies, including the likes of Sun Pharma? Let's go to Ekta to find out. Ekta.
US President Donald Trump has sent letters to 17 major global pharmaceutical companies, including the likes of Eli Lilly, Pfizer, AstraZeneca, Novo Nordisk, strongly urging them to reduce the US-branded drug prices and align it with those charged in other regulated markets, such as, for example, Europe. While there is no immediate impact on generics, analysts warn that the long-term addressable market for generic drug makers could possibly shrink. This, coupled with already existing issues such as pricing pressure, could pressure the generic drug market in the US and possibly even result in rejigging long-term plans, such as, for example, in licensing deals. For Sun Pharma, besides earnings, which I will just get to, the spotlight is also on its global innovative medicines portfolio, which includes branded drugs such as Ilumya, Secura, Lexelvi, and Winlevi. This segment, which accounts for nearly 20% of its total revenue and grew nearly 17% year-on-year in the fourth quarter to $311 million, while the company has not heard from the US administration, analysts point out that any move to cut US-branded drug prices could possibly result in the company reducing their specialty drug prices as well. And when it comes to earnings, the company has also flagged that its effective tax rate will normalize to 25% from 16% earlier. This has resulted in a few EPS downgrades, with some analysts cutting their FY26-28 core EPS estimates by anywhere between 8 to even 13%, but most of them have maintained their rating on the stock. Adding to the uncertainty on pharma, while pharma is currently exempt from tariffs, the pharma imports into the US are being reviewed under Section 232, which is a national security provision typically used to evaluate whether certain imports pose a threat to the US interests or not. Analysts believe it is a medium-term overhang, and any adverse finding under Section 232 could have major implications for Indian drug makers. India, remember, exported $11 billion worth of pharmaceuticals to the US in FY25, accounting for 35% of total pharma exports and nearly 47% of all prescriptions filled in the US in 2022.
Thank you very much for that. Siddharth Bhambre from Asit C. Mehta Investment Intermediates is now with us on the show. Siddharth, thank you very much for joining in. First, give an overall broad comment on the markets and where we're headed. We've been in a bit of a consolidation funk, but we've got this negative bias for the last couple of weeks.
Good afternoon, Rima. Thanks for having me on your show. We are not very gung-ho about market from next 1-2 quarters perspective. We know that there's a lot of noise which is emanating from US, and predominantly, I think globally it's now known that US president really want interest rates to go down. So the interest outflow because of humongous outstanding debt reduces, which in turn would probably fuel reduced interest outflow would fuel its economy. But it's unlikely to happen anytime soon. So he's taking all the measures through which inflation could go down, and that's the reason you guys were discussing about pharma. Earnings, I think again, market is not expecting or was not expecting very big surprises from earnings. Despite that, we have seen that there are hardly any big positive surprises, and there are a few negative surprises at this point of time. So earnings have also, or I would say the depleted expectation of earnings, despite that, it has not, given any solace to market. And we are seeing, selling from FI as though, every one of us is talking about how SIP inflows or domestic institutional money is coming in. But FIs continue to sell this market. So all in all, we are seeing that from a near-term perspective, at least from this quarter and next quarter perspective, the upside in market is capped. And some of the growth sectors where, market look forward to, those sectors are in problem. And that's the reason we are not expecting anything to come in next couple of quarters. So I would suggest participants to play this market defensively. And we are not ruling out some more downside in this market in weeks or months to come.
Okay, that's the call overall on the market. Siddharth, hi, good to have you on. Specifically on pharma stocks, obviously there's a lot of fear around because they've been fairly resilient so far, especially large cap pharma names in an otherwise weak earnings environment. What is your house call? Do you still have some buys, or those who don't have a very long-term horizon, should they be paring their positions?
We don't have active coverage on pharma, but then, Surabhi, it was pretty evident that when Trump is out there to charge higher tariff to different countries, India, maximum thing which goes to US is IT and pharma. So it was expected that something would come on pharma. People are, asking a lot of questions that which sectors would get impacted. But I think it was pretty evident that IT and pharma would bear more brand. Though we don't track this sector very closely, I would suggest if somebody has to take exposure in pharma, and people should, because a lot of mutual fund guys would move into defensive space, concentrate on companies which have more of domestic market than export market, especially US. Sorry, I won't be able to add much because we don't track closely.
Got it. PNB Housing, I'm not sure if you have a view, because that's the story we want to address. Stock is down about 18% or so. We spoke with the CEO of PNB, Ashok Chandra, about Girish Kousgi's exit from the subsidiary PNB Housing Finance. Listen in.
Nothing from the promoter side, nothing from any other shareholder side. In fact, he has some family commitments at Bangalore, and that is the only reason for which he has put up his paper. Otherwise, nothing to be seen other than this now, in this particular case now. See, as a promoter, I can only tell that we don't see any challenge in this. This is the personal reason he has cited, and he is moving to Bangalore. I think PNB, the HFL, this board also, they are going to have some investor meet today, and they will clarify all those issues. But we don't see any big challenge, anything happening.
Any thoughts on this one, PNB Housing, Siddharth?
Well, broadly, Prashant, we are seeing that credit cycle is slowing down, and a lot of issues first came out from MFI space. Now MSME is suffering, and when Bajaj Finance says that there is issue in credit offtake or in MSME space, then smaller players would certainly would face the heat. So nothing to contribute on stocks, but on this stock. But I believe the pain in MFI is about to get over, but the pain in MSME has, I believe it's in nascent stage of reversing credit cycle. So I would certainly avoid investors, or I would certainly suggest investors to avoid this space as of now and stick to larger names where at least there is some double-digit credit offtake.
Okay, that's PNB Housing. Quite a disappointment today with Mr. Kowski's exit news coming through. Just looking at some more movers and shakers in the broader market. Obviously, consumer is an area of interest. I mean, it seems to be the only area of, well, quote-unquote, perceived safety. So, Trent, Asian Paints, Nestle, Lever, ITC. On the large cap screen, these are the names that are seeing some buying. I'm just trying to see what else is on the gaining tally beyond FMCG, if there are any clear trends. Well, not really. Some of the renewable energy plays like Suzlon and Wari are having a very good session today, by the way. Suzlon's up 7.5%, Wari is up 4.5%, and Radico, also part of consumer, and of course, decent numbers coming through once again. Radico is up about 3.5%. So let's take the consumption piece first. Now, this is where the market's hopes are resting. Which are the stocks you like here, if any at all? I mean, and it's across the board, right? It could be FMCG, it could be Alcobev, it could be QSR. Any picks?
We are very bullish over here. If you remember last month on your show, we were discussing about HUL when the change of management took place, and we were sounding quite optimistic. The space has, gone through tough times, and we have all seen that. Last few quarters, the growth was around 1%, 2%, both in sales as well as in volume growth. But now, if a company like HUL is giving you 5.1% on the sales growth, 5.4% on the volume growth, yes, I understand that the EBITDA has softened a bit, but that's how it goes. That first your top line numbers start doing well, and eventually it trickles down to margins. So I believe the space has suffered a lot in last 2-3 years because of first rural consumption coming down, then urban consumption going down, and now there are some traces of urban consumption coming back. And in last 2-3 years, valuations have also corrected a lot. And if you look at mutual fund portfolios, everybody today also is underweight. And with IT and Pharma not doing well, and with markets, in these kind of situations, a lot of churning is left where all these fund managers would start increasing exposure in FMCG space. So expect strong upside in names like, HUL. Last time also we spoke some of the names which we like in related spaces, Varun Beverages, though, there is issue of competition and sales bit slowing down, but the exports are growing well. I last time mentioned some of the names like Bikaji, which we are liking. So we are very optimistic over in FMCG space. And we are taking a top-down as well as bottom-up approach over here.
There's one stock, Credo Brands, that's locked in a lower circuit of about 20%. So that stands out in very, very large volumes today. More than 25 lakh shares traded. This is a company which manufactures men's clothing, casual men's clothing under the brand Mufti. And numbers were very weak. Revenues have fallen, profits have declined close to about 36%. And the company is talking about increasing the ad spend. So it's been hit by softness in spending, consumer spending, particularly in Tier 2, Tier 3. Numbers came out around, after 12, there was this big crash in the stock, 20% gone on that. All right, Siddharth, we'll leave the conversation here for now. The mid-cap index too is accelerating its fall. Now it's down 600 points, 1% gone. And the Nifty and the Sensex are down close to about 0.5%. Thanks for joining in. We get into a break, but before that, here's a reminder for all our viewers. Unlock a world of exclusivity, expertise and influence. Become a member of CNBC TV18 Access. Our premium members-only experience on CNBC-TV18.com. The membership includes access to CNBC TV18's flagship events, interactions with the journalists along with curated studio tours, e-learning sessions, masterclasses, and curated lifestyle benefits.
0.5% down on the Nifty, and it's not too bad compared to a lot of the other global screens. We keep repeating that. Perhaps Indian markets been sensing this, drifting lower because of its own reasons. A lot of other global markets are down between 2 to 4%, as much as, for instance, the South Korean Kospi. Now, trade remains the biggest headline out there, with India being slapped with 25% tariffs and still uncertainty continuing on what are the additional penalties, if any, that we will have to face. Parikshit is joining in. He's picking up some source-based latest inputs on this and where these negotiations stand, and if there's any hope at all of any sort of a breakthrough. Parikshit.
Well, government sources telling us that they are going to be watching the situation very patiently. The effort would be to negotiate, manage and resolve the outstanding issues that have been raised by Donald Trump. Yes, there is tension in the relationship, but the effort would be to somehow resolve this, considering the larger long-term strategic implication of the India-US partnership. Government sources also telling us that national interest will be supreme in all trade negotiations, including those with the United States. Under no circumstances can we compromise on agriculture and dairy. These are red lines in negotiations, and we cannot compromise on interests of farmers, which are a large section of the Indian population, especially those farmers which depend on subsistence farming. Also, because bloodstock in the US is fed with a protein supplement called blood meal, therefore, India will also have to keep religious sentiments in mind and also interests of dairy farmers. So these are very politically sensitive issues for the country. There are interests of a large section of the population involved, and we are going to try and convey this to the US. Now, when it comes to the energy partnership, India is saying that we have a strong energy partnership with the United States, and we will continue to buy more oil and gas from the US in the coming years. And this is a relationship that will only grow under the US Compact initiative. But at the same time, we have to take calls on energy imports based on market conditions and geopolitical developments, and we will always have a diversified crude basket.
Parikshit, thank you very much for that. So the government, remaining firm, at least in terms of the red lines, so-called red lines, that it is not willing to cross. And we'll see how this one goes. But important sort of information in terms of the government stand, all source-based information at this point in time. There's this Indegene news which came through, right? I mean, I think we put it out in flashes. There's also sources to CNBC-TV18. Indegene Bank apparently under government scanner. Yeah, under government scanner. Ministry of Corporate Affairs conducts suo motu action against Indegene Bank. The preliminary inquiry against the bank revealed several violations of Corporate Governance and Companies Act. And stocks, I think, taken a bit of a dip. Government considering to refer detailed inquiry against Indegene to other regulators and agencies as well. I mean, when it rains, it pours in terms of bad news, right? And for the bank, RBI, of course, has been sort of watching things very closely. And now there is MCA, which seems to be involved as well. N. Jaykumar is Group CEO and Managing Director at Prime Securities. Jake, it's great to have you on the program. Thanks very much. This tariff bit, I know you want to spend some time on pharma, and we will come to that in just a bit, right? But broad thoughts. You heard Parikshit. The takeaway in that sense is that don't expect, I would read that to say that don't expect any big breakthroughs in the next 6-7 days, right? I mean, we are firm from our side, and of course, that 25% plus whatever that plus is has been announced. What is your sense? How should investors read what happens from here, near to medium term, Jakes?
Well, I think to my mind, the opening salvo has been fired at 25%. The idea is to buy more stuff from the US. I think what's riling them is the fact that we continue to do our own purchases from various parts of the world, as indeed we should if we are required to be energy sufficient and energy independent. Now, from our perspective, buying oil from anywhere can happen, which is what, if you heard Parikshit, the government sources seem to have referred to the fact that they'll be open to buying more oil, and therefore, for whatever this is worth, this obsession with the trade deficit, that can be actually cut down if you buy more oil from the US on oil, petroleum products. And my own feeling is that anything that will happen now will be marked with this particular thing, that which will be seen as a big win for the US, that they are able to sell far more petroleum products to us, far more oil to us. And I think that's going to be an important element in bringing down this optical trade deficit. My own assessment is that, or this is my guess, and I have obviously there's no information, that we'll probably settle at the 18-20% range as far as India is concerned. And some of the specific sectors that are eliminated, like pharma, etc., will continue to enjoy a zero to no tariff kind of thing because of the fact that we are the lowest cost suppliers of products into the US. This is my broad take, and I do believe that the very fact that overtures are being made about a deal will happen. I think they needed to, in a sense, poke this process forward, and that's why this 25% number was given. Nothing more than that. It's just usual trumpery which is happening, and I don't think we should read much more into this. There's no sanctity about this number.
Fair enough. Now let's come to pharma, where you have some specific thoughts as well. Is the market, first of all, overreacting? The pharma index is down 3.5%. The fear is there is the sectoral tariff, plus there is the indirect impact if these, the innovator companies like Pfizer, Novartis, Eli, etc., are asked to cut prices, and then the fear is they will pressure Indian companies who may be supplying to them. So there is two-way impact in that sense, which is being presumed, I guess. But what's your sense, Jakes?
I think it's complete overreaction. Markets have generally been skittish. Any news on any sector, they tend to react with both their hands and both their feet, as it were. I personally believe it's a huge overreaction. If anything, generics are a boon into the US, a boon for the US. And just to sort of explain this, Trump's issues are with the cost of patented products. His issues are with big pharma. The only big pharma in the Indian context that you can think of, in that sense, having its own, there are very few companies, but Sun Pharma is the only one that sort of jumps to mind, and that too, a small percentage of their portfolio. Other than that, I'll give you an example of, let's say, a pricing that happens in the pharma space. If the generics equivalent lands on US shores at $1, given the fact that most companies here, and assuming all their margins come from the US, they operate between 20 and 25% EBITDA margins, 30% if you want to be extremely charitable. So technically, the $1 gets marked up to about $1.40 when they distribute, when they sell it to the distributor chain. That's all the markup that the Indian pharma companies enjoy, one going to $1.40, and all of the costs are to their account. From 140, the problem begins actually at that point because three distributors, these are not names that are known, they are equivalent of the CVS chain, equivalent to the Boots chain in the UK. Three such chains account for 90% of the distribution. This is a point that's been actually on Twitter. There's been an exchange, even as much as, Elon Musk talked about it, the Doge talked about it, and I kind of contributed to the discussions to an extent, if you will, that actually the problem child, if you will, is the distributor in the middle. Because the distributor marks up this $1.40 to as much as $4, maybe even $4.50, justifying this on the grounds that the patented equivalent is at $10 or $12. So the markups for somebody who produces a drug is $1 go to $1.40. And for the intermediary, which is the three distributors and then the pharmacies that come into play, and they probably split that difference 80-20 in favor of the distributor, that $1.40 becomes $3.50 to $4.50. And that is where the problem lies. This is a cartel, for want of a better word, because 90% distribution goes through them. And there's enough evidence if you go back in time and do your research on the Doge savings to American consumers is concerned. That particular aspect did have a fair amount of exchange between various people. It's about 6-8 months ago when Elon Musk was still the blue-eyed boy of the administration, if you will. And he talked about how it's important to eliminate the margins here and actually convert this distribution into some kind of a utility, which actually can make way for substantially lower costs. And let me tell you that the lower cost is only happening because generics are coming in at that price. So you can't go after generics and tell them to hike up prices through tariffs, when actually you should, at one level, be eliminating the distributor margins. As far as the big pharma is concerned, some may have a target that they must recover their investment in R&D in 2 years. Somebody may say 3 years. And therefore, the pricing is as egregious as it is. But other than that, there is nothing to say that pharma, especially the generic space, is going to have problems of absorbing a 25% tariff hike. I don't believe that at all. In any case, most other suppliers in the world, Chinese being our biggest, are at a higher level of tariffs. So at best, you can look at the differential, and I don't believe that Pharma is going to be put in the same basket in any case.
That's very well explained, Jakes. The only thing is that obviously the US government has said everybody no. So your point is, even if tariffs were to go up, it won't make that much of a difference. I mean, we'll be able to, the companies will be able to absorb it. And if they go up, it'll be wrongly so. But given that all this, they also know all this information, right? The people who will decide, hopefully, who knows? But as I think I remember speaking with the Lupin's management, and they said that the cost of making in the US is about 8 times the cost of making in India.
That's a separate issue, by the way, which is why I believe manufacturing going to the US.
That's not going to happen. That's not going to happen at scale in any case.
Will not happen.
But what you are saying is that even at that one becoming $1.30, $1.30 or $1.40, that is, they could be that margin can compress. Or you're saying it won't happen?
I don't think there's any reason to. If that $1.40 became $1.60, all that the distributor is doing is earning not $2 for this, but maybe $1.80. I'm saying there may be some degree of this thing there, but most of the margin will get passed on. There's no question about that. Because the problem child in this is not, I repeat, not the generics guys. They are the folks who, in fact, who haven't as yet gone ahead and drastically raised prices in order to make up the difference between the patented and the generic. That's not happening in any case. And usually the rule of thumb is if it lands at $1, the generics price, the patented equivalent is usually 7 to 8 times that. So at 140 into 7 times, about $10. The problem is that the margins of intermediaries are just too high in the US. Now, they may justify it on various counts and, in terms of, the cartelization that happens, but that's the reality.
Yeah. So what should investors do? You said it's a huge overreaction. Buy some of these names?
I think so.
Which ones, Jakes, in particular, you think
I don't want to get to the name, but generics heavy. And to the extent that one or two of these names have some facilities in the US, the US facilities may get from a finishing part of it, may get additional business now. And you may have a higher utilization of the US facilities as a result of this. But other than that, I think there's marginal tinkering at best. Ultimately, I do not believe either tariffs to the pharma sector. In any case, they've indicated that even if they were to come through, would be 12 to 18 months down the line, which is what he himself has said. Of course, there's no sanctity for the fact that he said something and he can't go back on that. But more importantly, the fact that he has only written to the patented folks to bring down their prices because those are extremely high in the context of an individual's wallet, or even if a portion of that was to come through insurance. But I repeat, none of this conversation so far has meant anything to do with generics. So the reaction from that perspective, based on what has been spoken about, I think it's a huge overreaction.
Okay. All right. Take that point on board. Thank you for joining in, Jake's. Good conversation. Good listening into you today. Thanks for being with us. Have a good weekend. Before we move on to all the buzzers that Hormaz has pointed out for us, just take a look at US futures as well. You just saw that flash there. US futures right now are down between 1% to as much as 1.5%. European markets anyway are down between 1.5% to 2%. And this is the real point, that now these tariffs are a reality. So all this while, was the market simply ignoring it and moving on? Will there be a market reality being priced in now onwards? Let's see. You heard Jahangir Aziz in the morning say that inflation in the US is expected to cross 6% in the second half, somewhere around September, October. So will markets start looking at it with a little more clarity? We'll have to wait and watch.
And also Amazon in pre-market is down nearly 8%. So the street was a little disappointed with the guidance. So Apple is holding up okay in pre-market, but Amazon 7.8% lower now. But let's, as promised, get to the buzzers then. Hormaz is now joining in, putting the spotlight on the top movers.
There are some interesting names and some obvious ones as well for today, but we start off with Credo Brands. It's a recent listing, and after this 20% fall that we have seen in today's session, the stock has more than halved from its IPO price, which was 280 rupees. Now, this lower circuit comes on the back of 27 lakh shares that have already been traded compared to a 20-day average of just 1 lakh shares. Now, PNB Housing is the big casualty of the day, one among the many casualties of the day today. 18% lower now after the MD and CEO's resignation, the biggest single day fall since the stock has seen since March of 2021. Almost 3 crore shares traded today compared to a 20-day average of 8 lakh shares. So another big volume mover on the downside. Another stock that has snapped a 5-day gaining streak today is Dhanuka Agritech, and that is also on the back of its results. This fall is the biggest single day drop it has seen since March of 2020, and it has already seen 5 lakh shares traded in this 12% drop compared to a 20-day average of just 80,000 shares. So it's a very big volume mover on the downside. We spoke about Nelcast a couple of days ago. It features among the list today as well, slightly off the highs of the day, but among the top gainers was among the few that are bucking the trend on the small cap index, and has already seen almost 1 crore shares traded compared to a 20-day average of just 2.5 lakh, and it's been a good mover as well. The last 5 of the last 6 years, the stock has delivered positive annual returns. And the last one on the list, which has also snapped a 5-day gaining streak, is Ramratna Wires. And take a look at the volumes here. 3.5 lakh shares traded, 20-day average of just 50,000. And from 2020 onwards, the stock from just around about 35 rupees has gone up to as much as 700 rupees before today's fall. So more on the downside today, multiple casualties, but there are some that are bucking the trend as well.
Okay, all right, got it. Thanks very much for that, Hormaz. By the way, the market is testing recent lows. It's testing lows that we've seen earlier this week, lows which are just below the 24,600 level. In fact, we're right there. On Tuesday, the lowest level that we hit was 24,598, just a shade below that mark. Now, 580. And there's some other updates coming in on tariffs. It seems that because of the exemptions that at least continue till now, 50% of the goods that we're exporting to the US will not be impacted by these tariffs. So let's see. More on this in just a bit. But Manglam's here. Manglam, markets testing the lows of the week. What are you picking up from the FNO screen?
Markets are indeed testing the lows of the week. In fact, there is some feeling of weakness that we're seeing for most part of the day. It was okay. It was understandable. Start of a new series, etc. But now today's low will be extremely crucial to track. Why do I say that? Because, on the one hand, you have the Nifty, the mid-cap index, as well as the Nifty bank not doing too well. Broader markets would tell you that portfolios are feeling not very good on August 1st. But the domestic focus has been a lot more than the international uncertainty. So if you look at, the top sectoral movers, you have the FMCG index, which is gaining, and that's on account of the outlook becoming a lot more, better in the domestic sector, whereas there is increased uncertainty around the global facing sector. So we have the IT index lower by almost 2%, we have the pharmaceutical index lower by 3%, and the fact that FMCG has been such an underperformer is what the street is now shifting its focus towards. The Nifty days low. Remember, today, just before this decline happened, the low was 24,611. It was holding on to the lows that we've seen all of this week. So those levels come up for you. But now the Nifty is broken below that. So 24,550 is something that the street is eyeing as the next leg of support. But on the way up, there is a fair amount of congestion. That's what call writers are hoping for as well. Because if you look at the 24,700 call and the 24,800 call, both of them on day one of the series have added a huge amount of open interest. When we started the series, the put call ratio was 1.01, and on day one itself, it's come down to 0.85, telling you that there is a lot of call writing which is taking place right now. So 24,700 and 24,800 calls tell you that between 24,800 and 24,850, there could be a fair amount of supply. So the ceiling's coming lower. And at the same time, if you look at the 24,700 put, those put writers are fairly active. The premium is closer to 170, 200 rupees. And that's telling you that maybe 24,500 to 24,550 is a level that the street is looking at as the next leg of support. But amidst all of this, there are a couple of stocks which are fairly well bid in today's trading session as well. So Keynes Tech, for instance, has some long positions being added. It's outperforming an otherwise wobbly market. And PNB Housing, that's the biggest casualty of today. There's been a near 90% surge in open interest on day one of the series itself. And the total open interest as compared to the market-wide position limits is now over 105%, telling you that the stock definitely is going into FNO ban on day one of the series.
Yeah, absolutely. So some sharp movers there, and the market itself is making a sharp move right now. The week's low has been broken. 24,560 thereabouts is where we're trying to take some support. Let's take a break on that note. Come back on the other side. More buzz from the dealing rooms. Nimesh will join in, and some final technical trading advice as well. Okay, welcome back. Let's straight away get to Nimesh, because the real reaction in the market is playing out today. Nimesh, remember we were discussing this in Editor's Playbook as well. The market was fairly even Steven yesterday, but I think today it's double whammy. A, the expiry effect is over, and global markets are now beginning to price in the reality of tariffs. What are you picking up? What thoughts?
Well, Surabhi, today is clearly a reality check for the markets, right? I mean, yesterday the pullback was more of technical in nature because of the expiry, because of long chart ratios and everything. Even in this series, we are starting the series on an extremely short position from the FI. So somewhere down the line, you will see a bit of short covering as well. But today is a bit of a reality check across all markets and for India as well. But from a flow perspective, it's not like there is very large selling. We need to see what the institutional data throws up. But it's 1:2 on the sell side. But the flows are quite muted, is what I understand from larger institutions today. The broader market is where the bigger pain seems to be in today's market. So they've largely underperformed. A lot of smaller and mid-cap names are reacting very sharply in today's market on the downside. So that's something to track in the days to come. Technically, 24,500 is a level to watch on the downside. That's a very, very strong, crucial support for the Nifty. If that gets taken out, you will probably see further sell-off in the market. So that's a level. But today's fall seems to be more of the reality check. But again, flows are not very large, is what I understand from larger FIs.
Okay, so we'll wait by, because at least in the cash market, there have been big selling and then big buying on the DIF side. We will see what today's numbers throw up. What about individual stocks, Nimesh? What's the buzz?
So the first on my list is Aurobindo Pharma. The entire Pharma pack is under pressure. The Pharma index is down more than 2%, and so is Aurobindo Pharma as well. But interestingly, for the last couple of days, the delivery marking is on the higher side, and I understand one large domestic mutual fund has been a buyer at lower levels in Aurobindo Pharma. In fact, the company announced an acquisition as well. So maybe a bit of interest there from larger institutions, and especially one particular mutual fund is an active buyer there. Couple of stocks on the PSU side which is seeing selling pressure today. ONGC and Union Bank both stands out in terms of aggressive selling. Remember, Union Bank was part of my list yesterday as well, and there was delivery-based selling. So there is a continuation of selling in Union Bank, but even ONGC stands out on the sell side. And the last couple of stocks, while the broader markets are down, two stocks stands out for me, Timken as well as TTK Prestige. Both are seeing some small buy flows from larger FIs today. So there is some bit of delivery-based buying and interest as well from larger institutions in Timken as well as in TTK Prestige.
Okay, all right, Nimesh, thanks very much for that. Mitesh is with us with what to do today for a reverse trade on Monday. Mitesh, what do you have?
So, Prashant, actually, in this week market as well, I have one BTST and one STBT. On the BTST is JSL, which I would recommend buying with a stop below 700 for a target of 715, 718. And on the STBT side is Infi, closing near the day's low. That's STBT with a stop at 1477 for 1450 odd kind of a target.
Got that. Thank you very much for that. At the day's low now, nearly 230 points lower on the Nifty. But let's talk about the India's macros and the expectations. Remember, the RBI policy is also next week. The question is, have economists started marking down their forecast for India's GDP growth? Well, the CNBC-TV18 poll finds out that not yet. But most of them are on the verge of downgrading if the tariffs stay. There is also a big fall in the inflation forecast for the current year due to food prices and emerging global slowdown. Lata joins in with more.
Okay, well, actually, after the tariffs were announced, the logical thing was what will be the impact on GDP, and that's why I asked about 15 economists. What would it be? Actually, no one's lowered their GDP forecast. Maybe one, but hardly. In all cases, they are standing at 6.3%. That's the average I got versus the Reserve Bank's 6.5%. But all of them are prepared for about a 20 basis point fall if the tariffs stay. So the widespread expectation is that in these 7 days itself, India may be able to negotiate something. And therefore, it may not be 25. The other reason why people are not giving a new number is, what if the penalties are very, very big? So for both reasons, people are standing pat, but everyone has a downward bias to that 6.3. The expectation is if it stands at 25 percentage tariffs, then everybody will lower it closer to 6% from the current 6.3, between 6 and 6.1%. That's the word from the economists on growth. But the surprise find was that all of them have radically cut their inflation forecast. This was coming anyway because the June inflation came in way below expectation. Now, for the full year, the average is expected to be a ridiculous 2.9%. You know, before a month ago when I asked them after the inflation number, they were all talking about 3.4. The Reserve Bank is standing at 3.7. So look how much the Reserve Bank has to come down if it wants to come to the street level, almost 80 basis points lower. But the reason is that as it is, food prices have been low in the month of July. The bigger point is that the disinflation that will be caused if goods can't be sold to the United States, the expectation is that there will be, we saw the copper price fall. Likewise, the expectation is that there could be a general disinflation even in non-food items in Asia. So all that, of course, is leading up to more expectations of one more cut.
Okay, all right, Lata, thanks very much. So in terms of forecasts, just sort of standing pat at this point in time, waiting and watching over the next couple of days, quite literally, right? Because you don't know what's going to happen, both on the rate and, of course, on the penalty, as Lata pointed out as well. Let's talk about another name which is actually selling off, Niva Bupa. We spoke with the management early on, but let's just get a wrap out of the numbers themselves. Why is the stock down 6%? Yash, take it away.
Well, Prashant, the story lies in the numbers itself. The first quarter results pretty weak, and pretty weak from the top to the bottom. To speak about the premium growth itself, the growth here has been tapering. The company's managed to grow its net earned premium at about 20% in the first quarter, but the story gets worse as you move down the order towards the operational performance. Underwriting loss, that has increased almost 100%. The underwriting loss has doubled to about 234 crore rupees. The operating performance, there has been an operating loss. There has been an operating loss, that's correct, of about 145 crore versus an operating profit of 23 crore. The combined ratio as a result of which has spiked all the way to about 116.97 as compared to 106.09. The PAT is down about 91%, is down to about loss of 90 crore as a result of all these things. And all those factors from the top to the bottom in terms of operational performance and the growth itself weighing down on the stock today.
Thank you very much for that. Another one which is under severe pressure is Graphite India. Came out with numbers about an hour back, and disappointing set of numbers. Revenues are down nearly 9%, EBITDA down 60%, profits have fallen 45%. The stock has taken a knock, and along with that, HEG, which did well, post its numbers earlier this week, that's also seen a sharp correction. But all eyes will be on ITC. Awaiting numbers here, Mangalam joins in with the expectations.
Well, FMCG stocks are generally doing well, but ITC has been a bit of an underperformer here. It's closer to its 52-week low than its high. And, valuations-wise, it's always traded between 22, 23 times, at sometimes 24, 25. But this time around, unlike all the other FMCG companies, ITC may see a bigger impact on their performance, not because the consumption space is not doing well, but because leaf tobacco inflation may impact their core business, which is that of cigarettes. So, if you look at the standalone numbers, excise, you will see the revenues at 17,637 crores. And it is this absolute number which is more important than the comparable, because this is also the second quarter where the company is reporting numbers X of its hotel business. So not look at percentage change, but the absolute 17,637 crore on the top line, 6,300 crores on the EBITDA, which implies a margin of closer to 36%, and a net profit of 5,005 crores is what the street is working with. Once again, year on year, not comparable, because it is X of the hotel business demerger. What are we expecting? 3 to 4% cigarette volume growth, led by 5 to 6% revenue growth. But the cigarette EBIT will actually grow a step shorter than the cigarette volume, so we'll watch out for that. And we have 5 to 6% growth in FMCG revenue. However, there could be contraction in FMCG margins, which we've seen because of the inflation in palm oil and other raw materials as well. 20 to 25% growth in agri revenues, because one, leaf tobacco prices have increased, and at the same time, the government laws around exports of agris have also loosened up. So this would be a sector that benefits from that. But subdued conditions would mean the paper business grows just around 4 to 6%. So all in all, a not so very good set of numbers expected for ITC. But then again, the stock is reflecting that.
Thank you very much for that. Get into a break, counting down to the close today. Remember to tune in to the all-new CNBC TV18 Prime, bringing you insights from policymakers, leaders, economists shaping both the world and India's future. CNBC TV18 decodes global shifts, their impact on Indian businesses, giving you unparalleled insights. Tune in to CNBC TV18 Prime at 12 noon for the Global Reset, 1 p.m. for the Big C, and Global Lens at 8:30 p.m.
Welcome back. It's turned out to be a weak afternoon of trade. There's no other way of looking at it. And almost all sectors, actually not just a weak afternoon, the week also, barring the FMCG index, which has managed a 3% climb, all other sectoral indices are negative, and today's tally is on your screens. Mayuresh Joshi is with us, MarketSmith India. Mayuresh, so tell us, I mean, it's tough and there seems to be no immediate clarity. But on pharma specifically, I mean, people would be really worried. What is the call you're taking on stocks like Sun Pharma? I mean, what was your rating? Would you be changing that rating if tariffs become a reality on pharma?
Absolutely. I think the rating was always neutral. And I think with the impositions that are now expected to come through and the kind of numbers that have also come in, I think the OTR guidance that they've probably given of 25%. Obviously, a lot more is expected in terms of the aligned benefits that it gets from the Ranbaxy element. And therefore, I think within pharma, I think we've been very, very selective. I think hospitals as a space is something that we continue liking within healthcare as a domain. And therefore, our own sense is that hospital stocks, which are probably expanding their operations in a very inorganic manner, and also in an asset-light manner, along with expectations that all the new hospitals that are coming through will probably lead to better operational matrices and dynamics, tend us to believe that within healthcare as a space, hospitals might relatively go better. So I think hospitals like Fortis, KIMS is something that we continue holding in our.
Any thoughts on IIFL Finance? Mayuresh, today, this whole rise in credit costs that they're talking about, clearly the market is in no mood to digest any of such commentary. Stocks down 10%.
Absolutely. I think in a weak market, if you're giving such a commentary, I think that's not going to aid and assist the fortunes for the stock. And that's what the reaction of the street is probably given. Obviously, the rise in credit costs will mean that there will be implications as far as core parameters are concerned. And specifically on an NBFC, I think maintaining those credit costs within a range is extremely critical because you're absolutely dependent in terms of your borrowing mix for sources outside your domain. And therefore, I think the kind of borrowing mix that you probably got, the operational dynamics that you probably carry through are extremely important. And therefore, I think credit cost, asset quality, the risk-weighted ratio compared to the total assets becomes extremely critical from a performance perspective. And I think with the credit cost increase, I think there might be some element of increased and increased pressure on earnings.
Negative news pouring from all corners today. Look at UPL's update. Their impairment costs have gone up, and what was supposed to be receivables from client, now it's been turned into an impairment, and that explains the loss that they have been hurting with. Final thoughts then, Mayuresh. Anything positive? I mean, any interesting buy ideas this week? There's plenty of negative news. Leave us with anything positive.
Well, absolutely. So I think out of the results, I think everybody's probably being a little bit sanguine on auto. I think Hyundai India is something that we remain extremely constructive about. I think numbers have been pretty decent. They're expanding their capacity. So I think capacities will go up from 8,24,000 units to 10,74,000 units. The SUV market share is pretty reasonable and very decent for Hyundai. Again, I think the CNG penetration through their models Aug1st in particular, the expectations in terms of new launches coming through, I think will hold in good stead. Margins are relatively better between 13.5%-14%. It's a cash-rich balance sheet. And therefore, our own sense is that within autos as a domain, Hyundai is something that we continue liking at markets.
Okay, the bell has gone. Mayuresh, thank you very much. Let's quickly recap what's been a really tough Friday, ending up what's been a negative week for the market as well. For the week, the Nifty is down 1%, mid-cap index down over 2%, and small-cap index down over 3%. And today's tally, the Nifty has broken the earlier lows of the week, 24,570, a 1.5-month low for the index. The weakness was pretty much everywhere, but Pharma takes the cake. Sun Pharma down 5.5%. Dr. Reddy's down about 4%. Cipla lower by about 3%. So plenty of fear around what's happening with US policy on pharma imports. We've seen further weakness in IT names like Infosys, down 3% on Infi. Tech Mahindra is down about 2% as well. And beyond all of this, Adani Enterprises 3.5% lower, Tata Steel 3% lower, Tata Motors 2.5% lower. Many of these companies obviously are globally linked and weakness all around. The only place to hide today in the market was really FMCG and consumer. So Trent has managed a gain of about 3%, Asian Paints 1.5% higher. And then you have Nestle, ITC, Some of these names also pitching in with small gains. The saving grace for the bulls was that Reliance managed to notch up a 0.25% increase by the time we closed. Otherwise, this cut could have been even deeper. The bigger problem obviously was in the broader market, mid-cap market. The advance decline ratio is quite negative. Over 2,000 stocks declining today, as you can see on your screens. And if I talk about the weak hands, then, where does one even begin? PNB Housing Finance takes the top honors, 18% lower. But this is not because of earnings. This is because of Mr. Girish Kausgi announcing his exit from the company. IIFL Finance, that we were just discussing, credit cost issues showing up there. And even stocks where earnings were decent. Case in point would be, say, an RR Kabil. Wire and cable companies have done fairly okay this quarter. Even there, stock was down about 7%. Lots and lots of lower names. Lloyd, HEG, New India Assurance, GSK Pharma. Big list of losers out there. Tough week for the market. Well, with that, we come to a close on this edition of Closing Bell. Thank you very much for being with us. But all the market perspective continues. And where does this tariff confusion leave us? All of this and more being discussed on Editor's Roundtable in just a bit.
Markets fall for the fifth straight week amidst Trump's tariffs, which is the longest losing streak in 2 years. More than 35 Nifty stocks post losses this week. All sectoral indices slip, with realty, defense and metals leading the fall. The only exception was FMCG, which gained. Hello and welcome to this edition of Editor's Roundtable. I am Reema. With me are Prashant and Nimesh, and joining us here in the studio is Prashant Khemka, founder of White Oak Capital. Hi guys, what a week. Lots coming in from Donald Trump, earnings.
Yeah, and big shockers, right? Every day we had one accident this week. Today was a classic example of PNB Housing down 18% on MD resigning. So this has been a difficult week. In fact, it's been difficult months, Prashant, right? I mean, it's been challenging even for investors. Forget about traders and all, they're not making money. But at a portfolio level, are you seeing now a bit of fatigue?
Fatigue from investors investing,
yeah.
Is it? See, it ebbs and flows. I think last quarter was pretty solid quarter. July, as you pointed out, has been weak. If it sustains over a prolonged period of time, you start seeing the impact. Now, it's coming up to 12 months when investors would not be making any return.
I was to come to that point that now it's almost a year that, you know, the returns are negative for the last 1 year investors. So in that context.
So it'll be interesting to see. My gut feel is that you might see some moderation in the appetite for investment in mutual funds if 12-month returns, when they see in a couple of months' time, are negative. That's just how the investor psyche works. But we'll
and that's not been a trend for the last few years. So, you know, it's kind of a shock, right? I mean, if you're not experienced for 3 years, 4 years, and immediately 1 year you see negative returns, people get shaken out, right?
True. The expectations last year around this time were so ebullient. People were like 15 to 20%. Rarely would you find people who will say 15 to 20%. 20 to 30% was kind of become like an expectation that this much, so at least at least get. Because since COVID, that's in such a sharp
15, 20, 25, I'm confused. Were you talking about Trump tariffs or market returns?
They were escalating like Trump tariffs.
You know, but I want to put out some
reality
numbers.
Check.
But Nimesh, the point is we've been kind of slowing down in terms of returns for a while. And now we are, it's just coincidental that you're coming to a point, which is H2 of 2025, where any case, expectation is that all of this Trump tariff tamasha which has happened will now finally start to really show up. So far, it has actually not shown up, right? So India has been slowing down on its own account. US, etc., has been doing very well. So you are now, after coming to a point, already slowing down, where now perhaps in the US also this will start to show up. And actually, the graphics will come up for our viewers. There are two reasons why many are saying this will show up now. I mean, these tariffs have become reality. Because at some level, people were kind of wondering whether ye hoga, nahi hoga, you know, really 20-25%. Right now, looks like it's going to be 20%. Average tariffs are now, most economists are saying between 18 and 20%. There are two reasons. One is, there was, before these tariffs hit, there was a lot of front loading into the US which happened, right? So basically, they didn't have these tariffs, so consumers didn't feel any impact. So no inflation and sentiment, etc., was higher. Second is that companies themselves did not know what's going to happen. And I spoke to, for example, Raghuram Raju and a few others who are there in the US. The companies they have spoken with saying we're waiting to see where these tariffs settle at. So they did not increase prices. Now that they also see this is going to happen, you know, they will start to pass some of these prices on. So my short point is we've been kind of suffering without the globe. I shouldn't say suffering. We've had 3-4 good years, but we've been slowing down. And now maybe the world joins us, Prashant. Is that
I would say more than
assessment?
slowing down, I'd say normalizing. The past 3-4 years weren't normal. 20% return isn't normal. If you look at last 20, 30, 40 years, so an average out and adjust for inflation, obviously in the 80s and 90s, inflation was a lot higher. So the nominal GDP, the GDP deflator was higher, hence nominal GDP growth and corporate sales and profits were accordingly higher, and then hence the return a little higher. But if you look at last 20, 30 years, the returns are in line with nominal GDP more or less.
So in India, dollar returns are, I think, 12%.
Depending again where the starting point is. If you start March 20, it's very different from December 20 or March 20.
No, I'm looking at 25 years.
Yeah, 25
Last 25 years, it's 12, dollar returns is 12%.
So that's a little, I would say, higher than what we should expect going forward. Our expectation is if we get 12% rupee return.
You're saying 12% is higher?
Yeah, dollar return is very high. 12% is unsustainably high. And, you know, it probably, I'll have to see what starting point particularly we are taking, whether it's fiscal year or calendar year also can make a difference. I'll say nominal GDP growth in India would be 6 plus 4 or something like that, or 5.5 plus 4.5 something. That's a little over 10%. Add dividend yield of 1%. Pre-tax, so I say pre-tax double digit, ex-tax, post-tax high single digit rupee return is a reasonable expectation to have going forward. And for dollar returns, you shave off 3 percentage points to 3.5 percentage points. So around 6.5, 7% is a reasonable return to have in dollar terms.
Got that. Off late we're seeing a lot of interest in REITs because now the expectation from equity itself is moderating. A lot of the companies which are sponsoring the REITs is saying that anyway you're getting a dividend yield of 6-7%, and this is a very efficient way of returning. I mean, from a tax point of view, it's efficient. Plus, there will be some capital appreciation. So, it's quite risk-free to assume a low to mid-teens kind of a revenue growth. Should one be looking at REITs as an investment avenue?
No, sure, Rima. I think very important point. REITs, our team is quite positive on not just REITs as a sector, but they are finding many more opportunities in there, even though the sector is fairly small.
It's small. We've just got 4 and now 1 will come up.
Absolutely. So the team has a disproportionate allocation, I would say, in REITs. And yes, the valuation is attractive of several of these companies. And that is because there was this disenchantment for a variety of reasons, including 13-14% return or 12 to 14% return, no big deal. We don't want to settle for just low teens kind of return because the return expectations from equities were so much higher. As you recalibrate return expectations from broader equity market, quite possible these on a relative terms would start looking far more appealing. Beginning of the year when markets were down high single digit, double digit or so, the REITs actually were outperforming that time. Because not simply because people were rushing in to buy, but the valuation to begin with was very reasonable.
These instruments you should buy when interest rates are very high, right? That's the time to buy because yields will be high. I mean, are we at that? Have we kind of? So, does that make a difference? The buying point.
So we generally don't necessarily, follow these interest rate cycle and their correlation with specific sectors and all, or
no, not correlation.
Tend to underplay those. But even if you were to think about that,
because it's a quasi-debt product, essentially, right? I mean,
see, growth is also very important. As Rima pointed out, the growth element is also very important because these guys, the growth in rental yield or rental growth would only come if there is a stronger growth. So if interest rates are falling because growth is slowing down, and hence the rental inflation is likely to be lower, then that could be a negative factor. So there are competing factors on that one, but all else equal, you're right, but all else is rarely equal, but all else equal, you're right, and inflation rates are expected, interest rates are expected to.
I remember we had...
Ramdev.
No.
Ramesh Mantri.
Ramesh Mantri was
there. He was one of the big bulls.
Yeah, he is very bullish.
Very bullish.
Yes.
So next week we'll have Knowledge Realty Trust, which will open up in terms of an IPO, and that's backed by Blackstone and the Satva Group. So that's going to be a big one to watch out for. They're looking to raise about 4,800.
So that's the fifth REIT.
That's the fifth REIT.
We have 4 listed.
We have 4 listed.
3 are retail, 1 is commercial.
3 are commercial.
3 are commercial, 1 is
retail, which is Nexus, and this would be the 4th one, Knowledge Realty Trust. But just so quickly, if you thought this was an action-packed week, next week is going to be equally action-packed, and we're beginning with 5 consecutive weekly losses. So, this week we've lost nearly about 1% on the index. But in the August series, typically, at least in the 3 out of the last 4, the markets have gained. So next week, we've got the RBI policy, 6th of August, and plus 7th of August. That's the D day right now, 25% tariff on India, plus penalties, unless it's negotiated in the next 1 week. And in terms of big earnings, you've got DLF, Bharti, Bajaj Auto, Trend, Titan, LIC, SBI, Tata Motors. So the hectic earnings season will continue.
Prashant, now that we have enough clarity on the tariffs, certain sectors impacted the most, right? We spoke about textile as one space. Pharma, you liking some of those pharma names, but even those got hit very hard today. Now that we have a clarity, which are the sectors will be an avoid for you, and which is a sector where you feel there could be bottom fishing?
Certainly. See, first of all, if one manages any amount of sizable corpus, you can't swing the weights on every, otherwise, since the first announcement of tariffs, you would have already switched in, switched out a few times.
But now that we have clarity, now there is enough clarity on the...
Do we really? Do we really? Because this is his negotiation style as well, right? He ramps up the rhetoric in the final moments. So who knows, a week from now, maybe this is what the final outcome is. But let's assume for a minute, to Nimesh, to your point, if this is the final outcome. So within healthcare is a very broad segment. For example, hospitals in India aren't impacted. Diagnostics aren't impacted. Even in pharmaceuticals, only if you have a predominance. First of all, this tariffs are not applicable as of now.
Pharma,
to
exactly.
Pharma.
Still the market, the stocks have reacted very sharply.
Just worried that if his posturing is harsh against India, could there be a, though there are political compulsions within US on pharmaceuticals which may restrain him on that front. But let's assume even that the tariffs would be similarly high on, let's say, pharma as well. But then it impacts predominantly those who have, if that were the case, huge exposure to the US. There are several companies who have de minimis exposure to US, if at all. So very, mixed picture once you start going to the stock level. And that's how we would evaluate each opportunity.
I just pulled up this. I wish we could put this up. This is there's a gentleman called Marco Papik. We speak to him on global stuff. He says he's put out this nice graphic: 7 steps of maximum pressure. Trump's negotiating style. Number 1, ask for the moon. Number 2, when the world scoffs at your demands, threaten them with fire, fury, and whatever else. 3rd, punch someone in the mouth. It's number 3. 4 is break bread, make friends. Number 5, leave the bride at the altar. 6, kiss and make up, and then make a deal. So I don't know. Where are we? 5th or 6th or?
I don't know. I don't know if you've seen the movie The Apprentice. It's a. I don't know how real it is, but it gives you an insight into the character. It was really.
You've lived in the US though, right? I mean, Prashant. I mean, he's a New York businessman, right? He likes to make deals. He likes to. That's the style. He's.
Yes, I think we've seen it all over the last, particularly in this term. So, in some sense, the essence is his. At the heart, he's very unpredictable, and he likes it that way. He's no ego, so he can chew his words the moment he's spoken them. So in that sense, it is predictable.
Predictably unpredictable.
Yes.
But Prashant, say assuming for second half, as where we are in terms of earnings, in terms of tariffs and whatever, which are the things which will make you bullish for second half of this year for Indian markets? Because one of the argument is that India is an expensive market, and now with these tariffs and everything, the safe haven status will go for India, at least for the near term. In that context, as a fund manager, what will make you bullish?
See, this expensive argument, I don't buy.
It's been there for many years.
Right? It's like,
it's always been an
XYZ consumer staple stock has always traded at 50p multiple. It's always been the case and likely would remain the case.
True.
Because there are certain underlying reasons. It's not like...
so the argument is, forget the expensive part.
So it's not expensive, but to your point is still...
But what will make you bullish? I mean, what are the few ingredients that you're watching out for?
I think it will be quite possibly, as I said, a normal market. Which is a blocking and tackling market. You earn 10% in the market.
Sure.
And you try to make...
So basically, lower your expectations for this year.
That is normal expectation. I think going forward, a 10% return expectation is pretty normal expectation. 10 to 11% rupee expectation. They're very normal.
Prashant is talking about REITs. That should give you a signal, Nimesh. What his view on equities is. I want to ask you a question, and the graphics will come up. The broader losses this week, that one. Big cuts actually, Nimesh. PNB Housing was down 20, of course, all thanks to Friday. Home First was down 20. IIFL was down 17. 5-Star Finance was down 13. Indegene, of course, has been a casualty for a while, 12% lower. It's a...
Certainly. And just to Nimesh's question, like, look, 2 years ago or a year and a half ago, let's say late 2023, the environment for financials, lending institutions, couldn't have been rosier. Growth was very strong. NPLs were at cyclical lows. Post-COVID, over-provisioned books, and everything was beautiful. At that time, to your question, it would have been very easy to say that financials are a place where you can expect 20% kind of growth or so. So that turned out to be the other way around.
True.
In real world, in that sector. Yet there is a dispersion in the stock performance. Year-to-date financials is still one of the better sectors. Those
By the way,
who
it still routinely comes up as when we ask people that financials is the place.
You have to invest. We are ourselves the largest
weight,
allocation,
right?
but the conditions presently may be challenging, but that may be also potentially, who knows, the bottom.
Yeah.
If the economy does not, and there's no reason to believe it would nosedive or anything, even if it stabilizes, then it could be, we could be scraping somewhere around the bottom on the NPL zone. We'll only know with the benefit.
You've got the RBI, by all accounts, senior bankers have said that they are asking straightforward, what do you need to kickstart growth?
Yeah.
So there is, that push is very, very clear.
Absolutely.
So that tailwind is there, right?
It has reversed in the last 9 months.
Completely reversed in terms of the tone and tenor. I think we'll take a quick commercial break here. Let's do that. We'll come back. Prashant, of course, is with us and we'll continue some of the conversations.
Welcome back. You're watching Editors Roundtable. We're in conversation with Prashant Khemka, White Oak Capital. We've been discussing how the tariff uncertainty has been hurting the Indian market. But Prashant, if we have to expect a 10% kind of a return from here on, where do you make that kind of money? And also tell us a little bit about tech, because in the past you were fairly optimistic, but I think you've been bringing down your exposures.
Certainly. So within tech, you're right. Overall exposure in the portfolio has come down. But it has actually increased in certain areas like software products or mid-cap IT. It's probably held stable or up slightly, but most of the reduction has been on the large-cap names in IT. We already were less invested in large caps, but have taken down somewhat further. Now, new age tech is very much there and has increased over the prior. In fact, the so-called new age tech is now possibly larger, not possibly, is definitely larger in the portfolio than the traditional IT services name.
And large cap tech is practically nil now?
Much lower, very, very little.
Minuscule now.
Prashant, what about the QSR, or for that matter, the Zomatos and Swiggy's, the platform businesses, so to speak? You've looked at so many businesses globally as well in your GEM portfolio globally. In India, how do you value them, and are you been bullish on that space?
So see, value them the same way as anywhere else in the world and any other sector. So over the last 8 years, let's say, they've always been a sizable part of the portfolio.
Okay.
Obviously, 22 was a very difficult year for them, and some of 23 as well. And that's what I was referring to when I was saying new age tech.
Yeah.
Not all of these new age tech companies are necessarily new.
Yeah.
Some of these have been listed for a while. So collectively, these companies are a fairly significant, the way our portfolios are structured. We never take crazy thematic bets.
Sure.
But within that context, we have fairly sizable investment. As I was saying, I just realized they're a bigger component of the portfolio than the traditional IT services.
Sure. Zomato itself is what now? 3 lakh. What's the market cap? 3 lakh.
Which one?
3 lakh. Zomato.
Zomato market cap is more than 3 lakh.
3 lakh crores, right?
3 lakh.
So that's
So it's expensive. But again, it's so much of growth. In fact, today Swiggy, despite such a large loss, everybody is today on the sell side has upgraded the stock to a buy or a neutral. They've raised the target prices. So everybody feels it's a last quarter of big pain. In that sense, a lot of analysts are also bullish as well.
See, if you look at these stories may appear new and first time in India.
Yeah, absolutely.
But the story has played out across the world, country after country.
No, which is why I asked you, because in your previous role as well, you've looked at so much of emerging market companies globally.
Absolutely.
That would have been easy for you to take calls on the likes of Zomato.
Absolutely, that has certainly helped, and that is why in some ways we've had exposure to these companies long before they went public also.
Yeah.
And if you look at forget US, which this whole thing started in the late 90s. But even over the last dozen years, if you see China, Korea, other ASEAN countries, the same story has played out. A lot of these companies, start the business, and these companies are more or less copying for most part, though some elements, like you said, quick commerce is more, India is where it has started.
But this 10-minute is nowhere, right?
Yeah, so far, I think it will get copied from India, but this is...
And now the 10-minute delivery is larger than the food delivery.
Yes, in GM, depending on how you measure, yes, that is larger in terms of volumes, if you would. But it has, other areas have started, other places, they've started copying to some degree. But these companies from across, if you see, initially a lot of players start, a few gain the scale advantage. There is consolidation because a lot of players then just shut down, lack of funding, whatnot. And then one or two emerge to dominate those segments. Yes, they always face tech challenges and new...
I think in India there are three which are there, right? It's very clear. Zomato seems to be very strong in North.
Others can come in, and there is no entry barrier now.
But that emerge, what Prashant is saying, eventually we will... but there is Zomato very strong in the North, Swiggy, Bangalore, Bombay, etc.
Correct.
And I think there is Zepto, which is also strong in the West, I think.
In most of these businesses, the threat, in my assessment, globally also we've seen, is likely to be new players using some kind of a new novelty.
Yeah.
Rather than existing large players. Like in Korea, Samsung hasn't been successful, for example, in dislodging the new players. So in China, it isn't some incumbent of the old economy necessarily who's been successful. They've all tried, but it's usually the new disruptor who's been able to.
I think delivery by drones. I think we've done.
The other interesting thing I want to ask you was, a lot of money is now shifting to the unlisted market or the pre-IPOs and, that space. You're also launching a CAT2 AIF. Yes. Late in the game, early in the game, where are we right now? Because I can sense a lot of money chasing very few deals in the private market space now.
I won't say, see, when we started the asset management company, also in 3 years ago when we launched, I said, you are 43rd company, aren't you late? Give the example, there are thousands of asset managers in US, right? Yes. So 20, 30 years down the line, we'll say we were the 43rd AMC, like we were one of the earliest. 50, yes. Yeah, we were top 50, earliest 50 asset management company. So that's how in, unlisted space, we are at very, very nascent stages right now. Yes, with benefit of hindsight, could we have started a few years earlier? Yes, but it's never late. And the opportunity set, it's so huge, you can't, not everyone can.
What excited you to get into unlisted?
See, we were already doing so. For one of our funds for last 7+ years, we have been investing in, I would say, pre-listed segment. And very strong, I would say, experience, very positive experience for us. And several of the team members had been asking for it. I think it was my hesitation that delayed it for this long. But I realize it's a very attractive opportunity for us, for investors, and hence we launched it a couple of months ago.
Okay, for me, I think the big takeaway is that your exposure to the new age platform tech companies is more than that of the IT services as a whole. And even in IT, it's the mid-cap platform companies that you're, you like and you're attracted to. Well, Curtains down?
Curtains down. We'll say thank you to Prashant.
All set for the weekend?
Thank you. Yes, looking forward.
Thank you, Prashant.
Thanks very much.
Thank you very much for coming. Well, with that, we thank you for watching this show. Stay tuned to CNBC TV 18 for more news and updates. Goodbye.
Hello and welcome to Business 360. I'm Arundhati Ramnan and these are the headlines that we're tracking for you this evening. US President Donald Trump reignites the global trade war, imposes tariffs ranging from 10 to 41% on 92 countries. Canada hit with 35% tariffs, Switzerland hit with 39% tariffs. All the new rates to take effect from the 7th of August. Stock markets decline across the world. The 25% US tariffs on India is the highest in the region and among most developing economies. The White House is yet to clarify on the proposed penalty for trading with Russia. Sources say 50% of India's exports will be exempt, including pharma, electronics, and energy. President Trump issues an ultimatum to 17 top pharma companies over drug prices, says prices in the U.S. must be reduced to bring parity with international prices. Sun Pharma shares decline amid fears over the company's innovative portfolio, which accounts for 20% of total sales. Sensex and Nifty declined for the fifth straight week, the longest losing streak in 2 years. More than 35 stocks on the Nifty end in the red. Let's cut across to the MEA that's addressing the press.
Have had objection over the debate on Operation Sindhu. They had released a statement the day discussions happened, and today they have reiterated their objections. Also have questioned the timing of Operation Mahadev, saying that it was basically done to ensure that before the discussion this could have happened, and it is nothing but a fake encounter.
Uma.
उमा शंकर सिंह, इंडिपेंडेंट जर्नलिस्ट। कुछ मीडिया आउटलेट्स में ये खबर छपी है कि भारत की तेल कंपनियों ने रूस से तेल खरीदना बंद कर दिया है, क्या ये सही है?
Sahil.
Sir, I'm Sahil Pandey from ANI News Agency. So my question is related to Nimisha Priya. There were multiple claims made by many stakeholders. What is the update on this case, sir?
Okay, first let me, Siddhant, come to your question on the sanctions. We have taken note of the sanctions and we are looking into it. On the other question about proposed oil sale, etc., look, I would say that I have no comments to offer in this particular matter. Rishabh, on Operation Sindhur, you saw that we had detailed discussion and debate in the Indian Parliament. I would refer you to the statements made by our leaders there, including External Affairs Minister. Also on Operation Mahadev, Operation Sindhur and Operation Mahadev, you've seen how our leaders have spoken about it and the kind of importance it has for India.
So the MEA not commenting there on what Trump would do on the penalty front for India trading with Russia. But let's bring you up to speed with what's happening on the tariff front. And that's our top story this evening. US President Donald Trump has reignited his trade war, sparking a decline in stock markets across the world. 92 countries have been hit with new tariff rates ranging from 10% to 40%. The new rates are set to take effect from the 7th of August. India is facing the highest tariffs in the region. The new rate for Bangladesh has been reduced from 35% earlier to 20%. Pakistan faces a 19% tariff and Afghanistan is the lowest with 15%. India is also staring at the highest tariff rate among developing economies in Asia. Vietnam faces 20%, while Malaysia, Indonesia and Philippines all face a 19% tariff rate. Among the BRICS nations, South Africa has the highest tariff rate of 30%. President Trump has imposed only a 10% tariff on Brazil, despite defiance from Brazil's President Lula. US had threatened to impose 50% tariffs on Brazil, but a sharp rise in beef prices could have forced President Trump's hands, as the US is dependent on beef exports from Brazil. Russia is currently under US sanctions and there is no meaningful business activity between the two nations. Among the advanced economies, UK faces a 10% tariff rate. The European Union, Japan and South Korea face 15% tariffs, which is much lower than what Trump had threatened to impose in April this year. And finally, there are a handful of nations facing higher tariffs than India. Canada has been hit with a 35% tariff, which has drawn a protest from Prime Minister Mark Carney. Switzerland is in shock after Trump imposed a 39% tariff rate. The Swiss government says it continues to seek a negotiated solution. Now, the 25% tariff levy on India is the highest in the region and among most developing economies. The White House is yet to clarify on the additional penalty component. Sources say 50% of India's exports will be exempt, including pharma, electronics and energy. Parikshit Luthra joins us now with more details. Parikshit, what are you picking up from your sources?
The Indian government is going to try and negotiate and resolve the situation with Donald Trump and the White House. They wouldn't like this relationship to go down. This is a very long-term, important strategic partnership for India, and they will look for ways to negotiate and have a bilateral trade agreement. Now, as far as the energy ties go, India is making this point and will say this to the US as well, that we have a diversified crude basket. We're increasing our energy imports from the United States, reducing our defense and energy supplies from Russia, on a year-on-year basis. You have to give us some time. And the US energy partnership with India is only going to grow further. But definitely, because of geopolitical concerns and market conditions, we will keep our crude basket always diversified from different sources. Coming to agriculture and dairy, India is likely to stick to the point that these are areas we cannot really compromise on. These are sensitive communities for the Indian population. As far as farmers go, there is a very large chunk of farmers which depend on subsistence farming, and you have to keep in mind religious sensitivities as well, because bloodstock in US, all your livestock is fed with blood meal, which is a protein supplement. Therefore, the sentiments of religious sentiments of people have to be kept in mind. Sentiments of dairy farmers have to be kept in mind, and you have to think about the agriculture sector. So none of these areas will be opened up, but India will try and do whatever is best possible to give a deal to the US, but the deal should also be in India's national interest. Currently, the tariff on India is 25% higher than other economies in the region. It puts us at a disadvantage, and we also have to be ready for secondary tariffs in case the Russia-Ukraine talks were to fail.
Right, Parikshit. Many thanks for those details. Now, moving on, shares of pharma stocks, including Lupin and Cipla, tanked in today's trade. This after US President Donald Trump ramped up the pressure on 17 pharma companies. In a post on Truth Social, Trump said that these companies have 60 days to work with his administration to slash drug prices or they will face action. White House Press Secretary Caroline Leavitt has said that President Trump expects drug makers to commit to this warning and to provide the most favored nation pricing structure for American consumers.
The president signed an executive order earlier this year to solve the problem of exorbitant pharmaceutical pricing. According to recent data, the prices that Americans have been paying for brand name drugs are more than 3 times the price other similarly developed nations pay. The president is determined to solve this problem and took further action today. He has signed 17 letters to pharmaceutical companies' CEOs. Moving forward, the only thing I will accept from drug manufacturers is a commitment that provides American families immediate relief from the vastly inflated drug prices and an end to the free ride of American innovation by European and other developed nations.
India is setting its sights on Latin America to boost exports. Sources tell CNBC-TV18 that an Indian delegation will meet the South American trade bloc, Mercosur, this month. Officials will likely hold discussions on achieving a free trade agreement. The current preferential trade agreement between India and the bloc covers 450 tariff lines. The FTA will allow Indian exports to access new markets in the Caribbean. Copper prices hit all-time lows after the White House clarified that the 50% tariff it announced does not include raw input material, which is contrary to market expectations. The final order will apply to imported finished products like pipes and copper-intensive items like cables. However, analysts say that prices of consumer goods containing the metal are still likely to rise. On to the day's market action. The market fell for the 5th straight week amidst US President Donald Trump's tariffs on India. This is its longest losing streak in 2 years. Sensex and Nifty fell 1% each, while Nifty Bank and the mid-cap index were down 2% each. More than 35 Nifty stocks posted losses this week. All sectoral indices saw steep cuts, with realty, defense and metal leading this fall. The only exception this week was the FMCG sector. The Enforcement Directorate has summoned Reliance Group Chairman Anil Ambani for questioning on the 5th of August. This is pertaining to the alleged money laundering case against his group companies. Remember, we reported earlier that the ED had searched more than 35 premises of the group companies in Mumbai and Delhi. The Income Tax Department has surveyed the premises linked to Jane Street in Mumbai. Sources have claimed that the firm is not cooperating with the investigation and access to data is being blocked. The firm's servers are located outside India and investigators are being denied access. The company's books of accounts are also reportedly kept overseas. This despite Indian company law mandating that such records be kept within the country. SEBI Chairman Tuhin Kanta Pandey has said that every agency works within their own limitations.
देखिए, हर एक एजेंसी का अपना अपना दायरा है और अपने अपने वो कार्यक्षेत्र हैं. जब इंफॉर्मेशन मिलती है, इंटर एजेंसी भी शेयरिंग होती है और ये तो पुट आउट हुआ है. इंफॉर्मेशन इज राइट लार्जली इन पब्लिक डोमेन. तो डिफरेंट इन्वेस्टिगेशन एजेंसीज अपने हिसाब से अपने दायरे में काम करती हैं.
IndusInd Bank is likely to face more government scrutiny. Sources have said that the Corporate Affairs Ministry's preliminary inquiry shows possibility of more corporate governance lapses at the bank. Timsy Jaipuria joins us now with more details. Timsy?
Well, yes, as you rightly said, a preliminary suo motu inquiry was initiated in the IndusInd Bank matter by Ministry of Corporate Affairs, and now what sources indicate that the ministry has formalized the preliminary inquiry report, where it finds that it alleges that there are several irregularities when it comes to corporate governance and various laws of the MCA Act, that is the Companies Act, and thus keeping in mind these violations, these alleged violations to be precise, MCA is now assessing its final report, and the government, to be precise, is seeing what else could be the next follow-up action, whether there could be an SFIO probe which can be ordered in this particular matter, or for that instance, whether government says that they will like to go ahead with further detailed inquiry and the matter being referred to DG investigation again under MCA, something that we'll have to wait and watch for. But yes, as of now, more irregularities is what sources are claiming when it comes to corporate governance and violations of the Companies Act, and which is why the government could be ordering a further detailed probe Whether at SFIO or DG investigation, that is something that we'll keep you updated on.
All right, Timsy, many thanks for those details. Now, on that note, it is time for us to head into a short break. Coming up next, we turn the spotlight on India-Russia ties and why it may have miffed the United States. My colleague Parikshit Luthra will be joined by former Defense Secretary G. Mohan Kumar. On the other side, stay tuned for that.
Welcome back. US President Donald Trump announced that India will face a penalty over its ties with Russia. In a social media post, he said, and quote, "They have always bought a vast majority of their military equipment from Russia and are Russia's largest buyer of energy at a time when everyone wants Russia to stop killing in Ukraine," end of quote. As per a report by the Stockholm International Peace Research Institute, Russia is the biggest arms supplier of equipments and systems for the Indian Armed Forces. Between 2020 and 2024, 36% of India's arms imports came from Russia. However, that's smaller than 55% in the previous 5-year period and almost 72% in the period between 2010 and 2014. The US has been wanting India to procure more defense equipment from it, including F-35 fighter jets. President Trump and Prime Minister Modi's joint statement in February had also mentioned this. However, the Ministry of External Affairs today has informed the Parliament that there has been no formal discussion on the acquisition of F-35s by India. So what would Trump's penalty mean for India-US defense ties and India-Russia defense ties as well? To take this forward, I'm now joined by former Defense Secretary G. Mohan Kumar. Mr. Kumar, thank you very much for joining us. Let me begin, first of all, by asking you about the F-35s. Do you get a sense that the anger with India on our defense relationship with Russia is primarily because India is not agreeing to buy the F-35s, and even previously, the US has made offers to sell jets to India, but there has been a historical concern. Why is that? And do you think India will ever agree to buying F-35s?
Good evening, Parishit. Thank you for having me on the program. Yeah, the question is, it's a very delicate issue which is going on now because trade is being related to defense purchases and other things. I think this F-35 is maybe one of the factors that the US is looking at, because this aircraft they have been trying to sell it to India for a long time now, and so they would try to put pressure on India to buy this aircraft. Whether we buy this aircraft or not, as it has been made clear elsewhere, will depend upon what our national security needs are and how what kind of requirements we have. It's not that just because it's being offered or somebody is pressuring us to buy it, we will buy it, because that will be compromising our national integrity, national security, decision-making independence, it is strategic independence. So we have to consider very carefully what exactly we need for a stealth aircraft, like F-35. Of course, we are in the process of designing a new aircraft, this stealth aircraft AMCA. That's long way off, and there is opinion in certain quarters that there should be some interim arrangements. Now, whether we need an interim arrangement will depend upon our threat perceptions in the neighborhood, what we need against Pakistan, what we need against China. Because as far as Pakistan is concerned, China it will be very quick to share with Pakistan the stealth fighters they already have something, and so it depends upon our own analysis of the situation. Now, the most important thing is that how we can defend ourselves, that air defense part. If there are any alternatives to buy this aircraft. But the fact remains that you cannot allow the United States of America, in the name of trade, to pressure India to buy an equipment from them, unless India needs that.
Okay, Mr. Mohan Kumar, what do you think is the historical problem, concern that the Indian Defense Ministry, it's not just the current government, probably over the last 15 to 20 years, there has been some concern about buying fighter jets from US. Is it because it's also with Pakistan, or is it because if we buy these fighter jets, we won't have full control about how and when we use these fighter jets?
No, you're right. Because, when we bought the Rafale aircraft, for instance, the Americans were also in the fray, but they couldn't qualify. And so we got it according to the technical and financial bidding. And we procured the Rafale aircraft after following all the procedures. So because that met our needs very well. So, but as far as the equipment is concerned, even this F-35, what I hear about it is that there's a lot of controls being exercised by the United States, even among countries of the European Union and in the NATO countries. They are very, sometimes they are not very happy with the thing because there are so many controls. There are communication controls that they're not willing to share with them the source codes and all those things. And so it's very difficult having the aircraft. Because they also don't have that much independence handling the aircraft. So it's also even exaggerated. Maybe there are exaggerated claims that even America can control these aircraft remotely. So be that whatever that is, what India should do is we need not see that was one part of the story. I mean, but this other part is, see, whenever we enter into an agreement with USA on fighter jets, so there's a lot of other controls coming. The Comcasa agreement, was like communication compatibility agreement. No, which is it's really, this is not it's affecting our independence of action. So that's one of the reasons why,
And,
yeah.
You're right, sir, because we've seen how many of these agreements have moved slowly. Take 404 engines, for example. Those deliveries have been delayed. We've just got 1 or 2 engines in the last few months. Our entire indigenous fighter jet program is delayed as a result. Apache helicopters were delayed. So India is right to have those concerns with the US. But do you think what US is asking us to make compromises with Russia, buy less energy, stop buying Russian defense equipment, is it possible for India to do that?
Well, as far as the trade agreements are concerned, Russia is picked by the fact that India is buying a lot of oil from Russia. And of course, as I understand, there are alternate sources available. And if we get cheaper oils elsewhere, we should be going for oil from other countries. We need not completely depend on Russia. We can move away, we can diversify. But as far as military equipment is concerned, no, the last solid equipment that we got from Russia was the S-400. And as you know, everybody knows what role S-400 played. It was a robust equipment, and it was really, the strong pillar behind India's air defense. So this S-400, see, we should now focus on S-400. What kind of deliveries we have, and we should buy that and completely complete the procurement process. Because of the Ukraine war with Ukraine, Russia could not stick to its commitment of supplying it within the specified time. So now we should concentrate on getting all those equipment from Russia. Now, as far as other equipment are concerned, I think even before, my personal view is that the buying of military equipment in Russia was not a very happy experience, because the serviceability of the equipment was always under question, because spare parts, the supply of spare parts, the logistics, it was not very good. And as a result, there was a lot of impatience with Russian equipment, and we had also started the process of diversifying our purchases. And I think we should continue that process, and especially in this situation when Russia is engaged in a war with Ukraine, and they themselves are finding it difficult to meet their own requirements. India should not be going there to buy key equipment. And all we can depend on Russia is for the maintenance and supply of spare parts and logistics for other equipment which we have already bought and which are under service in the armed forces.
Right. That's an important point to end on, sir. Our military imports from Russia, even though it remains our top supplier, they have been declining from 72% in 2010, 55% in 2015, 2024 it was 36%. We are buying more from the US. We continue to buy more from countries like France, for that matter. So clearly, there will be more defense purchases from the US on the anvil as well. Thank you very much for that balanced discussion. With that, it's a wrap on this edition of Business 360. Thank you for watching. Goodbye.
The Genius Act recently passed by the United States is all set to change our lives. Until now, only governments issued currencies. Now the Genius Act allows non-government entities like banks and even non-banks like an Amazon to issue currencies called payment stable coins. Now, what are payment stable coins? They are midway between currencies like dollar and cryptocurrencies like Bitcoin. Stable coins are defined by the Genius Act as any digital token that is recorded on a cryptographically secured distributed ledger. The Genius Act establishes a regulatory framework for payment stable coins. Who can issue payment stable coins? All banks and insured depository institutions like credit unions in the US can issue payment coins. Now, just for an explanation, an insured depository institution is one that takes deposits from savers and gets insurance protection from the FDIC. Non-bank entities can also seek a license to issue payment stable coins. All companies that want a stable coin issuing license have to go to one of the following three regulators. One, large banks regulated by the Federal Reserve have to go to the Fed for such a license. Smaller banks or credit unions that want to issue less than $10 billion of stable coins may seek a license from the state banking regulators. Non-banks like, say, a Walmart or Amazon or even Tether and Circle have to go to the OCC or the Office of the Controller of Currency for a license to issue payment stable coins. Now, payment stable coins aren't going to come very soon, okay? The Federal Reserve, the FDIC, the Treasury Secretary, and each state payment stablecoin regulator will have to issue implementing regulations after seeking comments from the public. The Act says that these rules have to be made within 1 year of the enactment of the Genius Act. The regulators have to make rules regarding capital requirements, liquidity standards, reserve asset diversification standards, interest rate risk management standards, and standards related to operational, compliance, information technology risk management, etc. The Genius Act takes effect 18 months after the enactment of the law or 120 days after the primary federal stablecoin regulators have issued their final implementation regulations. Since the Genius Act was signed into law by President Trump on July 18th, 2025, one may expect these stablecoins to become effective payment instruments by around January 2027. Though it is not common for regulators to take longer to frame the rules. For instance, the Dodd-Frank Act was passed in July 2010, but regulators made rules only by 2013. Some part of that act were implemented only by 2015. So it may well take more than 2 years for payments through stablecoins to take effect. There is an additional hurdle. For companies like Walmart or Tether, the rule is no non-bank can issue payment stablecoins unless it obtains a unanimous vote from the Stablecoin Certification Review Committee. This committee is made up of the Treasury Secretary, the Chairman of the Federal Reserve, and the Chairman of the FDIC. And it is possible that these eminent regulators won't give licenses very easily unless they are convinced of the robustness of the companies that are applying for such licenses. While the detailed rules are still to be made, the Genius Act sets out some basic rules. Issuers have to back every coin that they issue with equivalent cash or US Treasuries. Also, issuers have to comply with anti-money laundering laws, and they have to report suspicious activity. They have also to report every month the composition of their reserve portfolio on their website, which means make it public. These monthly reports must be examined by a registered public accounting firm, an auditor. And the CEO and the CFO of the payment stablecoin issuer must certify the accuracy of these reports to the regulators. The primary use of these payment stable coins could be for retailers. You know, retailers like Amazon.com or Walmart, who have announced their intent to issue stable coins. They expect to save millions in terms of fees, you know, merchant discount charges to banks and card companies. It also ensures instantaneous payments like India's own UPI across suppliers and buyers. You know, another ready use case for stable coins is international transfers. Today, sending a $100 remittance from the US can cost like 6% in terms of fees, and it can take days to clear. Compliant stablecoins can cut that cost to just pennies and the time taken to just seconds. The US government might be another beneficiary of the Genius Act. Some estimates say that mandatory treasury bill backing means stablecoin companies could become top buyers of US treasuries. Who are the losers? Visa and MasterCard shares have been slipping amid fears that, on-chain dollars could steal settlement volumes from these card companies. Banks may also lose some income from retailers. Also, they may lose the idle float if companies start paying, say, part of their salaries via stable coins. But despite a long history of auditing and regulation, banks have failed. So stablecoin issuers have a far more light touch regulation. If these companies cheat on the rules, if they issue more coins than they keep reserves in the form of dollars, they can collapse. Remember, the Silicon Valley Bank failed because the value of the underlying treasuries fell. This can happen yet again, and it can set off a chain reaction of defaults. Experts doubt if regulators can keep track of so many more uninsured issuers of currency like tech firms and crypto startups. So those are the fears generated by the Genius Act. Well, that's the preface. I now have with me two economists, Professor Barry Eichengreen and Professor Ishwar Prasad, who are experts in the field of both money and currencies and have worked on cryptocurrencies. First, let me invite Professor Barry Eichengreen, who recently published a very critical piece in the New York Times saying that the Genius Act will bring economic chaos. So with that, let me welcome you, Professor Eichengreen. Thank you very much for your time. First up, the detailed rules as to who will issue the stable coins, what will be the capital and reserve requirements are yet to be written by the Fed and the FDIC. Now, if these organizations make the rules very strict, can that chaos be avoided? You don't think that's possible?
I do not. So we have to see what the regulations will look like. So the Genius Act permits the FDIC and the Fed and the other regulators to promulgate rules for stablecoin issuers, but it'll be 18 months until we see the rules. And there is plenty of historical evidence suggesting that issuers can get around rules. They can bend them, and I worry about their ability to stay one step ahead of the regulators.
Okay. You say 18 months. Who all have to write rules? Is it the FIDC? Which are the regulators?
It is the comptroller of the currency and the U.S. Treasury. I think that will be in the lead in writing these regulations, and the Genius Act gives them a window of time.
Okay. Is there any advantage at all that you see in stable coins that is not being, achieved by the sovereign US dollar?
Well, it depends who you are. If you're a resident of India, you already have UPI. Yes. So you can make instant payments at low cost between bank accounts, and having a new set of payment rails doesn't do much for you domestically. Dollar stablecoins may be an advantage in doing cross-border payments, however. So that's the one place where people in India may feel a difference, although UPI is being linked with the comparable system in Singapore and elsewhere. So there are other ways besides stablecoins of doing the same thing.
Okay. Well, I will come to the the cross-border transactions in just a minute. Why are you fearing that there can be chaos because of the issue of these private coins?
Well, there will be many different private coins and no guarantee that they will trade one-to-one for one another or that they will be interoperable. So there will be Amazon coin and Walmart coin. Can you use Amazon coin at Walmart or Walmart coin at Amazon? Will there be an exchange where you can trade one for the other? We don't know. So there could be many different tokens trading at many different prices, putting at risk what economists refer to as the singleness of money, where every dollar is worth a dollar and can be used everywhere, or every rupee is worth a rupee and can be used everywhere.
Well, the rules appear to suggest that for every dollar issued, there should be US Treasuries backing, and that there will also be capital prescribed for the issuers themselves, so that if there is a hit, it is the shareholders' capital that is first taking the hit. You don't think these are safeguards enough?
No, I don't, because I think we've seen plenty of counterexamples where existing stablecoins have been backed not only by treasury bills, but by bank deposits at places like Silicon Valley Bank, where they turned out not to be so safe after all, and the stablecoin in question went to a discount. We've seen money market mutual funds in the United States that broke the buck, where a dollar share fell below a dollar because supposedly safe bonds turned out not to be safe. I think we need to worry about that more generally in the Genius Act context.
Okay. Yes, there is a possibility that, the face value of the bonds fall because of a rise in interest rates and the company is incurring losses and there is a panic withdrawal. But in the case of, let me try my best to see if there is any advantage at all. Do you think that the stable coin will, help the issuer earn money, make a profit because they are backed by treasuries? And on the other hand, will it make it very easy for the United States to fund its debt, to finance its debt?
If stablecoin circulation grows the way people like Treasury Secretary Scott Bessent anticipate, so there might be $2 trillion worth of stablecoins outstanding, backed by $2 trillion of Treasury bonds and bills by 2028 or so. That would create additional demand for US Treasuries and therefore strengthen the dollar. But it's also a volatile form of demand, where there could be run-on stablecoins that backing would have to be liquidated all at once, and that could crash the Treasury market. So I would say in this context, be careful what you hope for.
Okay. Well, and from the issuer's point of view, the only profit they make is the yield on the treasuries?
Take my dollars and your rupee, and they issue you a token. They invest them in treasuries, and they earn some interest on that. They give us, you and me, payment services. The idea being that payments will be faster and cheaper than they will be using credit cards, bank accounts, or UPI, to which I would ask how much cheaper and faster.
Okay. Well, let me look at it from an India point of view. Would a country like India or Indonesia or Philippines, any other sovereign country, be afraid of stable coins? I mean, why would an Indian government want to lose control over the rupee or even the amount of rupees that are transacted into dollars? They may want to retain that sovereignty. Do you think that sovereignty will be challenged, their ability to make monetary policy?
I do think it will be. 99.5% of stablecoin circulation at the moment is in US dollars. So if they begin to circulate in India, that is the equivalent of dollarization, where people are shifting out of rupee into dollars for their payments and transactions, and that leaves the Reserve Bank of India with less leverage over the economy. It's called currency substitution, and it is a problem for central banks.
But can't governments, other governments legislate it out, render it illegal to do domestic transactions in dollars?
They can try. That's what domestic financial regulation is for, but a lot of questionable things go on in the crypto sphere. Every time governments try to outlaw crypto transactions, crypto users tend to find a way around those restrictions. So it will be a race, if you will, between the greyhounds, the investors, and the bloodhounds, the regulators.
Oh, yes. In fact, according to Chain Analysis, that the firm that looks at these data, India has, I believe, the largest number of cryptocurrency users. They estimate almost 95 to 100 million crypto users in India. Do you think we are particularly exposed to this probability of, some private transactions happening outside the realm of the Reserve Bank, that is, through stable coins?
I actually think India is in pretty good shape from this point of view because it has UPI. It has a digital system that's universal, that is fast and cheap, and that potentially can be used cross-border as well. Very few other countries have moved as far down that road. So there clearly are risks for India given rapid adoption, but given the provision of alternatives by the banks and the RBI, I think that is a bit reassuring.
Yes, it's certainly reassuring that we have a very fast and efficient method of payment, digital payment. But it is not always the desire to quickly pay that attracts people to stable coins and cryptocurrencies. What I fear is that stablecoin now makes it very easy to use legitimate currency, the sovereign issued currency, to buy crypto assets. Is there a possibility that people who want to do illegal fund transfers use the stablecoin, get into the cryptocurrency route, and then do these fund transfers internationally?
There is a very real danger there. The main use for stablecoins at the moment is as on-ramps and off-ramps for other cryptocurrencies. You move your rupee into a stablecoin, and then when the time is right, you buy Bitcoin or some other plain vanilla crypto. And when you want to get out, you get out similarly via a stablecoin. So this is kind of an enabler of use of other cryptos. And we know that other cryptos are used for all kinds of illicit as well as licit transactions.
Wouldn't that also impact the United States? The United States should be equally worried about transactions happening outside the realm of the law, basically outlawed transactions. Would that lead to some kind of breaks on the system? How do you see the US tackling illegal transactions?
Well, the Genius Act says that stablecoin issuers have to demonstrate the capacity to follow and enforce know your customer and anti-money laundering rules, and there will be an accompanying act affecting other cryptocurrencies likewise that will mandate that they follow such rules. But whether mandates will be enforced in practice and whether we can be sure that what is written on paper will happen in the real world, sounds like you and I share doubts.
Yes, we do. You said that you expect the laws and the rules to be in place in 18 months, and then we will start seeing stable coins as, stable coins kind of taking on. Do you expect that these rules can be written very strictly and, no space is allowed for illegal transactions? They may take longer. They may allow only fewer people to issue coins, but they make it safe. Is that a possibility?
I think the really bright people in the crypto sphere are working for the private sector and not so much for the government. So I worry about the private actors being one step out ahead of the regulators. In principle, technology can help here. We can place on top of stable coins programs called smart contracts that will automatically use computer code to enforce know your customer and anti-money laundering rules. But those kind of contracts can also be used to evade regulations. So I am deeply worried about how this is going to play out.
Okay. Do you expect, now you're saying it's 18 months from now. Let's assume it's even 2 years that the rules take on. Is it possible that a subsequent administration waters it down? I mean, I'm just trying to look at ways in which this doesn't become so chaotic.
Yeah, so we've seen that kind of regulatory pendulum swing back and forth throughout history. So there could be a clampdown. Unfortunately, a clampdown typically occurs after something goes wrong. So we had the global financial crisis in 2008, and then the Dodd-Frank tightening of regulations in the US in 2010. It would be some kind of run on stablecoins, some kind of panic that would precipitate, I think, a regulatory reaction. So there would first be a cost, and then there would be a response.
Hello, welcome to Global Eye. I'm Parikshit Luthra. US President Donald Trump has reignited his trade war. 92 countries have been hit with new tariff rates ranging from 10% to 40%. The new rates are set to take effect from the 7th of August. India is facing the highest tariffs in the region. The new rate for Bangladesh has been reduced from 35% earlier to 20%. Pakistan faces a 19% tariff and Afghanistan is the lowest with 15%. India is also staring at the highest tariff rate among developing economies in Asia. Vietnam faces 20%, Malaysia, Indonesia, Philippines all face a 19% tariff rate. President Trump has also vowed to penalize India for doing business with Russia, but has not clarified on the specifics. Sources tell us that the White House has been eyeing greater access for American products in India's dairy and agriculture markets. Indian government sources told CNBC-TV18 that they will never compromise on the interests of farmers. However, the government will continue to negotiate with the US due to their robust strategic partnership. In a press conference, External Affairs Ministry spokesperson Randhir Jaiswal has said India's partnership with the US has weathered several challenges and New Delhi is confident of continuing the relationship moving forward. He also pointed at the potential to grow the defense relationship and energy relationship even further.
India and the United States share a comprehensive global strategic partnership anchored in shared interests, democratic values, and robust people-to-people ties. This partnership has weathered several transitions and challenges. We remain focused on the substantive agenda that the two countries have committed to and are confident that the relationship will continue to move forward. We have strong ties with the United States. These ties have strengthened over the last several years and decades. There is potential for this partnership to grow further under the India-US Compact for the 21st century.
We're now joined by Philip Luck, Director of the Economics Programs at CSIS. Mr. Luck is also the former Deputy Chief Economist for the US State Department. We're also joined by Humayun Falakshahi, Head of Crude Oil Analysis at Kepler, and Thomas Matthew, former bureaucrat who served as Deputy DG at the Institute for Defense Studies and Analysis. Mr. Matthew is also a security analyst. Thank you very much for being with us on the program. Philip Luck, if I can begin with you. You know, US has been investing in the India partnership for the last so many years as a buffer to China. What has gone wrong so seriously that Donald Trump has used this kind of language for the Indian government, saying that Russia and India are dead economies, they can go down together for all I care, then saying that we're going to penalize India with very harsh tariffs. Why would he use this kind of language for India? What's gone wrong? What's he so upset about? And what is the US really seeking from the trade deal?
It's a great question. I mean, I think I would certainly start by saying this seems to be frustration, not strategy. And we're seeing this replicated across many of other trading partners. I mean, if you think about critical minerals, Canada is going to be an incredibly important partner for our critical mineral supply chains. We are doing everything to disrupt those productive relationships. I think the exact same thing is true here with India. The last thing I would say is, you know, I think some of the problems that we're having, the administration clearly wants to be opening up markets for U.S. ag. A problem there is the reason they need markets for U.S. ag is because due to other trade tensions, other markets are shutting down. So exactly the sticking points that we have with India right now are in some sense self-created because of other challenges that we've created for ourselves.
Right. You know, just to speak to you about agriculture and dairy, you know, top government officials have briefed journalists here and they said that there can be no compromise on agriculture and dairy because almost 60 to 70% of our population is into farming. And these are farmers with very small land parcels. It's very difficult for India to give any concessions, and this would be a non-negotiable. And is agriculture and dairy really what US wants? Because on one hand, Donald Trump, Phil, says that India is a very small trading partner. We don't do too much trade with them. Is this about agriculture and dairy, or is it about bigger oil and defense contracts?
It's a good question. I mean, I think, you know, it certainly is the case that people have indicated to the president, or they've gotten into his ear and said that these barriers are things that have to come down. But to your point, I don't think there's a proper appreciation for the fact that these are non-negotiable. These are things that are incredibly difficult to do, and the concessions that we would have to make, which of course we're not willing to, would have to be enormous to sort of offset the implications for the Indian economy. To your point, there are areas of compromise. I mean, there are rather mutual benefit, whether it be through continuing to increase our defense cooperation or oil and gas and other areas. The other area I would say, of course, I do think even though they didn't put a tariff on India for its imports of oil above the price cap from Russia, I do think if there was some ability to make movement there, that could really help.
Right. Let me go across to Humayun Falakshahi on that question. Humayun, we are telling the United States that we have a diversified crude partnership. Our energy partnership with the US is strong. We are going to buy $25 billion worth of oil and gas from the US this year. But we have to keep in mind geopolitics and market demand and market conditions. To what extent are you seeing India's import of Russian energy go down? Do you significantly see India's energy imports from US going up?
Hi, Raicha. Thanks for having me. I think, to an extent, imports from from Russia into India have been relatively stable year on year. So, as you know, India emerged as one of the largest buyers of Russian crude after the war between Russia and Ukraine, and the imports went up from 30,000 barrels per day back in 2021 to 1.8 million barrels per day. So far this year, we're still at these levels. We're slightly under on a year-on-year basis. We're only down by about 50,000 barrels per day. But it's true that in July, we have seen a big drop in imports into India of Russian crude. But it's also down from a very high level back in June. So in June, we saw more than 2 million barrels per day of imports, actually. And there's been a 500,000 barrels per day drop in July. This could be the beginning of something, as you mentioned that India could shift some of its crude diet more towards, let's say, countries like the Middle East or even the US as well. So it's true that we've seen an increase in oil imports from the US, but in terms of volumes and the magnitude of the shifts, it's far from being sufficient, I would say, in the Indian market. So, we have seen a drop of 500 KBD, 500,000 barrels per day from Russia. And on the other side, we have seen an increase of 100,000 barrels per day from the US. And looking forward, given the US has a very diversified export market, the US cannot really replace Russia in the Indian market. We could see imports from the US go to as high, I would say, as 300,000 barrels per day, which is another 100,000 barrels per day on top of what is currently being achieved. But it's hard to see it go a lot higher, considering all the different characteristics of US crude as well, which is quite different in terms of quality compared to Russian crude.
That brings me to my next question. To what extent have you seen a growth, a jump in India's import of US crude, US LNG since February this year? And logistically speaking, and complementarities in crude refineries, price-wise, can US actually replace Russian crude? And will India be able to stop buying Russian crude altogether?
So this, the answer to your very last question really depends on the extent of, the U.S. action against Russia here. Whether it's going to be secondary sanctions being imposed, whether it's secondary tariffs, it makes a difference. Or even, as we think at Kepler, we believe that this is mainly a negotiating tactic from the Trump administration. And at the end of the day, there will be an agreement to continue import oil from Russia to an extent. Secondary sanctions, of course, I think this is the kind of bazooka option from the Trump administration. It would mean that all Indian refiners would suddenly need to stop imports from Russia. Secondary tariffs, I think it's still quite debatable, and we could still see some imports from Russia. Looking at the imports from the US, we have seen, again, an increase since the beginning of the year. And if you compare, for example, with 2024 and 2023, there has been an increase of about 100,000 barrels per day in the past 2 years to about 200,000 barrels per day on average so far this year. Actually, the past 2-3 months, we have been closer to 270,000 barrels per day from the US. But again, if you look at this magnitude, it's far from being able to replace Russian crude in the Indian market, which is 6 times higher in terms of volumes. The fact that the US, needs to export to different markets as well mean that it cannot be replacing Russia on its own in the Indian market. However, India can also turn to the Middle East and to West Africa, for example. We have seen the spread between Brent and Dubai come down. So it means that crude from the likes of West Africa and Brazil are becoming more attractive to Indian buyers. But I think it would still be a problem because the Russian share in the Indian market is still at 37%. And so that's a huge chunk to replace, and it will come at high cost if it has to be.
Right. Let me go across to Mr. Thomas Matthew. Mr. Thomas Matthew, as someone who has watched India-US relations for a long time, is there still room for some creative negotiations and diplomacy? How do you find a way around your red lines? You've got a US president saying that you have to give me unprecedented access or I'm going to hit you with secondary tariffs, and those could come as early as the next 10 days. If the Russia-Ukraine talks were to fail, there could be more penalties on India. What options does India have?
Yeah, Parishit, firstly, thank you for having me on this talk. Now, let me tell you, India is in a slightly precarious position here. You have Trump, who is very unrestrained in both his actions and talk, and he will walk his talk. If you see what has happened to UK, you should understand the Anglo-Saxon country has always been the closest to the United States. And even with regard to UK, he has negotiated a very tough deal and got several concessions from UK. And he has reduced the tariffs to 10%. Another strategic partner like Japan, he has imposed 15%, and EU, the largest trading bloc, also 15%. Now, can India defy Trump? My answer is no, India cannot. Now, if India were to be penalized for importing Russian oil, it would actually impact India's economy substantially. We need to accept that the US is the giant in the world market. It's about 26% of the world GDP. And plus India's exports to US and India's trade with the US is about 18 to 20% of its total trade. So India cannot do without the US. But at the same time, I think India will have to take a principled stand and negotiate very carefully, pampering to, if I may say, Mr. Trump's ego. The whole shift in Trump's strategy with regard to Russia, I'm told, happened because Melania Trump's influence on Trump, and there's been a sudden shift saying that the Russian president, who was considered to be very savvy, very smart by Trump, has suddenly become his nemesis. Now, if he's going to take a tough stance with regard to Russia, you need to understand that we are importing, as Mr. Homayan said, we are importing close to 30 to 37 to 40% of our needs from Russia. And that's about $50 billion. Can you change overnight? You cannot. You will probably be able to spread your intake to other countries over a period of time. But if Trump takes a tough stance, you will be compelled to enter into some kind of negotiated settlement. If EU has been compelled, if Japan has been compelled, if UK, the closest ally of the US, has been compelled, then I think India has no choice. India will have to negotiate very subtly with the US administration. Although the stance of Trump administration, according to me, is completely irrational from many points of view.
Right. Mr. Matthew, I want to speak to you about the defense partnership because that's the other irritant in talks. I'm going to take a break, but I'll request all our guests to stay with us. We'll be right back. Welcome back. You are watching Global Eye, and we continue to focus on the India-US trade ties in light of some sharp criticism from Donald Trump. We still have with us Philip Luck of CSIS, Humayun Falakshahi of Kepler, and defense expert, and someone who has worked across the Finance Ministry, the Industries Ministry, and the Defense Ministry in India, Mr. Thomas Matthew. Mr. Matthew, speaking about the defense relationship, you know, 72% of our defense inventory is of Russian origin. Our defense imports from Russia have been going down, but can we significantly increase our defense imports from US? Is the US seeking, according to you, most favored defense supplier status from India? Can India do that?
Yeah, Parishad, that's a very tricky question. That's a difficult question. That's a very important question. If you really asked me, I've been a person who's been critical about importing American equipment, US equipment. And why do I say it? I say it because if you import American equipment, you can only fight the wars you want the US to us to fight. On the other hand, Russia has been the most dependable ally of this country, starting from the 1971 war. And please understand, the US weapons are subject to technology denial regime. While on the other hand, Russia has been more than forthcoming in transferring technology to India. Whether you talk about the nuclear submarines, whether you talk about shipbuilding, whether you talk about missiles, in comparison to Russia, US has not been a dependable defense partner, nor will it be, because of the tight technological control regime they have. In fact, they do not have much history of co-production, except in some of the European countries and also in UK. So therefore, shifting to American weapons would do India bad, according to me, because these weapons cannot be utilized or put into action unless the US says, go in and use them. This is the basic problem. And I don't know, India is going to face a tough question, how it will be able to evolve a strategy to keep Trump happy, at the same time, keep India's preparedness intact. For instance, S-400, the missile, the defense missile, surface-to-air missile, which proved its potency. So similarly, we have nuclear submarines, we have all kinds of weapons from Russia. You don't want a supplier who will control the equipment which you buy, which you pay money for. This is the problem which we are going to face.
Right, that's a very important point. Let me go back to our guest from CSIS, Mr. Phil Luck. Phil, just to ask you, what's going to happen now over the next few weeks? And what we saw during the Biden administration, and you were a part of the Biden administration, there were tariffs on steel, aluminium that were imposed by Donald Trump. There were some China tariffs that were imposed. Joe Biden and his administration kept those tariffs on. They did not change that economic policy, so to say. They added their own. They had their own legacy. But it's not like they completely did away with the kind of tariffs Donald Trump had. Is there a danger that if India is not able to have a deal with the US, then the tariffs that are imposed by Donald Trump now may stay even with the next US administration?
I think that's a real concern and something that I've been thinking about more recently. I think, look, tariffs are very hard to take off once you've put them on. There's a protected constituency who really wants those tariffs in place and is going to lobby quite hard to keep them in place. When we had the tariffs on China, when we came in the Biden administration, there was a lot of talk about how to make those more strategic, how to lower them in certain areas where we could import more from China and increase them in areas where it was strategically important to do so. That really didn't happen. We weren't able to reduce tariffs because of the sort of pull of keeping protection in place. The other thing I would note is, these are not an enormous source of revenue relative to overall government revenue. the tariffs we're looking at now maybe be about 5% of government revenue. That's still about $200 billion. So anybody who lowers tariffs from here is going to have to answer the question, where are you getting $200 billion, or are you borrowing it? Now, of course, we're borrowing far more than that, but I agree with you that, you know, overall, this big tariff regime, the longer it stays in place, the more difficult it's going to be to move back to anything close to our pre-Trump 2.0 tariff regime.
Right. Coming to you, Humayun Falakshahi, when it comes to India's imports, could you give us a sense, if you had to quantify in value terms, what would be the value of our imports, oil and gas imports from US since the start of this year versus Russia? And in terms of certain long-term contracts that you're tracking, are you getting a sense that Indian energy companies are signing major long-term oil and gas contracts with US entities?
Yeah, so I mean, when it comes to the value of imports, so specifically looking at the oil side of things, as Mr. Matthews mentioned, it's more or less from Russia, it's more or less around $50 billion. It's actually slightly under that, around 45, 46. Again, if we compare in terms of volumes to the US, you know, imports from Russia are about 5 to 6 times higher. So in terms of value from the US, it would be around, you know, I would say about $7 billion in terms of oil. Now, that said, Russia's oil is slightly discounted, so this is also to take into account. But more or less around $7-8 billion when it comes to oil. When you look at LNG, the volume actually from the imports from the US have decreased so far into India. They have almost halved. And that's mainly due to, you know, it's not linked to the recent skirmishes between New Delhi and Washington. It's mostly linked to the LNG market and the fact that the prices in Europe have been more attractive for US producers. So they have been shipping more of their LNG to Europe. If you take that into account, then more or less the total traded value of energy between the US and India, I mean, oil and liquefied natural gas is around $10 billion, so a lot less than what India imports from Russia. And I'm sorry, if you could repeat your second question, that slipped out of my mind. I'm sorry.
Right. Any visibility outlook on certain long-term contracts with US entities? Are you seeing that between India and US entities?
Not really, no. I mean, you know, you look at the refinery landscape in India, usually they have a lot of term contracts signed with the likes of Middle Eastern countries. And also recently, you know, Reliance and Naira have had term commitments with the Russians. Excuse me. With the US, it hasn't been really the case so far. I think we could be in a situation where if there's a trade deal that is signed, it could be a promise that the Indian players, the importers, the refiners, you know, pledge potentially to the US administration that, you know, we pledge to increase our buying from the US and potentially even sign term commitments, meaning that there is a certain level of flows, a minimum level of flows that US producers would be able and would be certain to ship to India. It's something that could take place, but so far we haven't heard anything like that.
Right. Mr. Matthew, coming to you, do you now expect that if we don't have this trade deal, we could be looking at a prolonged phase of SAARD relations between India and United States? And secondly, in terms of market sentiment on the financial sector, on the stock markets, if you don't have this deal and you have tariffs, which put you in a disadvantageous position. If I look at the tariff chart now, we have the highest tariffs in South Asia. How do you think the investor sentiment will be on India if we don't have this deal and India-US relations were to worsen here on?
Parshit, more than the 25% tariff, I'm worried about the additional tariff that will be imposed if India does not reduce its dependency on Russia, both for defense equipment as also with regard to oil. That's the catch here. And knowing Trump, one morning he will wake up and then play golf, and sitting in his cart, he will say, okay, from tomorrow, I'm going to impose 200% tax on India, or 300% tax, or 500% of US trade in goods. It's only about 2.4 or 2.3%. That's not substantial. But for India, it is substantial. But if the 25% continues to hold, then it's going to adversely affect Indian economy. There is absolutely no doubt with regard to that. See, almost 20% of India's total export goes to the US. And there are certain areas like pharmaceutical and gems where the percentage would slowly rise to 28 to 29 to 30%. So India will have to, play smart with Trump, and negotiating with Trump to strike a deal is a sine qua non, is a non-brainer as far as I'm concerned. I may not agree with Mr. Luck when he says that if this tariff continues, then it will become the new norm. That may not happen. You cannot compare China and India. Biden continued some of the policies of Trump because China is the big threat to the US, whether it comes to the chips or whether it comes to defense. But as far as India is concerned, you need to understand, except for Trump, many other American presidents have appreciated the need to strengthen India because of the democratic dividend the world will get if India becomes actually an emblem of success of democratic values. The US always speak about India's pluralistic society. They speak about India being the largest democracy. And in many ways, India's democracy is stronger than the American democracy. It's more vibrant than the American democracy because American democracy is primarily controlled by pressure groups and lobbies. While in India, it's more down to the root. So India has got something like a better form of, I won't call it direct democracy, but better democracy. But the US should be doing that. But unfortunately for Trump, he is like an old-time 15th century British mercantilist, That's what he looks like. He looks at the world not in terms of geostrategic perspective. Now, Bush gave India exception. If you remember, Jimmy
Matthew, I'm running out of time.
Sorry. Okay.
Mr. Matthew, I'm unfortunately running out of time, but I really appreciate your views. And there is hope in India, and what we are told by sources that the government is going to try and negotiate and find a way out because it's just too important a relationship to sacrifice like this. But Phil Luck, Humayun Falakshai, Thomas Matthew, thank you very much for joining us on the program. With that, it's a wrap on this edition of Global Eye. Thank you for watching. Goodbye.
The single biggest way to impact an organization is to focus on leadership development. There's almost no limit to the potential of an organization that recruits good people, raises them up as leaders, and continually develops them. These words of author John Maxwell hold true for my guests today. With over 30 years of experience in the financial services sector, Renuka Ramnath has always been a believer that when the time comes, things happen. Not one to rest just on fate and serendipity, Renuka took many risks, pivoting from being a banker to an entrepreneur at ICICI Bank, and then to an entrepreneur who decided to venture into the world of private equity investing with her startup Multiples Asset Management, with close to $3 billion of assets under management in a portfolio of 30-plus companies today. A self-confessed worshipper of entrepreneurship, Renuka is hoping to fuel the dreams of India's dreamers. It was on a plane trip that you decided the things in your life are going to be different.
When I sat in the plane, I said, I'm not going to look back because this is an opportunity for me to come back as a new person. The program was all about entrepreneurship, the near-death experience they have with their businesses. I was dying to have the same experience.
Really?
You know, liberating myself from being an employee into the launching yourself into the world of entrepreneurship. I just felt that I should give myself a chance. I should not be afraid of failure. So in Multiples, we worship entrepreneurship. You have to identify the blind spot and be that supportive investor. Indian families, now they are realizing that their children are not going to be interested to succeed. There are more exciting opportunities the subsequent generations want to pursue. Private equity is a very, very important source of achieving this. What VCP industry has done is really democratized capital and unleashed entrepreneurship in India.
Two young women who are looking at starting out, what is it that you would tell them?
I would tell them that, double down on your conviction. Brazen yourself, become very thick-skinned.
ICICI Bank is a classic example where women flourished.
If I was not in ICICI, with that cohort of women, there is no way today's Renuka Ramnath can exist.
Good to have you. I should have also worn a sari.
In Multiples.
How are you? Good to see you. Your therapy is also cleaning. Like me, I'm OCD about cleaning. So it's music, painting, and what else do you do outside your work?
No, I do a lot of yoga.
Oh, really?
Training, walking. On the physical side, Vipassana meditation.
Okay, nice.
Is another thing that I do.
How long?
Otherwise, just engaging with art. I love buying art without knowing where I will put it up.
What kind of music are you listening to these days?
Both classical and film music. Yeah, and instrument.
Do you sing?
Everything. I used to sing. I am a trained singer.
Really?
No, I trained for 25 years, from the age of 3 till the age of 25.
Wow.
Formal classical Carnatic music. Yeah. But given up also for that many, but I sing only for my grandchildren.
You know, I remember very distinctly, and I think I was watching an interview of yours where you said that you were always unmanageable, that you always believed that you should work alone because you're the most effective when you do things by yourself. So you've always been an entrepreneur at heart.
Absolutely, yeah. And I have to place huge gratitude to ICICI, the institution, and all my bosses, starting from super boss, Mr. Kamath, to all the other leaders like Lalita, Kalpana, Shika, who all nurtured, this entrepreneurial spirit in me and tolerated me for several decades, yeah.
I'm given to understand that it was on a plane trip while you were going to the US to study at Harvard that you decided the things in your life were going to be different when you came back. And that was, in a way, the trigger or the start of your entrepreneurial dream. I won't say journey, but the start of the entrepreneurial dream. Take me through why that plane ride was so significant for you.
So, when I requested ICICI to sponsor me for AMP, this was something that came from my heart. It was not that ICICI had a very structured program where they would send their senior leaders for this course or something like that. And again, Mr. Kamath was so ready in sponsoring that. And when I sat in the plane, I said, I'm not going to look back. I'm not going to keep in touch on what's happening in ICICI, what deal, who's getting promoted, who got what increment, because this is an opportunity for me to come back as a new person. The program was all about entrepreneurship and the struggles that entrepreneurs, the near-death experience they have with their businesses. A normal professional would have got, so hassled by, reading and going in depth into the experience of these entrepreneurs and would have said, oh, this is not for me. I should keep far away from it. And I was dying to have the same experience.
Really?
How do I go through those trials and tribulations to build enterprises? So I came back and again requested Mr. Kamath, can you give me an opportunity to do e-commerce or wealth management, which are the two big gaps.
You dabbled with the payment gateway as well.
Absolutely. So I went to a conference, just a routine banking conference, along with my then boss, Mr. Anand Mukherjee, and I saw Check Free. And I just got so inspired by the Check Free model, I said, hey, I'm going to go and build this in India. And again, because ICICI was an organization that encouraged innovation and new ideas, on the piece of a memo that I wrote, I got 15 crores of capital. And then I sent an internal mail to see who will volunteer to kind of set this up. I had an internal person, Bikramjit Sen, who put up his hand. And it was just reinventing this whole payment, bill payment business. We also set up our India's first payment gateway. My colleague Bhargav, was leading that initiative. Again, motivation came from me, and he was the guy who kind of built it out. And, we had to look into what are India's guidelines, what are RBI norms, which are very different from the clearing processes in the US. If I had not done those entrepreneurial ventures, probably I wouldn't have had the kind of training that I had to nurture other entrepreneurs through the investing business.
But you still, Renuka, had the sort of, the ICICI Bank name, the ICICI Bank legacy, and that's a significant legacy to sort of fall back on. So the decision to then say, I'm going to do this by myself. I'm actually going to start something of my own. How much of that was the belief that you wanted to try something different? How much of it was experience of having worked through some of these ventures that you decided, okay, I'm ready now to take the plunge?
So one, Shireen, in terms of conceptualizing a business, how do you go and sell the business to other stakeholders, whether it is building the team or getting the customers to buy from you or finding the capital? All of this training I had when I was in ICICI itself. The question was, can you just stand on your feet and will the market trust you? So what I said was, like how you would launch any new product, you would do a market test, right? You would choose your micro markets and you will go and try to sell the product and then get all the criticism and then improvise the product and then stage it to the world. I did the same thing. So I wrote my exit mail to a whole bunch of people in India who matter. Like Mr. Deepak Parekh, Mr. Sunawala, so many people at that time. And I went and met them and I said, look, I'm thinking of doing something on my own. Do you think it can happen? And each of them said, you could do this, but I wonder whether you have this, right? I'm sure you'll do a great job in investing, but do you have the money to set up your own firm? I'm sure you will get the money and you will do good investments, but will good people join you? And each of it, instead of rubbishing it, I would come home and think about it deeply and say that, oh, if this is going to be a big problem, how am I going to overcome this?
So they actually helped you refine your proposal.
Exactly right. And understand what are the shortcomings in my proposal and how do I fill up the gap and how do I present myself. And some very interesting ideas came about there saying that, hey, you don't have to pay your service providers with your own money. You can have a deal with them that when you become successful, you will pay them. I also reduced the amount of my personal money I had to burn, so to speak, before multiples became, had revenues of its own. So it was, I would say, one of my most beautiful experience of liberating myself from being an employee into the launching yourself into the world of entrepreneurship and seeing how much goodness, how much trust, how much goodwill, how many good ideas and support come your way if you have a strong will to kind of do something new.
And an open mind, because I have to say, it's not easy to put yourself through that test, to put yourself up for scrutiny, because I think all of us only want to hear the good stuff, right? But when somebody comes back with feedback that could potentially be deterrents, that could be hurdles, that could be seen as weaknesses, were you afraid of how you would respond possibly to that?
Yeah, so Shireen, I didn't start multiples thinking that I'll definitely be successful. There were many other offers as well that came along the way, which could have de-risked my entrepreneurial journey. There were many institutions who said, take our business, you keep 26%. Some said, you keep 74%, and so on and so forth. But I just felt that I should give myself a chance. I should not be afraid of failure. I'm going to set myself exactly a one-year target, and I'm not going to be endlessly pursuing this.
So what was the one-year target that you had set?
At the end of 1 year, I wanted to pay myself salary. That was the target. So
how much salary did you take at the end of a year?
So I took enough to run my household, but the idea was that will you become revenue positive? So financially, I was extremely disciplined. I didn't have any baggage because this was a startup. All you had to do was to go out and raise money.
You were talking about those exit letters that you sent out. Was there an exit letter before the exit to Mr. Kamath? How did he react to it?
No, I would say that, Mr. Kamath has nurtured all of us, and, I owe everything I am to him. But for the opportunities, the guidance and the challenges that he placed along the way, I would not have emerged as the professional that I did.
Since we're talking about Mr. Kamath and ICICI Bank, Renuka, I want to ask you this because this is the common perception, right? Which we have heard ad nauseum, that women don't support each other, that if you have women in leadership roles within an organization, they very often pull each other down. I mean, ICICI Bank is a classic example where women flourished, women thrived across different roles pretty much at the same time. How do you explain that?
No, I would say that if I was not in ICICI, with that cohort of women who supported me through my several personal and professional challenges, there is no way today's Renuka Ramnath can exist. In fact, being in a cohort, being in a group of high women achievers who are pulling each other up, and who are lending a shoulder in your downtime is what was singularly responsible for us all to kind of float and emerge and come out so successful. So it's I would say they're completely baseless comment.
Where do you think it comes from, this perception that, it has been handed out across generations? Where do you think this stems from?
No, I guess people, these are all old cliched beliefs that women gossip, they are very jealous and they can't see other people successful. Like many other baseless assumptions about, if you're an unmarried woman, will you continue working after you get married? If you're pregnant, will you even come back after your maternity leave? These are all, completely unestablished biases coming from several generations. Even when I was in college, Shireen, many boys would say that I am a wasted seat. I went to VJTI, which is a government college, and there used to be a lot of resentment that, this government is spending this money to educate you and get you an engineering degree, and all you're going to do is to get married and raise children.
But did they actually say that to you, to your face?
They did at that time. But we are talking about 1978 to 82. That is, that's how much understanding there was, about how much women can contribute to the growth of this economy, and what does a woman's determination really mean?
Yeah, well, speaking of biases, Renuka, when you finally decided to start, and it's been a 15-year journey for you at multiples, and the private equity venture capital market in India was very different 15 years ago, especially as far as the domestic market was concerned, and especially as far as homegrown private equity companies were concerned. What was the big challenge that you faced then when you actually went out looking for capital?
Yeah, so Shirin, I would say I faced an even bigger challenge when I went out to raise capital as part of ICICI Venture.
Really?
Because the market was even more nascent, right? One had to really go and sell this private equity product. And given how vibrant Indian capital markets are, IPO markets have been, right? I mean, from the 80s, people couldn't understand, why do you need private capital? What's the big purpose it's serving? Knowing fully well that the awareness around this product is very, very low, there is a lot of skepticism. And two, it's a very risky product. At the end of the day, you're giving long-term risk capital to enterprises, and it could go either way.
Either way, yeah.
I did one very good thing of deeply engaging these institutions.
Okay.
So I created two committees. There was an investment committee and there was an advisory committee. And I made sure that these institutions had representatives in both the committees.
Okay.
And I would go take a lot of effort and get my team to present up to the minutest detail about how investment, divestment decisions are being taken, the challenges of nurturing these enterprises. I could have chosen the other path of saying, hey, I've got the money.
Yeah.
They have written a document where we alone take the decisions. Why should I involve them? I knew that the only way to build a business is by getting all your stakeholders on board, keep them deeply engaged, be extremely transparent, and get their support 100%. I want to recount a very interesting experience. When I got purchased Tata Infomedia from the Tata Group, it was a very big deal because Tata Group has never sold any business, and they were, for the first time, selling a business. And that too to a faceless entity called a private equity. Right? If it went from Tata Group to Birla Group, it would have been another matter. For whatever reason, the company bore the name Media. It was called Tata Infomedia. The circumstance was such that the CEO had to be replaced with a new CEO. And it was an important decision to be taken and implemented. Equally, I wasn't sure how the press will react. And more importantly, by reading the press, what our investors would react. So I was calling various chairmen of banks to tell them that this is going to happen, don't get hassled, I'm on top of the situation. So one bank chairman said, did I read the newspaper before I gave you money? I trusted your competency. Don't worry about what newspapers would write, So tremendous support. I firmly believe that the strength of a private equity or any alternate asset management institution comes from the stability of the investor base. How much trust you enjoy with them, how learned they are, and how deeply they are vested in the business and understanding of your investing style and the stability that they need to provide.
A lot has changed in India, globally of course as well, but even in India as far as the maturity of the private equity and the venture capital market is. The startup ecosystem has changed dramatically in the last 15 years. And that's what I want to talk to you about as well. What we're seeing today is India has emerged as the second largest market in Asia Pacific as far as private equity is concerned. 2024, a record year as far as exits are concerned. 2024, also a record year in terms of domestic capital raised by private equity players. So, finally, do you believe that this is the moment that you've been working towards, that you've been waiting for over the last 15 years?
Yes, I would like to say this is the moment, but I still think that the moment is probably another 2-3 years away.
Okay. So this is a mini moment.
This is a stepping stone to kind of the moment. Of course, in terms of attracting foreign capital, last year, 2024, we attracted about $56 billion from about 11 billion in 2014, which is a significant growth in 10 years. There's a lot of family office and private wealth interest in this product. But as far as institutional capital from India is concerned, including pension funds, we have not done well at all. So once that happens, I would say the moment has come. So I think as a country, we should have a strategy in mind, because at the end of the day, what we are sharing with global investors is the wealth that is being created by the Indian economy.
Yes.
Indian consumers, Indian market, and all of that stuff. What is a fair split for the risk between how much the Indian savers will keep and how much we will export to the global world? I think a much more comprehensive look and enablement around that would create a moment. The second moment, a lot of people ask me how long you will keep working. I keep saying the moment hasn't come, what I've been aspiring for. I see the biggest opportunity in institutionalization of ownership. Indian families, now they are realizing that their children are not going to be interested to succeed. There are more exciting opportunities the subsequent generations want to pursue. And they all want to call out something as their own rather than taking the reins from their father or grandfather. And also consolidation to create mega corporations will be an absolute must to compete in the global marketplace and win, because you need to invest in technology, research, and brand and good talent. For both of these, private equity is a very, very important source of achieving this. Private equity firms will buy. We've seen enough transactions, but this will go tenfold in the next 3 to 5 years and probably 100-fold in the next 10 years. I'm waiting to see that moment.
So you're talking about family businesses institutionalizing, selling out. 2024 has also been probably a record year in terms of buyouts by private equity in India. In that context, I want to get you to weigh in on what we heard from Uday Kotak, which of course then created quite a stir, with him saying that, look, we're now dealing with the next generation that's happy to be money managers, wealth managers, but don't want to get their hands dirty and turn entrepreneur. And he sees that as a risk for India. But you're saying that, you don't necessarily see that as a risk.
So I would say that what VCP industry has done is really democratized capital and unleashed entrepreneurship in India, right? If you talk to Dipinder or you talk to any number of those genre of entrepreneurs, they would say it was because capital came to us, backing a winning idea, that we could go out and build that. The traditional model was that I took my father's business and then incrementally stepped up, right? Maybe brought in more foreign technology or created a bigger front end or whatever. I think that is the piece that is going to wane away because people are now wanting to chase new ideas. That doesn't mean that the traditional businesses are not required. Somebody needs to manage them, consolidate them, and run them and create more value, right?
And just to look at your portfolio of companies, you're backing a lot of startup companies like Zomato, you know, whether it's Acco or Delivery or Licious, but you've also got your checks in on some of the traditional businesses as well, the likes of Arvind and so on and so forth. So, you know, when and I know that, like us on Young Turks, you've never believed in chasing valuation. You've always believed in chasing value. So when you make these investments, what are you betting on?
No, first, of course, what is absolutely universal is the macro. What's the size of the market? What's the size of the profit pool? And are all the other paraphernalias in terms of government policies, no concentration of supply or buying. I mean, no concentration of buyers or suppliers. All of those absolutely traditional things that you would learn in school. But finally, how to sculpt that opportunity is in the hands of the entrepreneur. So are you backing the right entrepreneur who has the ability to imagine what is possible from this macro opportunity and has all the other qualities, right? One, you can have the right imagination, but if you're not a good people's person, if you can't put a good team in place, if you don't have the right attitude towards governance, if you don't invest heavily in building scale and investing in technology, making your business really robust for the next decade, you are not going to be building a successful business. So whether an individual's idea and determination and entrepreneurial power will get translated into the organization. To build an organization that sustains and scales over a period of time, keeping in balance the requirement of all stakeholders is the biggest call every investor is taking. So in multiples, you know, as you very correctly started, we worship entrepreneurship. We are investing there because we truly believe in the capability of the entrepreneur. So we want to be the wind under the wings rather than say that it is thanks to us that these enterprises are getting created. Even in a controlled situation, we are betting on the management. We are backing the management to go out and build the company. You have to identify the blind spots. You have to have that conversation and be that supportive investor who is walking hand in hand and fixing the gaps rather than trying to get behind the steering and start driving the car.
You know, I took you through some of the investments and I took our viewers through some of the investments that you've made, but was there any founder in particular, when you were having the conversations on whether you should join as an investor or not, that completely blew you away with their vision, imagination, what they intended to do, and has that borne out in the way that they pitched it to you?
Yeah. So I will say that in multiples, we are proud of each and every investment. You know, we don't necessarily...
No favorite children.
No favorite children. I mean, we really deeply respect each of our entrepreneurs. Early on, we invested in delivery, right? I mean, meeting Sahil, I mean, given how young he was, probably 27 or 29, you could make out in the very first meeting, you know, the determination he had to go out and build, the way he would take calls, the way he would interact with his co-founders. So many questions we would have in terms of when it scales up and something becomes a bottleneck, how will he deal with it? He said no to his key customer because some of the practices in the customer's premises he felt would damage the reputation of delivery. Who does that when you are that young and desperate for business? These were great confirmations for us that this guy cannot fail. Similarly with Harsh, right, in Dream 11, that when you are investing behind a business which has its own regulatory, you know, kind of headwinds, you know, how would you tackle it? Again, the maturity of the entrepreneur with Varun in Acco, you know, the way he understands deeply the business and the bold steps that he is able to take. Or Licious, you know, Abhay and Vivek to go out and say, I'll build a direct-to-consumer brand. You know, and when you have so many very deep-pocketed consumer companies. But there is no one way in which you can get the best out of each of these entrepreneurs. Multiples way of engaging with each of the entrepreneur is fine-tuned to who the person is, what motivates them, what exacerbates them, what are their strengths, what are their blind spots, which is the best way to influence them and get the best potential of the company and of the market. That's where I would say, you know, people are very proud to say, you know, my way is this one prescribed way. This is how I do business. When you're a private equity investor dealing with such wide variety of entrepreneurs in a high growth market, which is volatile, which can have some completely unforeseen situations thrown at you, either from competition, regulations, or whatever it may be, it's very important for you to adapt to each individual and get the best out of that individual.
I would like an honest insight into what it was like for you when you actually, I mean, you've been around for 30 plus years. You've done the stint as a banker at ICICI. So it wasn't as if you were fresh off the boat, so to speak. But nevertheless, you're still entering rooms that are largely men.
Yes.
Men in suits. For a woman in a sari to say, look, I'm doing my own thing. I'm starting my own private equity firm. What was that like for you? I mean, what was the reaction? What was the response? And I'm sure that, there was, of course, all the positive stuff that you spoke of. But what were some of the other misconceptions, the other preconceived notions and ideas that you had to battle?
Yeah. So I would say that, Shireen, the world probably is divided into people who have this bias that they cannot think of a woman as an equal professional and would carry the notion that a woman will give up or a woman cannot, deliver as well as a man, given the same platform. I experience it even today. I feel that, there is a negative bias because some men cannot be, cannot elevate themselves to look at a talent as a talent, irrespective of the gender.
I like the way you framed that men can't elevate themselves to see you as equal.
And I have learned over a period of time not to bother myself, not to correct their impressions, not to have any negative, bitter feelings about them. Let them be, right? There is a vast world out there which is giving you the benefit of doubt. But even today, sadly, I have to say that there is a bias not favoring the woman. It's okay to pay a woman director lesser than a man director, right, on a board. It's okay to pay a woman employee lesser than an equivalent man. It's okay to make an assumption that the woman will be the one who will compromise her job if the family needs her time and not the man. So some of these things are going to take way more time to fix.
But two young women who are looking at starting out, maybe as founders, I hope we see more women founders in this country, but who are looking at careers at this point in time and, still dealing with the lack of role models. I mean, today it's very, very different, but still dealing with concerns, questions, doubts. What is it that you would tell them?
I would tell them that, double down on your conviction, brazen yourself, become very thick-skinned, look at who is supporting you and gravitate towards that, and don't bother your head and you consume your bandwidth about somebody who did not give you the benefit of doubt. And you have a job to do. Are you interested in fixing the world, or you are interested in getting ahead and getting your job done?
I want to talk to you about resilience. And I want to talk to you about resilience in the context of your own journey, in terms of your own lived experience. Where do you derive your strength from? Where do you derive your inspiration from? Where do you derive your imagination from, today, for instance?
I think a large part resides in your mindset, which fortunately for me comes from genetically from my parents. I think my father is a very, very positive mindseted man. I think living with them, he has passed that on. And my mother is an extremely conscientious person. So that has come from her to me. So when Subiksha happened, which was a very famous failure of mine, I was for a brief period of a few months looking at probably my career has ended. And it is such a sad story that I worked so hard for 25 years and I wanted to make a great career. I wanted to build a great institution in ICICI Venture for alternate assets. Just when that happened, I had, no exaggeration, at least a dozen of my entrepreneurs who I had backed in ICICI Venture, flying down from different parts of India to come to my office to give me only one message, that let this one Subiksha experience not change you. I would say that I get my energy through these reinforcements of people, our entrepreneur ecosystem, who come back and say, there will be occasionally some setbacks, but please don't. Two, as I said, my team. it is for me such a great pleasure and privilege to walk into this office and work with them.
It's interesting that you brought up Suviksha, and there's a lot that one learns actually from failure and from loss as well. Do you believe that you understand your founders who are part of your portfolio companies better because you yourself are a founder?
Yes.
Do you believe that there is a greater alignment of frequencies there because you understand what it takes to start up, you understand loss, you understand failure much more personally than somebody who's been an investor and has only invested through the course of their career?
Exactly. So right from the beginning, when I got into this career, I would tell my team in ICICI Venture that don't look at an entrepreneur as a client. Look at yourself as a partner with that person. Together, you're going to build a business, right? And here in multiples, we call each of ourselves a multiplier because we kind of multiply everything in our portfolio companies, right? So we tell ourselves that we are entrepreneurs first and investors next. So we don't think from spreadsheets. We don't think from numbers first. When a threat happens, we see that as an opportunity rather than something where we have to run away and look at the exit door first. Which is why multiples came forward to invest with PVR and Arvind Fashions and these companies which had to shut down because they were just physical businesses, right? I mean, the business happens in physical premises.
Through COVID.
Through COVID. We were right there to invest because fundamentally we have invested in understanding what the business is all about, what their strengths are all about, what the team is all about, and therefore our confidence to step in at the time of crisis and be that anchor, be that rock solid trusted partner for our entrepreneurs is literally unmatched.
You know, we're talking about your investment philosophy and your investment style. I want to talk about what Renuka Ramnath does to invest in herself. So I know music is a big part of your life and it's been a big part of your life. Yoga is another thing that you're passionate about. What else? What do you do to reinvest in yourself?
Actually, I get quite replenished when I come to office. Strangely, work replenishes me. Working with
so you're
very
not just
capable
a worshipper
people.
of entrepreneurship, but you're a workaholic as well.
Workaholic as well. But I enjoy it. I mean, I don't feel burdened by it. More recently, I would say grandchildren. When I spend time with them, that's the end of the world. So family and friends is, again, very important to me. Family is very, very important to me. And I'm also blessed with a fairly large circle of friends who are very caring, very loving, very genuine. So, I get hugely nurtured by all of them. So walking is another passion. And invariably, in a week, at least 3 to 4 days, somebody or the other is coming asking for career counseling, personal advice, or parental advice.
So the agony aunt. Are you the agony aunt?
Not really an agony aunt, but much more in terms of, things that are confusing to them and, how should I take my life forward? Should I really continue with my career? Should I do this? Should I do that? Probably I should make more time for recreation, but I don't suffer from a feeling of imbalance because I enjoy every minute. I mean, I don't do things that stress me out. I only do things that bring joy to me.
Well, that's a good approach to have, and that's a good place to be as well. So, to sum it up, Renuka, what do you believe you would describe as your leadership language?
I am unfortunately not a big subscriber of many notions about being a corporate leader where you have to be ruthless, you have to be, only result driven and so on and so forth, or you've got to be a very aggressive negotiator and so on and so forth. I treat my colleagues like my family members. We have built a culture where we have taken the trouble to understand each other And we've created a bonding which is deeper than just engaging at the level of work and being superficial to just get our work done. And what this does is that it has built a culture where in multiples, everyone wants to see themselves successful and their colleagues successful as well. So they look at the positives and you become much more understanding and accepting of some of the weaknesses that the team members have.
You know, it's interesting because many of those attributes, you know, the hard negotiator, the aggressive leader, and so on and so forth, this is the masculine leadership that we've been accustomed to. So to change that, has that been a conscious effort? Has that been something that you've consciously designed? You know, because then you get tagged as the feminine leadership, but it's the human leadership, right?
It's human, absolutely. And especially in the current world, I think this is the only sustainable way of leadership. I mean, I go to bed every day thinking about what kind of stress levels my team members are going through and what can multiples do to alleviate it. You know, working today is very different from when I started my career, because there were no telephones, no digital, no nothing. At least when I reached home, I was disconnected. Today, there is no way you can be disconnected. It brings a very different, level of stress. So in multiples, you know, we started with one of our key values is win-win. Everybody in the world says that, but to live it is a very different thing. And, you know, I would say that the weakest person dealing with us, which could be the vendor who supplies vegetables to our pantry or the person who decorates our office with flowers. The tendency will be you can push them back, you call them, make them sit in the reception, tell them, aaj check nahi milega, come after 15 days. And poor fellows, what can they do? Multiples is an important customer. I set the value system absolutely straight and kind of uncompromising from the beginning. That when someone deals with multiples, whether it is a guy who supplies potatoes to me or my largest LP, right? They don't have to watch their back. If you call them your partner, you are watching their back. And you are not going to do a single thing which is a win for you and a lose for them. I am extremely proud to say that we have never compromised this despite demon, despite slow economic growth, despite COVID, and what have you, in the last 15 years. So if you build a nurturing environment, which is demanding of performance, which is demanding of high competence, a highly learning, agile environment, but very supportive, very trusting.
And
I think, the results that you can deliver over very long periods of time will have a multiplier effect on the short-term gains that you may have.
Well, Renuka Ramnath, what an absolute pleasure it has been to speak with you. I hope you continue to build the win-win culture at Multiples and also each of the organizations that you do touch by way of your investments. And I hope that many who have watched this program take away from you what strength and resilience look like. It's been an absolute pleasure. Thank you very much.
Thank you, Shireen. My pleasure to talk to you.
Well, with that, it is time for us to wrap up this edition of Leadership Language. Do remember to log on and visit CNBC-TV18 Access, CNBC-TV18 Prime. We'll be back again with more conversations around leadership. Till then, from the team, goodbye and thanks for watching.
Hello and welcome to Startup Street. I'm Arundhati Ramnan, and these are the headlines that we're tracking for you from the startup world. Cybersecurity firm Safe has raised $70 million in a fresh funding round led by Avatar Ventures for building CyberAgi. The round was led by Avatar Ventures with participation from Susquehanna Asia Venture Capital and others. Deep tech startup 6sense has bagged $8.5 million in a Series A funding round led by Peak 15 Surge, Alpha Intelligence Capital and others. The fresh capital will be used to expand into chip-making hubs across Malaysia, Taiwan and the US. Zomato's Dipinder Goyal plans to make India's first turbine engine from scratch for planes with his new venture, LAT Aerospace. The startup has announced the establishment of a propulsion research center in Bengaluru. The facility will focus on making India's first indigenous gas turbine engines from scratch. Swiggy will sell its 12% stake in Rapido that is now foraying into food delivery. Swiggy acknowledged that Rapido's move could lead to a potential conflict of interest, while it is unclear how much money the company will make from its 3-year-old, as deal negotiations are yet to begin in its latest shareholder letter. Apple reports a blowout June quarter with $94 billion in revenue, the biggest jump in nearly 4 years. India revenue hits a record high. The tech giant projects a $1 billion hit due to Trump's tariffs in the current quarter. Those were the headlines that we're tracking for you this evening. But on What's Brewing today, AI-powered recruitment platform for blue-collar workers, Vahan.AI, has announced a strategic investment from Lemmatree, an investment firm founded by Singapore's Temasek. Alongside this transaction, Vahan.AI has also acquired Learn, the digital learning and upskilling tech platform of Good Worker, which was backed by Lemmatree. The company says the strategic investment will help them to further develop the technology stack and move closer to placing at least 1 lakh people per month, up from about 40,000 people per month currently. For more on this, joining me now is Madhav Krishna, the CEO and founder of the company. Madhav, thank you so much for taking time out and being here with us on Startup Street. You know, if you could start off by telling us about this strategic investment from Temasek's Lemmatree, what is the size of the investment you've secured and how will you sort of deploy this money?
First of all, thank you for having me here, Arundhati. We are very excited to partner with the Lemmatree, which, as you mentioned, is backed by Temasek, one of the largest funds in the world. There are primarily 3 objectives behind this partnership. Number one, to obviously improve the tech stack that we've developed, specifically the AI recruiter, which is essentially a voice bot that can speak to candidates from the blue-collar space in English and Hindi and help them match with the best jobs available for them. It can answer questions, and soon it'll be able to collect documents and validate those. We're now expanding into multiple languages. We plan to support at least 8 major languages by the end of the year, and at least a few 10 to 20 dialects as well. Second, we are very excited now to expand into other verticals outside of the gig economy. As you mentioned, Vahan today recruits about 40,000 workers a month, primarily in the delivery and gig economy space. So we work with all the large delivery platforms, including Zomato, Swiggy, Flipkart, Amazon, Zepto, Uber, Rapido, Blinkit, etc. And we've proven our model there. We are now expanding to sectors such as manufacturing, as well as warehousing. Soon, we will also consider expanding to other geographies outside of India. So both Southeast Asia and the MENA region are very relevant for what we are doing. Last but not the least, this partnership with Lemmatree and Temasek includes the acquisition of a product called Learn that was developed by Good Worker a few years ago. Now, we're very excited to bring this product into our portfolio.
Right.
It can help blue-collar workers upskill. As you know, India has a massive upskilling problem. We produce close to 7 million graduates every year, but it's estimated that more than half of them are unemployable today. So we hope to make a dent in that problem space as well through the use of the Learn product.
Absolutely. So big plans there with the funds that you have raised, you know, expansion plans as well as, you know, this new acquisition that you have. We're going to talk about that a little bit more in detail. But before that, you know, sort of Vahan.AI currently places about 40,000 workers each month, right? And you're sort of targeting 1 lakh placements. So what are the key levers that will help you scale 2.5x from here and how soon will you be able to get there?
Yeah, that's a great question. One of the things that is turning out to be a tailwind for us is the growth of the Q-commerce space itself. As you know, Swiggy, Instamart, Blinkit, and Zepto are growing very, very aggressively. In fact, we estimate that close to 1,500 to 2,000 dark stores will be added in the space within this calendar year. And then the space is expected to double from there in 2026. So we will see significant growth in this space over the next 18 to 24 months. That's a tailwind that's helping us with growth as well. Secondly, the technology that we're developing. Like I mentioned, our AI recruiter today is able to talk to candidates in English and Hindi, and we do close to 40 to 50,000 interviews a day with the AI. Once we expand to other languages, we'll be able to reach many more people across different parts of India, and that should also help with our growth.
Right. And, you know, you've also, as you mentioned, you've also announced the acquisition of Learn, right? And you are sort of now integrating upskilling directly into the recruitment journey. If you could tell us about the synergies from this acquisition and how this will sort of shift Vahan.AI's model from, you know, a jobs platform to a full-fledged career ecosystem.
Yes. I'm glad you used the word career, because that's exactly what we are trying to build for blue-collar workers. Today, blue-collar workers, unfortunately, don't really have careers. Most of them work the same type of job throughout their entire lives. And what we're trying to do with this product is help them grow. Let's say somebody starts as a delivery worker. Can they perhaps learn maybe a little bit of English and start to do sales? Or can they learn maybe a little bit of coding and start to do entry-level coding? And in fact, with AI, that's become more and more doable. So our goal is to help people really grow in their lives and their careers, not just from an economic standpoint, but an overall societal status standpoint as well. So Learn, I think, is incredibly important for us on the path to achieving that. The other thing that I am personally very passionate about is as the world changes with AI coming in more and more, people will need to upskill very quickly. India, in fact, today has about 950 million people between the ages of 18 to 60. So it's a very young population and it's a growing population. I believe that the biggest value in applying AI for India will come in helping those people upskill and augment their skills as well. So that's our plan. We hope that we can really help people get closer to their aspirations and ultimately help our country and our economy grow.
Absolutely. You know, India's job growth is expected to be driven 70% by blue-collar roles by 2030, right? So how is Vahan.AI tapping into Tier 2 and Tier 3 markets where digital access and literacy sort of remains, you know, major hurdles? If you could quickly tell us, we're running out of time.
That's a great point. In fact, even today, we're able to recruit people across 920 cities in India. So we already have fairly good reach. Our technology, especially the AI recruiter, becoming more capable in terms of languages and dialects will further improve our reach, and hopefully we'll be able to reach the very hinterlands of the country with that.
Right. And how concentrated is your revenue today? Do a few major partners like Swiggy or Zepto make up a large portion of your income, and how sticky are those enterprise relationships over time?
Our customers have never left us. We're lucky to have true partners in these companies. Our contribution to them, in fact, has only grown over time. And I'm sure it will continue to grow as this space expands as well.
Right. All right, Madhav, thank you so much for taking time out and being here with us on Startup Street. And we wish you all the best going forward.
Thank you for having me.
Trupeer.ai just raised $3 million to change the way businesses create product videos, and it's not your average screen recorder. Built for the speed and scale of modern teams, Trupeer turns raw screen recordings into polished AI-powered videos in seconds, complete with avatars, voiceovers, and translations in over 50 languages. Over 10,000 teams already use it for everything from demos to training. Backed by RTP Global and Salesforce Ventures, this Bengaluru and SF-based startup is betting big on making workplace communication video first and lightning fast. Joining me now to discuss this further is Shivali Goyal, the co-founder and CEO of Trupeer. Shivali, thank you so much for being here with us on Startup Street. You know, you are an AI-based content creation platform. If you could take us through the specific problem that you're trying to solve for, and if you could take us through what's on offer.
Absolutely, Arundhati. Really nice to be on this platform today and talk to you. Like what we're essentially doing is trying to democratize content creation for the world of software and products, right? So if you look at, the software world today, right, with AI, it's become so much easier to create new software, right? Like every day you can spin up new tools, prototypes, etc. But when you look at the communication layer around it, right, being able to talk about it, being able to market it, being able to sell it, being able to train people on it, that layer is still broken, right? Because content creation is fundamentally hard. So what we have done is we've created a really, really easy to use self-serve platform where anyone, irrespective of their skills, resources, or time, can create studio quality videos in a matter of minutes, right? So something that would take thousands of dollars and weeks is now being done in minutes in like 50 to 60 languages, across the world. So that's what we enable.
Right. And what sort of makes Trupier's AI video engine stand out from traditional screen recorders or video editors and, other firms that you're sort of competing with at this point?
Absolutely. So if you look at, traditional screen recorders, right, the place where they start, where they end is where we actually start, right? So a screen recording typically is just like really rough, right? You have to put in a lot of effort in scripting, editing, and making it actually perfect and ready to use, right? Whereas what we have done is essentially taken all of that headache away from the user. So if you do a really rough screen recording where, you're saying anything, you're sort of showing different things on your screen, but you're not really perfect about it, we will make it perfect, right? So in literally minutes, we convert that rough screen recording into something really professional without you having to spend any time in editing, adding visual effects, zoom effects, scripting, voiceover, etc. Right? So that's the fundamental value. And if you compare it to traditional video editors, right, like they're actually built only for people who know video editing, right? So you need that professional skill. Whereas if you look at our platform, that's actually now, like you said, it's being used by 10,000 plus teams. And these people happen to be first-time video creators, right? These are people who've never made videos before, but now they're making like hundreds of videos a month just because it's so much easier to do, right? So it's engineers, marketers, sales teams, customer support teams, and so on, right? So those people are finally able to create professional quality videos.
Sure. And, you've raised this $3 million in funding. How do you sort of plan to use these funds? What's on top of the agenda?
Absolutely. So what we are seeing, Arundhati, is that there's a wide need for this kind of a solution across markets, right, across countries as well as across functions, right, all the way from sales to customer support to product marketing. So obviously, the first thing on our agenda is global expansion, right? So a lot of this fund will actually be utilized towards accelerating that. But even if you look at our product, right, there's so many vectors of growth, right, beyond the content creation that we do today. There's other formats of video creation that we can enable for our users. And then how to utilize that content in actually driving business value, right? Be it solving support tickets or be it, actually driving sales conversions, right? So there are so many workflows and, there's a platformization almost that can be done around this layer of content. So that's the product acceleration that we'll be working on.
So product acceleration and, geographic expansion. But if you could sort of take us through the kind of engagement that you're currently seeing, how are teams using Trupier, and what's the kind of impact it's having across functions like marketing, support, and training?
Absolutely. So, interestingly, when we started, we thought that it's going to be used by very specific teams, right? Like be it product marketers or people who actually have the mandate of making demos. But then interestingly, what we start seeing in organizations is that once a couple of people in the company adopt it, it rapidly spreads to other teams as well. Whoever needs to communicate anything on their screen, right? Be it an engineer who's trying to sort of create, like, let's say, a test case video, right? Earlier, they would have to actually go on a Zoom call to communicate that, but now they can just do a Trupier video, right? So we see rapid expansion across functions within the company, and most of it is organic because they end up seeing one or two videos, right? They see a video and they're like, okay, I also want to create something like this. So that's something that we're seeing. And I think the other interesting vector here is that, apart from startups who were sort of our initial adopters, we are now seeing a lot of enterprise adoption, right? So in our suite of clients, we also now have Fortune 500 companies, right? Like, and their teams using it for global, training, global transformation, digital initiatives, and so on and so forth. So there's a lot of enterprise level movement that we are now seeing.
So lots of enterprise level movement that you're seeing. But if you could take us through your business model then and the kind of, revenues that you're currently clocking, where do you hope to end this year? Also, is it mainly through subscription? Are there other revenue streams as well?
Absolutely. So, our main model of revenue generation is subscriptions, right? So we offer subscriptions all the way like from, $50 a month to, something that can actually go into hundreds of thousands of dollars, depending on, your video needs, like how many videos you need to create in a month, how many teams need to use it, how many seats need to leverage it. But we've created in a way that we offer a very generous free tier as well, right? So the idea is that anyone who just wants to try it out can just go on our app and make a couple of videos and get comfortable and only then subscribe, right? So what we see in our, like I said, in these companies is that first a couple of people start adopting it individually as self-serve plans. And then, they bubble up into enterprise plans, right? Because they have larger needs. So that's sort of the revenue trajectory that we are seeing. And like month on month, we are growing like, 50 to 60%. So by the end of the year, it's going to be, quite a sizable revenue.
All right, quite a sizable revenue, not giving us any numbers there. But, if you could sort of take us through your presence, you were talking about big geographic expansion as well with the funds that you've raised. What's the global expansion plan? How big will the India market be for you? If you could sort of give us also a revenue split between the geographies.
Absolutely. So right now, around 50 to 60% of our revenue is actually US, and another 30 to 40% is India, and then there are other markets as well. Where we see that this platform has adoption wherever there's a lot of software being created, right? So obviously, US and Europe tend to be like a big chunk of that. So that will continue to be significant for us. But having said that, given the language angle, right? Given that for the first time, people are able to make videos in any language, so that language barrier is solved for, we are actually seeing adoption in a lot of like language sensitive markets, right? Like be it South America, be it, markets in Europe, like Germany, Spain, Italy, etc. Right? So there's a lot of demand coming from these markets where they would traditionally not be able to open up their platform for the world just because there was a language barrier.
Right. And, you are currently present in over 50 languages. Are you looking at sort of, developing languages for the Indian market as well?
Absolutely. So that's actually a big part of, what we have already done, right? Like if you look at, some of our enterprise clients in India, they're actually now creating content for, like for in Marathi, in Telugu, in Tamil, right? And they were earlier not able to do that just because there were not enough resources or translators or speech writers, right? So now, they're able to take that one video and translate it into 50 other, in 3 or 4 other regional languages, and then actually help educate those native speakers on their software, on or whatever training that they want to do.
All right, Shivali, thank you so much for taking time out and being here with us on Startup Street.
Absolutely. Thank you.
On that note, it is time for us to head into a short break. But coming up next, Pune-based startup Zero Circle has made seaweed processing a viable business model and an eco-friendly one by turning seaweed into edible packaging. A special report on the other side. Stay tuned. Welcome back. You're still with us on Startup Street. It looks like plastic, it feels like plastic, and it works like plastic. But it's not plastic, and it dissolves after use. A Pune-based startup has made seaweed processing a viable business model and an eco-friendly one at that. Here's a report. Landfills like these may start shrinking in size quite rapidly if Pune-based entrepreneur Neha Jain has her way. This former Google employee runs Zero Circle, a 5-year-old startup that is repurposing a plant that not many people spend too much time thinking about, seaweed. And she and her team are on a mission to reduce the mounds of plastic-ridden landfills and rubbish heaps, one plastic bag at a time.
So this is brown seaweed. This is a fresh seaweed that grows in the ocean, and it grows all over the world. We source this seaweed from south of India and west of India. We then take it through different stages of extraction to extract the material and compound of interest without changing any property of the compounds.
Zero Circle creates coatings and pellets out of seaweed which can be turned into plastic-like sheets. These are not only easily compostable, they dissolve in seawater, they're also edible. Any plastic manufacturer can use these pellets in existing machinery to make these sheets and even products like carry bags.
Where the magic begins and the IP that we hold is in the conversion of these pellets. Now, why this is very important is because when you make the material, it needs to go into an existing manufacturing line, right? Because we want to make sure that every plastic manufacturer that is available in India and all over the world is able to use our solutions in their lines.
Zero Circle has raised 20 crore rupees in seed funding this year, and Neha plans to use this to improve on and expand her product range. Adding to the sustainability factor is that the residue left over from this process is mixed with crop waste to make Zero Circle's unique tree-free paper.
So far, we've created already manufactured 1 million pieces of coated products in the market. Our goal is to commercialize coated products, and at the end of 2 years, our goal is to commercialize the coatings itself, so that not just the converters and the end users, which is retailers, even the manufacturers who are making the paper and converting the paper are also able to use that.
Seaweed plastic and seaweed paper is just the beginning. Neha tells CNBC-TV18 that hard plastics to make bottles and sachets are also in the pipeline.
So if you can simplify, if this, let's say, converts into my bottle of shampoo, and if I throw it away, how will it be recycled? How will it dissolve? How will it biodegrade?
Fantastic question. So this material is biodegradable. This material is compostable. In industrial settings, in home compost, a 2-year-old can compost this.
The sustainable and eco-friendly initiative also has huge commercial potential.
You get your food wrapped in plastic, your skincare products and the bags they come in, your phone cover, stationery, cups, snacks, the list is inexhaustible. Studies show that India generates approximately 9.3 to 9.5 million tons of plastic waste every year, which is about 20% of global plastic emissions.
And it's this 20% number that Neha and her team are keen on bringing down drastically. In Pune with Sakshi Baukar, Arundhati Ramanan. And moving on, this week, as many as 20 startups raised $140 million. According to Venture Intelligence, some of the notable fundraise includes EV battery swapping operator Sun Mobility, securing $60 million from Helios Climate and others, and mattress maker The Sleep Company, attracting an investment of $12 million from Saffron Investments, Carol on Investments, and Infinity Partners. That's not all. Dairy brand Desi Farms landed an investment of $11.43 million from 3 State Ventures and others, and edtech startup SpeakX secures $11 million, while B2B market research startup Metaforms bags $9 million. So far this year, over 500 companies raised a total of $4.8 billion. And with that, it is a wrap on this edition of Startup Street. More news and updates coming up on the other side. Stay tuned.
Welcome to Indianomics. The June CPI number coming in at a 6.5-year low of 2.1% has led to a few things. One, most economists have revised down their average CPI forecast for FY26, this year that is, to 3.2 to 3.3% against Reserve Bank's forecast of 3.7%. Second, many are penciling in another rate cut. Third, most are not expecting it in August itself. And fourth, above all, bankers and bond dealers are watching Reserve Bank's liquidity policy. How much liquidity Reserve Bank will add or remove from the system and when will determine bond yields and the rate cut transmission. Now, equity investors in banks are still penciling in about 12% credit growth on hopes of a 10% nominal GDP. That may be up for threat. And they're also penciling in an end to the rate cycle. These are what equity investors are penciling in. So today on Indianomics, we have three experts to help us understand how growth, inflation and liquidity may pan out. I have with me Saugata Bhattacharya, Senior Fellow at the CPR, Center for Policy Research, more importantly, MPC member. Neeraj Gambhir, the Group Executive and Head Treasury Markets and Wholesale Banking at Axis Bank, and Samiran Chakrabarti, Chief Economist at Citi India. Gentlemen, good morning and thank you very much for joining me in what's a very crucial conversation. Saugata, first your thoughts on the CPI number, deflation in food inflation and core as well, pretty much under control.
So hi, Lata, thank you very much for having me on your show. So a couple of observations. Yes, the CPI food overall headline and food inflation numbers came in a little lower than what markets had been expecting, but this has begun to emerge as a trend for the last 3 or 4 CPI prints. We have seen this happening. This, to my mind, is very much a one-off. One, as everybody now already knows, I mean, this is partially due to the base effect of a very high inflation print, 5.1% in June of last year. So the next 2 inflation prints are likely to be higher headline prints. Overall, we are in a very good place, very good position in terms of inflation. As you mentioned, I think inflation for the year is likely to be lower than the RBI, the current RBI forecast. So that definitely gives us room, gives room for the RBI, the MPC to continue with the easing cycle. It's just that the pace is unclear. On core inflation, which is what is probably important from a policy making point of view. I think the 4.55% that we have seen in June is likely to peak out, given the fact that base rates, the base effect of core inflation, has been increasing. So I mean, I don't expect a dramatic increase in core inflation, given the fundamentals that are driving core metals prices, commodities prices, etc., seem also to be in a good position. They are very unlikely, particularly crude prices, are unlikely to increase. So I think from the inflationary point of view, I think monetary policy is in a good position. But again, I mean, there are multiple other things to consider.
Okay. Well, Samiran, you're the person in the among the people I spoke to with the lowest inflation expectation for July. Your number is 1.1. So tell us your trajectory. Does it get much below what Reserve Bank has forecast in June?
Thanks, Lata. So yes, we are looking at a 1.5 kind of CPI for August, but this will be which will come out in August for the month of July. But this will probably be the trough on the inflation trajectory. We are now looking at the July-September quarter to be averaging about 1.9%. But at the same time, we think that all the stimulus that is going into the economy, that with a little bit lag will start impacting demand also. So we have actually built in a slightly higher momentum in core inflation for the last quarter of the year. And that's why our last quarter average headline CPI is marginally ahead of the RBI's current forecast at around 4.7%. Altogether, the full year average is about 3.2%. The critical part, which always is very difficult to forecast, is the vegetable price trajectory. But other than vegetable prices, I think most of the non-veggie food prices are that trend is going to continue as well. So overall, it seems to be, at least in the near term, a very low inflation path that we are going to follow.
Okay. Neeraj, what are the markets expecting from Reserve Bank? If the number, as Samiran is putting it, is going to be 1 point something, maybe even lower than 1.5, will they go ahead and cut despite the neutral stance?
So I think given the inflation outcome and given what Samiran has said, I think the markets are broadly in line with the fact that the next reading is going to be a low reading, but after that we'll see some recovery in inflation numbers, some pull up in inflation numbers. But given the expected outcome on inflation, despite that, I don't think the markets are expecting a rate cut in August, as you yourself mentioned in the initial part of this program. The key reason is twofold. First is that Reserve Bank has already front-loaded a lot of monetary policy action. I think given what they did in the last policy, it was much more than what the market had expected. And I think with that size of monetary policy impetus given, I would guess the Reserve Bank would like to wait a little bit longer before taking the next step. Second is that the action on the liquidity front is also a little bit unclear. There is ample liquidity in the system. There is approximately 3 lakh crore surplus in the system currently. If Reserve Bank does not conduct variable rate reverse repo auctions, then all this liquidity will sit in the SDF, which is where the rate is 5.25. But if Reserve Bank continues to do VRRs and keeps on, it will effectively pull the overnight rate up towards the repo rate. So currently the market is expecting Reserve Bank to continue with the VRRs and pull the overnight towards the repo rate, which basically means that, there is an implied 25 basis point hike in the overnight rates, right? So these are the two forces which are kind of playing out, which is why you're seeing bond market to be very, very stable at this point in time.
Okay. Yeah, I agree. Moving more towards 5.4, actually, the call rate from below 5.25 some time back. Saugata, I'm going to ask you 2 quick questions because you're not going to be with us after the break. Our discussion will continue. One is, how should central bankers think of inflation? Should they think of the fact that all through 2025, we are going to have 3% or below inflation, which means the real rate is more than 250 basis points? Or should they think of the 1 year forward, in which case 1 year ahead you may have a 4% plus? What should be the standard way of thinking?
So, I think this question has been settled in multiple papers, theoretical, academic discussions, and Samiran put it very, very clearly that it's not just the next couple of prints, the next quarter. You have to look at it over the course of the year, probably across the cycle. Again, I still go by the RBI's forecast, but even there, it does seem to be on an upward trajectory after, say, from the third quarter onwards. So obviously, this is not. You hear the argument that it's best to cut the policy rate before start with another make another easing move before inflation starts moving upwards. I don't think that's a correct argument because obviously the monetary policy easing cycle, as the name implies, is over the course of the cycle.
Okay.
So you have to consider that. On top of that, you have to look at various other measures which might impinge on core and headline inflation going forward. The inflation growth trade-off, global uncertainty, volatility, etc. So I think caution that I at least particularly keep talking about. I think that needs to be very much in place in looking at the path of monetary policy.
Okay. Let me pack 2 quick questions before you leave us. One, do you personally think that there is space? Because if you look at current inflation, there seems to be a lot of space. If you look at 1 year ahead, you can even argue there is no space. And the governor's statements can be interpreted either way in his interview to me. That one question. And the other one, would growth move the RBI more? And are you worried about growth? In the sense, the WPI number came in at deflation. It came in at -0.3. So, is there a growth scare as well?
So again, growth is definitely the impulses that you see, the data, the high frequency data that you see, definitely suggests that some ambiguity on growth. It's not very clear. I still go by the 6.5%, the forecast for FY26 growth. If we actually do grow at 6.5%, I think we are okay in this current market with the amount of elevated uncertainty that still remains. We have no idea where the overall tariff situation is going, where the trade situation is going. I think we are in a good position in terms of growth. Of course, we need to support growth given the space that the inflation trajectory even over the course of the year provides. But I think at this point in time, as Neeraj mentioned, I think the liquidity support that the RBI has provided, I think that's a far more critical thing in terms of looking at transmission, in terms of credit growth. In terms of credit growth, which is an important part of the monetary policy cycle target, the objective, I need to point out that it's not just bank credit. I mean, the overall flow of resources in the corporate sector, that's very, very, the amount of money that's being raised to the corporate bond market, I think is very, very, very high this time and is expected to remain high. Transmission has been faster in the corporate bond market. So, we need to look at the overall flow of credit, not just from the bank credit side.
Fair point. So you see space for a further fall in rates?
In short, yes. Okay. Yes, I see space, but that obviously depends on multiple factors going forward, particularly inflation.
Okay. Well, thanks a lot for that, Saugata. We'll take your leave. Neeraj, Samiran, please stay on. Quick break, and we are back with more questions. Welcome back to Indianomics. This one has been triggered by the ultra low or unexpectedly low CPI number that we got for June of 2.1, with a large part of the economists community now expecting the full year inflation to be as low as 1990 levels, 3.2%. The resultant impact on what RBI might do in terms of liquidity and rates is what we are discussing. We had Saugata Bhattacharya, the MPC member, plus Neeraj Gambhir and Samiran Chakrabarti speaking to us. Neeraj and Samiran, thank you very much for staying on. Samiran, if you can analyze the impact on credit growth, do you think that the Reserve Bank needs to do more in terms of both liquidity and rates to push credit growth? There are a lot of people who are expecting only single digits. Can Reserve Bank make a difference with liquidity?
It boils down to how you were looking at credit growth, whether you were looking at it from the demand side or you were looking at it from the supply side. Our sense is that the demand side is still weak on the credit growth front, and that's because of two broad reasons. One is that the interest sensitivity of segments of credit demand is often low. There are only a handful of them where the interest rate sensitivity shows up in a big way. And the second is, as Saugata was mentioning, the borrowers are looking at alternative sources of funding, including corporate bond, ECBs, et cetera, as well as a large chunk of equity funding, which is replacing probably debt funding. So I think the demand side would not be the trigger for credit growth to improve, but we should not be ignoring the supply side. There is substantial amount of liquidity that has been given to the banking system. At some point of time, the banks will try to offload this liquidity onto the system. This can happen through the NBFCs who have a larger feet on the street. So through the supply side, the first trigger for credit growth could come in. So I will not be surprised if the credit growth numbers inch up to 12-13% at the back end of the year when the full effect of this monetary transmission takes shape.
Okay. What's your sense, Neeraj? I mean, put on your banker's hat and think, what will a punishing amount of liquidity, every day bankers forced to give money to the Reserve Bank at 5/4 or even maybe if there is a rate cut at 5% to RBI, would that be trigger enough to force bankers to lend? In the last cycle, of course, it was very long ago, in the 2000 to 2004 rate cutting cycle, you did not see credit offtake up until 2004. It took 4 years. And then, of course, credit growth jumped to 25%. But rates falling from some 10% to 6.5% did not increase credit growth. Bankers remained cautious or borrowers remained cautious. What's your sense now?
So my sense is that hoping that this dose of liquidity and the rate cuts that Reserve Bank has done, coupled with the fact that government is doing spending on the capital side, there is some front loading of subsidies. So there is a push towards increasing sort of demand, even though I agree with Samaran, the demand side is looking a bit weak. I think all of these factors will combine to give us a better outcome on credit in the second half of this year. Currently, the credit growth is at about 9 or 10%, somewhere in between. And we will slowly inch up towards 12%. I still don't see it going significantly beyond 12-13% for this year because the demand from large corporates, the demand from overall corporate sector still continues to be somewhat weak. Now, when will monetary policy deliver? I think it's an open question. There is no clear timeline. I've seen at least 4-5 cycles now. Each cycle is very different. And the drivers of credit growth in each cycle are also very different. I think if you remember, between 2012 to 2014, the big driver was infra spending, right? So between 2017-18 to 2020, the driver was retail lending. So every time we've seen a slightly different driver of credit growth. We'll have to see this time around in the revival sort of leg of credit, which sort of segments play their bigger than usual part in terms of driving it back. But I think I would expect that as liquidity settles down in the system, as the rates settle down in the system, they have done to a large extent on the lending side, but also from banks' perspective, the cost of funds steadily comes down. There will be some impetus to bring the credit growth back towards 12-13% numbers by the end of this year.
Okay. A two-part question for you, Samir. And actually, I'll put it in two separate questions. One, this 12-13% number is coming into question more because now the nominal GDP is going to be very low. If we are going with a 3.2% CPI and a lower WPI, then the nominal GDP perhaps will not even touch 9. It could be even sub 9. And then the credit growth, if it is 1.1 times nominal GDP or something like that, we may not get beyond, maybe barely make it to double digit. Is that an argument?
So first, we are not talking of kind of average credit growth here. Okay. We are talking more about what the credit growth would be, exit credit growth type of thing. And that, to some extent, will benefit from a bit of base effect of last year when, in the latter part of the year, the credit growth actually tapered off. So from there, the favorable base should help. And, there are times when the system is trying to push higher credit. It's not for the first time that we will be seeing that credit growth will be substantially higher than that mechanical rule of X times nominal GDP growth. It could possibly be the case, but my bigger worry actually is that to what extent the non-banking channels of credit and equity would drive the financing rather than the banking credit. Fair. As Neeraj said, that there could be different pockets of credit that could emerge, not the traditional ones.
No, fair point. NBFCs are more nimble. And since there's a banking system is actually negative year-on-year terms in terms of their loans to NBFCs, maybe that route will fire. But Samaran, a more general question on growth. The Reserve Bank can be moved to cut if it genuinely perceives danger to growth. Is the 6.5 in danger? Is even 6.3 in danger in terms of growth rate?
Right now, for the April-June quarter high-frequency data, I think we are tracking somewhere around 6.5 only on GDP growth. We will get to see the corporate results now, which have a large bearing on the final GDP number. So we might have tweaked the number a little bit here and there to adjust for it. The open question is that when this tariff-related uncertainty settles down and whether the average tariff settle down at 20% for US or at 25%, depending upon that, we might see the global headwinds. We have to consider that to what extent that creates a downward bias. But at the same time, I think the markets are generally underappreciating the size of the stimulus. There's a 30 basis point of GDP coming out of tax cut. Our estimate is 40 basis point of GDP is the immediate impact of the 100 basis point rate cut on household borrowing. And then there could be about 30 basis point more coming out of higher credit growth. So altogether, about 1% of GDP, monetary and fiscal stimulus is there in the system. So that should show up in numbers at the latter part of the year is what our call is. So not thinking that the growth outlook is necessarily very bearish.
Okay. There have been economists who are telling me that even in Q1, while latter part, even in Q1, if the normal GDP is C plus G plus I plus net exports, especially service exports, have done well. Goods exports were flat even last year. So in terms of input into GDP, exports have not taken away anything, plus government spending much better than last year. So we could get a good growth number. And therefore, we are coming to Neeraj's forecast or the bond market's forecast. If the expectation is that growth is not under threat, and the RBI argues in its own mind that when I go to the August policy, I will have a July CPI which will be 1.1, if you're right, Samiran. So there will be more pressure on me in August, so why should there'll be more pressure on me in October, so why give away the rate cut now? So be that as it may, Neeraj, if there is no rate cut in the August policy, but the governor sounds dovish, saying that, if inflation surprises on the downside, etc., how will the bond markets react? Because bond markets have been, completely ignoring any chances of rate cut or low inflation. They're still sitting at 6.3, a good 15 basis points higher than the low before the June policy. Do you see any fall in bond yields?
Okay, let me just answer this in terms of what the expectation of bond market from MPC is. I think the base case or the general expectation is for no rate cut in August. Obviously, the tonality of the MPC and the language around the forward-looking view on inflation, the forward-looking view on growth is what the market will be watching out for. And I think given what we've seen in terms of data and given the commentary that even Samiran talked about, I think there is a case that you could build a case for an October rate cut, but I think between August and October also we'll have some more data. So my guess is that the Reserve Bank would likely wait until October, see data between July, August and October and see how things are playing out, particularly on the growth fund, before taking a call on the October rate cut. As far as bond market is concerned, unless and until it gets a very clear signal from Reserve Bank that the next rate cut is going to happen, I don't expect a meaningful slide in bond yields. I think we will be in a very range bound mode, around 6.25 to 6.3%. All the positives have been discounted. Good liquidity has been discounted. If anything, the overnight rates are now going to inch up towards 5.5 possibly. So I don't see a significant positive momentum, but at the same point in time, no reason for yields to actually go up from where we are right now.
Okay. Well, we'll have to leave it at that. I might just tell you that there's one more positive. One person told me before, when I was preparing for this interview, that the borrowing calendar for the next second half may have much fewer 30 to 50 year tenor because, you're getting such an attractive rate at the lower end. The government may rethink, or the RBI may advise it to bring it down. Then there is a bit of a rally perhaps at the steeper end of the curve. Let's wait and see. Many moving parts here. Samiran, Neeraj, thank you very much for continuing with this conversation and helping our understanding of what to expect from the Reserve Bank in terms of inflation and growth numbers, as well as how the bond market will behave. That's it on this edition of Indianomics. Thanks for watching.
Let's talk money.
Hello and welcome to this week's edition of Let's Talk Money. I'm your host, Surabhi Upadhyay. Now, it's been a news and noise-heavy first half of the calendar year. Markets have been volatile, yet resilient. They've been dealing with all the war and tariff developments that have been thrown around. But one thing that investors have perhaps rediscovered in 2025 is that making money is not a straight line process. So it's a good time to revisit some of the ground rules of portfolio planning and also talk about why a portfolio shouldn't be too skewed towards any one particular asset class, even if that asset class is equity. Today on the show, I have with me Alek Yadav of Sanctum Wealth, who will tell us the 5 mistakes to avoid in our portfolio. And of course, then he'll also shine a light on how hybrid funds perhaps can help us enhance overall returns just that little bit. Alek, great to have you back on the show. So thank you so much for being here.
Thank you so much. Thanks for having me again.
So I want to start with a dipstick mood check first.
Yeah.
Because this has been, like I said, it's been so noisy, right? All kinds of news.
Yeah.
And you don't know, tariff, and Mr. Trump is telling you that the whole world has to be reset, and geopolitics. What is the feedback you've received from clients? What are they saying? Are they still buying every dip?
Sure. Yeah, so I think there's a little bit of concern that is there amongst investors as well, So they're afraid from committing too much of capital at this point of time. However, what has happened is that the last quarter was such a one-way run, that they're also fearful of missing out on the rally. So I think most of them are staggering, and that's what we're suggesting clients, that instead of fully staying away from equity, stagger the money over a period of time so that you get participation, and if there is a correction in the market for whatever reason, then that could be an opportune time to add more to equities.
So there is fear of missing out, but there's also fear of participation. So
That's
it's like, twin fears working together.
Exactly.
But in generally, as a house call right now, when you talk about any broad portfolio advice, so I know it'll be different for different individuals, but generally, are you fully overweight on equity? Is it more equity skewed? Gold has done so well. So I think people are just asking themselves these questions: that where should I be? Where should my money be?
So we have been overweight gold for a while, for actually the last 2 years. Actually went overweight when Ukraine and Russia crisis broke out in 2022, and we've been overweight in gold since then. Now I think we're starting to book a little bit of profit because it's been a stellar rally for gold. So we're booking a little bit of profit. We're adding a little bit to equities. If you look at Indian markets, things have only improved. The macro environment has become better. The government is starting to spend. RBI has cut rates by more than 1%, and is also supporting liquidity by doing open market operations. So the overall macroeconomic environment in India is improving. On the other hand, the earnings sort of bottomed out in the last quarter. I think the expectation is that they will keep improving quarter on quarter, and the second half of this financial year should be a better year. And that's why we're saying that slowly, gradually add to equities and don't miss out on the rally. If there is correction for whatever reason, it is likely to emanate from global market risk. Use that opportunity to add to equities.
So equity would be the one big asset class that you're advising that investors should they should be putting in their money. What else, just in terms of asset classes?
Yeah, so that's one. Gold, we still have some allocation. We're not fully taking out.
How much?
Generally, our model portfolio allocation is about 10%. We were right now at closer to 12%, slightly overweight on gold. And on the debt side, we are saying that maybe it's time to book out money from duration and add to conservative debt like corporate bond funds, and using income plus arbitrage as tax efficient vehicles to take allocation to debt.
Okay, so that's the overall thought process with respect to where the money should be parked. That's the Sanctum view. But now I want to get to the exciting part. Because the way Alek has done this is that he's going to encapsulate all the mistakes we end up making in a panch ka punch. So the 5 to avoid. Take it away, Alek.
Yeah, so I think the first one, that we typically see in client portfolios is over concentration or over diversification. So generally investors who have been investing for a long period of time, HNI investors who have a larger portfolio, they tend to end up accumulating too many mutual funds. We've seen in client portfolios with 40, 50 mutual funds as well. And as we know, each of these mutual funds have about 50, 60 stocks. So you overall end up owning like 1,000 odd stocks, almost the entire market. That's too much of diversification. On the other hand, newer investors who started new, they end up doing 2, 3 mutual funds, maybe 4, 5 mutual funds, and have a concentrated portfolio. There again, what happens is that, if there is a good experience with one fund, you got it at the right time, you end up owning 20, 30% in that one mutual fund. So that's too much concentration. Our ideal, thing is anywhere between 5 to 15% allocation to one single mutual fund, which means around 8 to 12 mutual funds on the equity side is more than enough, and that should cover for you.
8 to 12 funds. Because this is something that people always grapple with, and sometimes people have multiple advisors. So you have one portfolio with one and another with the other.
Exactly.
So you're saying no more than 8 to 15 funds.
Yes, that's right.
Okay, so that takes care of the over diversification part of it.
Yes.
if someone does have a big portfolio right now with like 20-25 funds, and they need to basically clean it up and come down to what you're saying. How do you start? Where do you, how do you prune it and get it all together?
So the second point comes in, which is the diversification across market cap as well as style. We'll talk about both of them. But here, what we should look at is that, you should have funds in each category, some flexi cap, some mid cap, some small cap, some large cap mutual funds, and then diversification across style is also what you need, and we'll talk about that.
All right, so mistake number one to avoid, do not be over diversified in too many funds. That's number one. So what's the second mistake to avoid?
So second one is market cap, and that is very pertinent right now because we've seen a stellar run for mid and small caps. They've outperformed large caps almost, like small cap index has done double of large cap in the last 5 years. So and investors look at past returns while taking decisions. So one may be a little more skewed towards mid and small cap at this point of time. And we know mid and small caps also have their cycle. So that periods where they do extremely well and periods where they underperform as well. As a thumb rule, what you could look at is the overall market cap for India. If we were to break it in large cap, mid cap, small cap, about 70-75% would be large cap. 20-25% would be mid cap, and the balance 5-10% would be small cap. So that could be your guiding tool. And depending on if you're aggressive, then you could have, say, maybe 40% in mid and small cap, and if you're balanced in less.
But that's the thing, because the last couple of years, large caps have not been delivering great returns. Therefore, people have wanted to go to mid and small caps in search of better returns. So what do you say to that? Because it's a valid argument, right? Because foreign investors are not coming in, so you're not seeing big moves in big large cap stocks. So if you're stuck there, you're forever going to be underperforming.
Yes. So I think the right way to take that large cap allocation is through flexi cap funds. And flexi cap funds will have about 50-60%, 70% large cap exposure. They'll do their picking up of the right stock, which will add a little bit of alpha. And then they'll use the mid and small caps to also deliver good returns. And if you look at flexi cap funds, they've done really well. Some of them have done really well in the last 5 years. So that is, I think, the way to go ahead rather than just doing pure large cap mutual funds.
Okay, so maybe flexi cap funds could, give you that edge because ultimately it's the portfolio manager, the fund manager who's going to decide whether it's time to load up on some additional well-performing mid caps or not. So second mistake to avoid.
We're now joined by Philip Luck, Director of the Economics Programs at CSIS. Mr. Luck is also the former Deputy Chief Economist for the US State Department. We're also joined by Humayun Falakshahi, Head of Crude Oil Analysis at Kepler, and Thomas Matthew, former bureaucrat who served as Deputy DG at the Institute for Defense Studies and Analysis. Mr. Matthew is also a security analyst. Thank you very much for being with us on the program. Philip Luck, if I can begin with you. US has been investing in the India partnership for the last so many years as a buffer to China. What has gone wrong so seriously that Donald Trump has used this kind of language for the Indian government, saying that Russia and India are dead economies, they can go down together for all I care, then saying that we're going to penalize India with very harsh tariffs. Why would he use this kind of language for India? What's gone wrong? What's he so upset about? And what is the US really seeking from the trade deal?
It's a great question. I think I would certainly start by saying this seems to be frustration, not strategy. And we're seeing this replicated across many of other trading partners. If you think about critical minerals, Canada is going to be an incredibly important partner for our critical mineral supply chains. We are doing everything to disrupt those productive relationships. I think the exact same thing is true here with India. The last thing I would say is, I think some of the problems that we're having, the administration clearly wants to be opening up markets for U.S. ag. A problem there is the reason they need markets for U.S. ag is because due to other trade tensions, other markets are shutting down. So exactly the sticking points that we have with India right now are in some sense self-created because of other challenges that we've created for ourselves.
Right. Just to speak to you about agriculture and dairy, top government officials have briefed journalists here and they said that there can be no compromise on agriculture and dairy because almost 60 to 70% of our population is into farming. And these are farmers with very small land parcels. It's very difficult for India to give any concessions, and this would be a non-negotiable. And is agriculture and dairy really what US wants? Because on one hand, Donald Trump, Phil, says that India is a very small trading partner. We don't do too much trade with them. Is this about agriculture and dairy, or is it about bigger oil and defense contracts?
It's a good question. I mean, I think, it certainly is the case that people have indicated to the president, or they've gotten into his ear and said that these barriers are things that have to come down. But to your point, I don't think there's a proper appreciation for the fact that these are non-negotiable. These are things that are incredibly difficult to do, and the concessions that we would have to make, which of course we're not willing to, would have to be enormous to sort of offset the implications for the Indian economy. To your point, there are areas of compromise. I mean, there are rather mutual benefit, whether it be through continuing to increase our defense cooperation or oil and gas and other areas. The other area I would say, of course, I do think even though they didn't put a tariff on India for its imports of oil above the price cap from Russia, I do think if there was some ability to make movement there, that could really help.
Right. Let me go across to Humayun Falakshahi on that question. Partnership with the US is strong. We are going to buy $25 billion worth of oil and gas from the US this year. But we have to keep in mind geopolitics and market demand and market conditions. To what extent are you seeing India's import of Russian energy go down? Do you significantly see India's energy imports from US going up?
Hi, Raicha. Thanks for having me. I think, to an extent, imports from from Russia into India have been relatively stable year on year. So, as you know, India emerged as one of the largest buyers of Russian crude after the war between Russia and Ukraine, and the imports went up from 30,000 barrels per day back in 2021 to 1.8 million barrels per day. So far this year, we're still at these levels. We're slightly under on a year-on-year basis. We're only down by about 50,000 barrels per day. But it's true that in July, we have seen a big drop in imports into India of Russian crude. But it's also down from a very high level back in June. So in June, we saw more than 2 million barrels per day of imports, actually. And there's been a 500,000 barrels per day drop in July. This could be the beginning of something, as you mentioned that India could shift some of its crude diet more towards, let's say, countries like the Middle East or even the US as well. So it's true that we've seen an increase in oil imports from the US, but in terms of volumes and the magnitude of the shifts, it's far from being sufficient, I would say, in the Indian market. So, we have seen a drop of 500 KBD, 500,000 barrels per day from Russia. And on the other side, we have seen an increase of 100,000 barrels per day from the US. And looking forward, given the US has a very diversified export market, the US cannot really replace Russia in the Indian market. We could see imports from the US go to as high, I would say, as 300,000 barrels per day, which is another 100,000 barrels per day on top of what is currently being achieved. But it's hard to see it go a lot higher, considering all the different characteristics of US crude as well, which is quite different in terms of quality compared to Russian crude.
That brings me to my next question. To what extent have you seen a growth, a jump in India's import of US crude, US LNG since February this year? And logistically speaking, and complementarities in crude refineries, price-wise, can US actually replace Russian crude? And will India be able to stop buying Russian crude altogether?
So the answer to your very last question really depends on the extent of the U.S. action against Russia here. Whether it's going to be secondary sanctions being imposed, whether it's secondary tariffs, it makes a difference. Or even, as we think at Kepler, we believe that this is mainly a negotiating tactic from the Trump administration, and at the end of the day, there will be an agreement to continue import oil from Russia to an extent. Secondary sanctions, of course, I think this is the kind of bazooka option from the Trump administration. It would mean that all Indian refiners would suddenly need to stop imports from Russia. Secondary tariffs, I think it's still quite debatable, and we could still see some imports from Russia. Looking at the imports from the US, we have seen, again, an increase since the beginning of the year. And if you compare, for example, with 2024 and 2023, there has been an increase of about 100,000 barrels per day in the past 2 years to about 200,000 barrels per day. On average, so far this year, actually the past 2-3 months, we have been closer to 270,000 barrels per day from the US. But again, if you look at this magnitude, it's far from being able to replace Russian crude in the Indian market, which is 6 times higher in terms of volumes. The fact that the US, needs to export to different markets as well mean that it cannot be replacing Russia on its own in the Indian market. However, India can also turn to the Middle East and to West Africa, for example. We have seen the spread between Brent and Dubai come down. So it means that crude from the likes of West Africa and Brazil are becoming more attractive to Indian buyers. But I think it would still be a problem because the Russian share in the Indian market is still at 37%. And so that's a huge chunk to replace, and it will come at high cost if it has to be.
Right. Let me go across to Mr. Thomas Matthew. Mr. Thomas Matthew, as someone who has watched India-US relations for a long time, is there still room for some creative negotiations and diplomacy? How do you find a way around your red lines? You've got a US president saying that you have to give me unprecedented access or I'm going to hit you with secondary tariffs, and those could come as early as the next 10 days. If the Russia-Ukraine talks were to fail, there could be more penalties on India. What options does India have?
Yeah, Parishit, firstly, thank you for having me on this talk. Now, let me tell you, India is in a slightly precarious position here. You have Trump, who is very unrestrained in both his actions and talk, and he will walk his talk. If you see what has happened to UK, you should understand the Anglo-Saxon country has always been the closest to the United States. And even with regard to UK, he has negotiated a very tough deal and got several concessions from UK. And he has reduced the tariffs to 10%. Another strategic partner like Japan, he has imposed 15%. And EU, the largest trading bloc, also 15%. Now, can India defy Trump? My answer is no, India cannot. Now, if India were to be penalized for importing Russian oil, it would actually impact India's economy substantially. We need to accept that the US is the giant in the world market. It's about 26% of the world GDP. And plus India's exports to US and India's trade with the US is about 18 to 20% of its total trade. So India cannot do without the US. But at the same time, I think India will have to take a principled stand and negotiate very carefully, pampering to, if I may say, Mr. Trump's ego. The whole shift in Trump's strategy with regard to Russia, I'm told, happened because Melania Trump's influence on Trump, and there's been a sudden shift saying that the Russian president, who was considered to be very savvy, very smart by Trump, has suddenly become his nemesis. Now, if he's going to take a tough stance with regard to Russia, you need to understand that we are importing, as Mr. Homayan said, we are importing close to 30 to 37 to 40% of our needs from Russia. And that's about $50 billion. Can you change overnight? You cannot. You will probably be able to spread your intake to other countries over a period of time. But if Trump takes a tough stance, you will be compelled to enter into some kind of negotiated settlement. If EU has been compelled, if Japan has been compelled, if UK, the closest ally of the US, has been compelled, then I think India has no choice. India will have to negotiate very subtly with the US administration. Although the stance of Trump administration, according to me, is completely irrational from many points of view.
Right. Mr. Matthew, I want to speak to you about the defense partnership because that's the other irritant in talks. I'm going to take a break, but I'll request all our guests to stay with us. We'll be right back. Welcome back. You are watching Global Eye, and we continue to focus on the India-US trade ties in light of some sharp criticism from Donald Trump. We still have with us Philip Luck of CSIS, Humayun Falakshahi of Kepler, and defense expert, and someone who has worked across the Finance Ministry, the Industries Ministry, and the Defense Ministry in India, Mr. Thomas Matthew. Mr. Matthew, speaking about the defense relationship, you know, 72% of our defense inventory is of Russian origin. Our defense imports from Russia have been going down, but can we significantly increase our defense imports from US? Is the US seeking, according to you, most favored defense supplier status from India? Can India do that?
Yeah, Parishad, that's a very tricky question. That's a difficult question. That's a very important question. If you really ask me, I've been a person who's been critical about importing American equipment, US equipment. And why do I say it? I say it because if you import American equipment, you can only fight the wars you want the US to us to fight. On the other hand, Russia has been the most dependable ally of this country, starting from the 1971 war. And please understand, the US weapons are subject to technology denial regime. While on the other hand, Russia has been more than forthcoming in transferring technology to India. Whether you talk about the nuclear submarines, whether you talk about shipbuilding, whether you talk about missiles, in comparison to Russia, US has not been a dependable defense partner, nor will it be, because of the tight technological control regime they have. In fact, they do not have much history of co-production, except in some of the European countries and also in UK. So therefore, shifting to American weapons would do India bad, according to me, because these weapons cannot be utilized or put into action unless the US says, go in and use them. This is the basic problem. And I don't know, India is going to face a tough question, how it will be able to evolve a strategy to keep Trump happy, at the same time, keep India's preparedness intact. For instance, S-400, the missile, the defense missile, surface-to-air missile, which proved its potency. So similarly, we have nuclear submarines, we have all kinds of weapons from Russia. You don't want a supplier who will control the equipment which you buy, which you pay money for. This is the problem which we are going to face.
Right, that's a very important point. Let me go back to our guest from CSIS, Mr. Phil Luck. Phil, just to ask you, what's going to happen now over the next few weeks? And what we saw during the Biden administration, and you were a part of the Biden administration, there were tariffs on steel, aluminium that were imposed by Donald Trump. There were some China tariffs that were imposed. Joe Biden and his administration kept those tariffs on. They did not change that economic policy, so to say. They added their own. They had their own legacy. But it's not like they completely did away with the kind of tariffs Donald Trump had. Is there a danger that if India is not able to have a deal with the US, then the tariffs that are imposed by Donald Trump now may stay even with the next US administration?
I think that's a real concern and something that I've been thinking about more recently. I think, look, tariffs are very hard to take off once you've put them on. There's a protected constituency who really wants those tariffs in place and is going to lobby quite hard to keep them in place. When we had the tariffs on China, when we came in the Biden administration, there was a lot of talk about how to make those more strategic, how to lower them in certain areas where we could import more from China and increase them in areas where it was strategically important to do so. That really didn't happen. We weren't able to reduce tariffs because of the sort of pull of keeping protection in place. The other thing I would note is, these are not an enormous source of revenue relative to overall government revenue. the tariffs we're looking at now maybe be about 5% of government revenue. That's still about $200 billion. So anybody who lowers tariffs from here is going to have to answer the question, where are you getting $200 billion, or are you borrowing it? Now, of course, we're borrowing far more than that, but I agree with you that, you know, overall, this big tariff regime, the longer it stays in place, the more difficult it's going to be to move back to anything close to our pre-Trump 2.0 tariff regime.
Right. Coming to you, Humayun Falakshahi, when it comes to India's imports, could you give us a sense, if you had to quantify in value terms, what would be the value of our imports, oil and gas imports from US since the start of this year versus Russia? And in terms of certain long-term contracts that you're tracking, are you getting a sense that Indian energy companies are signing major long-term oil and gas contracts with US entities?
Yeah, so I mean, when it comes to the value of imports, so specifically looking at the oil side of things, as Mr. Matthews mentioned, it's more or less from Russia, it's more or less around $50 billion. It's actually slightly under that, around 45, 46. Again, if we compare in terms of volumes to the US, you know, imports from Russia are about 5 to 6 times higher. So in terms of value from the US, it would be around, you know, I would say about $7 billion in terms of oil. Now, that said, Russia's oil is slightly discounted, so this is also to take into account. But more or less around $7-8 billion when it comes to oil. When you look at LNG, the volume actually from the imports from the US have decreased so far into India. They have almost halved. And that's mainly due to, you know, it's not linked to the recent skirmishes between New Delhi and Washington. It's mostly linked to the LNG market and the fact that the prices in Europe have been more attractive for US producers. So they have been shipping more of their LNG to Europe. If you take that into account, then more or less the total traded value of energy between the US and India, I mean, oil and liquefied natural gas is around $10 billion, so a lot less than what India imports from Russia. And I'm sorry, if you could repeat your second question, that slipped out of my mind. I'm sorry.
Right. Any visibility outlook on certain long-term contracts with US entities? Are you seeing that between India and US entities?
Not really, no. I mean, you know, you look at the refinery landscape in India, usually they have a lot of term contracts signed with the likes of Middle Eastern countries. And also recently, you know, Reliance and Naira have had term commitments with the Russians. Excuse me. With the US, it hasn't been really the case so far. I think we could be in a situation where if there's a trade deal that is signed, it could be a promise that the Indian players, the importers, the refiners, you know, pledge potentially to the US administration that, you know, we pledge to increase our buying from the US and potentially even sign term commitments, meaning that there is a certain level of flows, a minimum level of flows that US producers would be able and would be certain to ship to India. It's something that could take place, but so far we haven't heard anything like that.
Right. Mr. Matthew, coming to you, do you now expect that if we don't have this trade deal, we could be looking at a prolonged phase of SAARC relations between India and United States? And secondly, in terms of market sentiment on the financial sector, on the stock markets, if you don't have this deal and you have tariffs, which put you in a disadvantageous position. If I look at the tariff chart now, we have the highest tariffs in South Asia. How do you think the investor sentiment will be on India if we don't have this deal and India-US relations were to worsen here on?
Parshit, more than the 25% tariff, I'm worried about the additional tariff that will be imposed if India does not reduce its dependency on Russia, both for defense equipment as also with regard to oil. That's the catch here. And knowing Trump, one morning he will wake up and then play golf, and sitting in his cart, he will say, okay, from tomorrow, I'm going to impose 200% tax on India, or 300% tax, or 500% additional tax. That's the worry. Now, you need to understand India's total trade with the US as a percentage of US trade in goods is only about 2.4 or 2.3%. That's not substantial. But for India, it is substantial. But if the 25% continues to hold, then it's going to adversely affect Indian economy. There is absolutely no doubt with regard to that. See, almost 20% of India's total export goes to the US. And there are certain areas like pharmaceutical and gems where the percentage would slowly rise to 28 to 29 to 30%. So India will have to, play smart with Trump, and negotiating with Trump to strike a deal is a sine qua non, is a non-brainer as far as I'm concerned. I may not agree with Mr. Luck when he says that if this tariff continues, then it will become the new norm. That may not happen. You cannot compare China and India. Biden continued some of the policies of Trump because China is the big threat to the US, whether it comes to the chips or whether it comes to defense. But as far as India is concerned, you need to understand, except for Trump, many other American presidents have appreciated the need to strengthen India because of the democratic dividend the world will get if India becomes actually an emblem of success of democratic values. The US always speak about India's pluralistic society. They speak about India being the largest democracy. And in many ways, India's democracy is stronger than the American democracy, is more vibrant than the American democracy, because American democracy is primarily controlled by pressure groups and lobbies. While in India, it's more down to the root. So India has got something like a better form of, I won't call it direct democracy, but better democracy. But the US should be doing that. But unfortunately for Trump, he is like an old-time 15th century British mercantilist, That's what he looks like. He looks at the world not in terms of geostrategic perspective. Now, Bush gave India exception. If you remember, Jimmy
Matthew, I'm running out of time.
Sorry. Okay.
Mr. Matthew, I'm unfortunately running out of time, but I really appreciate your views. And there is hope in India, and what we are told by sources that the government is going to try and negotiate and find a way out, because it's just too important a relationship to sacrifice like this. But Phil Luck, Humayun Falakshai, Thomas Matthew, thank you very much for joining us on the program. With that, it's a wrap on this edition of Global Eye. Thank you for watching. Goodbye.
Hello and welcome to India Business Hour. I'm Ashmit Kumar. Here are the headlines that we're tracking this evening. Stock markets decline across the world as US President Donald Trump reignites the global trade war, imposes tariffs ranging from 10 to 41% on 92 countries. Canada hit with 35% tariffs, Switzerland hit with 39%. All the new rates to take effect from the 7th of August. The 25% on US tariff on India is the highest in the region and among most developing economies. The White House is yet to clarify on the proposed penalty for trading with Russia. Indian government says the partnership with the US has weathered several challenges and New Delhi is confident of continuing the relationship moving forward. President Trump issues an ultimatum to 17 top pharma companies over drug prices, says prices in the US must be reduced to bring parity with international prices. Sun Pharma shares decline amid fears of the company's innovative portfolio, which accounts for 20% of total sales. Sensex and Nifty declined for the fifth straight week, the longest losing streak in 2 years. More than 35 stocks on the Nifty end in the red. IndusInd Bank likely to face further government scrutiny after disclosing accounting lapses. Sources say Corporate Affairs Ministry has initiated a suo motu inquiry. IndusInd Bank says it has not received any communication from the ministry in this regard. The Income Tax Department surveys premises linked to Jane Street in Mumbai. Sources claim Jane Street is not cooperating with the investigation and access to data is being blocked. This comes after SEBI penalized Jane Street, alleging market manipulation. IDBI Bank strategic stake sale moves a step closer. The EPAM secretary tells CNBC-TV18 that due diligence for the bank has been completed, adds that they hope to invite financial bids by the end of this year. ITC reports a mixed first quarter. Revenue beats expectations, profits in line, but margins missed the estimates. Revenue from cigarette business above 8,500 crore rupees and volumes are close to 6%. PNB Housing Finance CEO Girish Koski resigns a year ahead of the end of his fixed tenure. The resignation is effective 3 months from now. The stock crashes 17%. PNB management says that there are no business-related issues at its subsidiary, adds that Koski's exit is purely personal. Indian Medical Association says 650 private hospitals in Haryana will suspend treatment under the government's Ayushman Bharat insurance scheme from the 7th of August. Association cites unpaid dues worth 500 crore rupees, also writes to the Chief Minister and state authorities seeking payments. Apple reports a blowout June quarter with $94 billion in revenue, the biggest jump in nearly 4 years. India revenue hits a record high. The tech giant projects a $1 billion hit due to Trump's tariff in the current quarter. Parliament remains paralyzed amid uproar over the voter list revision in Bihar. Rahul Gandhi accuses the Election Commission of being involved in voter theft to benefit the BJP. Vice presidential elections to be held on September 9th following Jagdeep Dhankar's sudden resignation. Shah Rukh Khan wins his first ever national award for Jawan. Will share the Best Actor honours with Vikrant Massey for 12th Fail. Rani Mukherjee wins the Best Actress award for Mrs. Chatterjee vs. Norway. 12th Fail is also adjudged as the best film. Well, we'll come to that in just a bit. But first, the top story this evening. US President Donald Trump has reignited his trade war, sparking a decline in stock markets across the world. 92 countries have been hit with new tariff rates ranging from 10 to 40%. The new rates are set to take effect from the 7th of August. India is facing the highest tariffs in the region. The new rate for Bangladesh has been reduced from 35% earlier to 20%. Pakistan faces a 19% tariff and Afghanistan is the lowest with 15%. India is also staring at the highest tariff rate among developing economies in Asia. Vietnam faces 20%, while Malaysia, Indonesia and Philippines all face a 19% tariff rate. Among the BRICS nations, South Africa has the highest tariff rate of 30%. President Trump has imposed only a 10% tariff on Brazil, despite defiance from Brazil's President Lula. US had threatened to impose 50% tariffs on Brazil, but a sharp rise in beef prices could have forced President Trump's hands, as the US is dependent on beef exports from Brazil. Russia is currently under US sanctions, and there is no meaningful business activity between both the nations. Among the advanced economies, UK faces a 10% tariff rate. The European Union, Japan and South Korea face a tariff of 15%. Meanwhile, tariffs which are much lower than what Trump had threatened to impose in the month of April of this year. Now, finally, there are a handful of nations facing higher tariffs than India. Canada is one amongst them. Canada has been hit with a 35% tariff, which has drawn a protest from Prime Minister Mark Carney. Switzerland is in shock after Trump imposed a 39% tariff. The Swiss government is saying that it continues to seek a negotiated solution. And well, as I mentioned, the 25% tariff levy on India is the highest in the region and among developing economies. The White House is yet to clarify on the additional penalty component. Indian government says that the partnership with the US has weathered several challenges and that New Delhi is confident of continuing this relationship moving forward. For more on this, Parikshit Luthra, my colleague, joins us. Parikshit, give us a sense, what next in this tariff tussle that we've seen over the last 48 hours?
Well, definitely a worrying and precarious situation for India. We've been hit with the highest tariff in South Asia. Countries like Pakistan, Afghanistan, Bangladesh, Cambodia, Sri Lanka, they've all got lower tariffs. And what's worse, India could be hit with a penalty because of our energy and defense exports from Russia. And this could happen as early in the next 7 to 10 days if the Russia-Ukraine war were to fail, and the US could go ahead and impose secondary sanctions on India for purchasing Russian energy. So where do things stand? Sources in the Indian government saying that the effort will be to resolve and not retaliate against the United States. We would like to see how the sticking points, the tension points that have cropped up in the relationship can be addressed at the earliest. We would not want to compromise or sacrifice a long-term, very important strategic partnership, the India-US strategic partnership. What we're told that the government is going to convey that we already have a strong, robust energy partnership under the India-US compact, and the same goes for defense, and India will only grow this further in the weeks and months to come. When it comes to energy, we are buying $25 billion worth of oil and gas from the US in the year 2025. More can be done, but at the same time, we cannot sacrifice some of our time-tested partnerships, such as our partnership with Russia, for that matter. We are dependent, 80% dependent for our crude needs on imports, and we have a diversified basket. India possibly is likely to reduce its reliance on Russian crude. It has already come down sharply this month, but it will continue. We may end up buying more from countries in the Middle East, from Africa and the US, but we can't stop buying from Russia altogether. The Ministry of External Affairs has made some 4 or 5 important points. I'll quickly run our viewers through them. Number 1, India will remain focused on the substantive agenda between US and India. Number 2, India-US partnership has weathered several transitions and challenges, and we will be able to overcome this present tension. There is potential to grow the defense and energy partnership under compact. India-US ties and India-Russia ties stand on their own merit. They should not be seen through the prism of any third country. And India and Russia also have a time-tested partnership. Finally, the important thing for our exporters is that the exemptions that we have on sectors such as pharmaceuticals, semiconductors, critical minerals, lumber, steel and aluminum, sectoral tariffs on autos, those continue as it is, as exemptions. That hasn't changed. But the worry is additional penalty on India. And whenever that happens, that will be a further blow to the Indian government and also our exporters.
India and the United States share a comprehensive global strategic partnership anchored in shared interests, democratic values, and robust people-to-people ties. This partnership has weathered several transitions and challenges. We remain focused on the substantive agenda that the two countries have committed to and are confident that the relationship will continue to move forward.
Well, staying with Donald Trump, shares of pharma stocks, including Lupin and Cipla, tanked in today's trade. This after U.S. President Donald Trump ramped up the pressure on 17 pharma companies. In a post on Truth Social, Trump said that these companies have 60 days to work with his administration to slash drug prices, or they will face action. White House Press Secretary Caroline Leavitt has said that President Trump expects the drug makers to commit to this warning and to provide the most favored nation pricing structure for American consumers.
The president signed an executive order earlier this year to solve the problem of exorbitant pharmaceutical pricing. According to recent data, the prices that Americans have been paying for brand name drugs are more than 3 times the price other similarly developed nations pay. The president is determined to solve this problem and took further action today. He has signed 17 letters to pharmaceutical companies' CEOs. Moving forward, the only thing I will accept from drug manufacturers is a commitment that provides American families immediate relief from the vastly inflated drug prices and an end to the free ride of American innovation by European and other developed nations.
Well, India is setting its sights on Latin America to boost exports. Sources tell CNBC-TV18 that an Indian delegation will meet the South American trade bloc Mercosur this month. Officials will likely hold discussions on achieving a free trade agreement. The current preferential trade agreement between India and the bloc covers 450 tariff lines. The FTA will also allow Indian exports to access new markets in the Caribbean. And well, on to the day's market action. The market fell for the 5th straight week amidst the U.S. President Donald Trump's tariffs on India. This is the longest losing streak in 2 years' time. The Sensex and the Nifty fell 1% each, while Nifty Bank and Midcap Index are down 2% each. More than 35 Nifty stocks posted losses this week. All sectoral indices saw steep cuts, with realty, defense and metal leading the pack. The only exception this week was the FMCG sector. Now, GST collections for the month of July rose to 1.95 lakh crore rupees, marking a 7.5% year-on-year increase. The growth was largely led by higher collections from domestic transactions and imports, signaling steady economic activity. Meanwhile, gross GST collections in the first 4 months of this fiscal year is nearly 11% high on an annual basis. Now, IndusInd Bank is likely to face more government scrutiny. Sources have said that the Corporate Affairs Ministry's preliminary inquiry has shown possibility of more corporate governance lapses at the bank. The IndusInd Bank says it has not received any communication from the ministry in this regard. Timsy Jaipuria has joining us now with more details. Timsy.
Well, yes, as you rightly said, a preliminary suo motu inquiry was initiated in the IndusInd Bank matter by Ministry of Corporate Affairs, and now what sources indicate that the ministry has formalized the preliminary inquiry report, where it finds that it alleges that there are several irregularities when it comes to corporate governance and various laws of the MCA Act, that is the Companies Act, and thus keeping in mind these violations, these alleged violations to be precise, MCA is now assessing its final report, and the government, to be precise, is seeing what else could be the next follow-up action, whether there could be an SFIO probe which can be ordered in this particular matter, or for that instance, whether government says that they will like to go ahead with further detailed inquiry and the matter being referred to DG investigation again under MCA, something that we'll have to wait and watch for. But yes, as of now, more irregular